Hello students. Now let's have a discussion on another very important economic related module, that is the concept of India and international trade. Now in this particular module, we'll be discussing very, very important concepts such as exchange rates. Very often you have come across the concept of rupee versus dollar exchange rate, how many rupees are required to purchase a dollar, etc. We'll have a discussion, total discussion related to the concept of exchange rates today. And after this, we'll discuss another concept of balance of payment. Generally, one question is asked either from the concept of balance of payment or from the concept of exchange rate. After this, we'll discuss foreign trade policy, then the concept of economic integration, then India's trade relations with the rest of the world. Now let's start with the discussion on the concept of exchange rate here. First and foremost, understand the idea here. We say that Indian economy is an open economy. Okay. Now what do we mean by the term open economy here? Technically, the concept of open economy is that there are various interactions between one country with the rest of the world. For example, let's say this is India, and there are multiple interactions between India with the rest of the world. For example, USA, China, Japan, South Korea, the Great Britain, etc. And because there are interactions, there is inflow of the foreign currencies into India and outflow of foreign currencies from India. Now, what kind of interactions are generally represented here? For example, from India, the goods are exported, services are exported, as a result of which there is an inflow of dollars into India. Now, although the trade is conducted in different currencies, generally in the discussion of exchange rate as well as the foreign trade policy, international trade, etc., I will use the international currency, that is a dollar. Okay, so understand this. There are exports of goods and services as a result of which there is inflow of foreign currencies into India. In the same way, India imports goods and services as a result of which there is outflow of the currencies from India. So there are various transactions like this because of exports of goods and services, imports of goods and services, right? Tourism, healthcare expenditure, imported, exported, investments in assets are either done in foreign countries or foreign investors are doing investment in India. So because there are interactions between India and the rest of the world like this, we generally say Indian economy is an open economy. And whenever you have an open economy, there are always requirements to convert your currency into international currency and vice versa. For a simple reason, whenever you want to import something, the exporter from another country would want to receive the payment, let's say in terms of dollars. So we do not print the dollars in India. I understand the logic here. We do not print the dollars. RBI has only the right to print the Indian currency notes that are rupees. So when you print the domestic currency notes, but you want to pay, let's say in terms of dollars, you need to convert your rupees into dollars. And vice versa also. Imagine here's an exporter. He has exported certain goods or services to, let's say, the USA market and has received certain dollars. Can he use these particular dollars in the domestic market? Imagine you are the exporter. You have received the dollars. Can you use the dollars to pay salaries to your employees? Can you pay the dollars to your vendors or suppliers who are there in the domestic market? No, because in the domestic market, the currency that is accepted as a mode of exchange is rupees. There are various transactions which will require the conversion of domestic currency into international currency or foreign currency for that matter, and various transactions which will require the conversion from the foreign currency or international currency into your domestic currency. And the market which will facilitate these kinds of transactions, the market which will allow for these particular conversions from the domestic currency into foreign currency and foreign currency into domestic currency, that particular market is called as exchange market. To be more precise, it is referred as foreign exchange market. Is okay? And in many of the books, they use a short form of this rather than simply saying foreign exchange. They will replace this with forex. Okay? And hence this is called as a forex market. And this is one very important point. Now, what type of transactions are involving wherein there's a conversion of your rupee into dollars, where you need to convert the domestic currency into a foreign currency or an external currency. For example, imagine you're an importer. Okay? Imagine you're an importer. You have imported goods or services. For having imported these particular goods and services, you'll have to pay a foreign currency. You need to convert the rupees into dollars. Imagine you're going outside for study purposes, or some of you say, sir, our studies are already over. Imagine you're going for tourism purposes then. Okay, somebody might be going for healthcare purposes. Somebody would want to invest in a foreign market, let's say in purchasing the shares in a foreign market, in purchasing certain assets, investment in real estate outside India. So in many of these particular transactions, what you need to do is you need to convert the domestic currency into foreign currency. You need to convert your rupees into, let's say, pounds, rupees into dollars, rupees into any other foreign currency. And on the other hand, there are also various transactions where you have received the foreign currency, you have received the payment, or you have received the amount in foreign currency. You need to convert these particular foreign currencies into the domestic currency. For example, foreign investments in India. Right? For example, within the foreign investments, there is a FPI, foreign portfolio investment, foreign direct investment. There are also other forms of receivables, for example, in remittances. Imagine your friend is working in USA, he will send you certain dollars in the form of a gift. Or your brother is working in, let's say, one more foreign country, he has sent part of his earnings to the household. So there are various ways through which you are going to receive the remittances. But these particular remittances are in the form of a foreign currency. They could be in the form of a dollar. You need to convert these particular dollars into rupees. And then there is exports of goods and services. Is okay, exports of goods and services. Right? For example, in case of exports of goods, you're going to export a lot of these particular merchandise or products which are manufactured in India. And what about the service exports? You can export IT or ITES, you can export tourism services, etc. In all these particular cases, you are going to receive a foreign currency. There is going to be inflow of foreign currency into India. And you need to convert this particular foreign currency into a domestic currency, because in India, we need to use the domestic currency for conducting any kind of a transaction. So the market which will facilitate the transactions wherein one currency is converted into a domestic currency and a domestic currency is converted into a foreign currency, that particular market is called as forex market. And in this particular market, at any given point of time, you need to pay certain units of domestic currencies to purchase, let's say, a unit of a foreign currency. For example, what if I were to say that today, what are the exact exchange rate is, please do not worry about it. What if I say that today for every $1, you're going to receive 80 rupees. This is the basic idea of an exchange rate. Exchange rate essentially means for every unit of a foreign currency, how many units of the domestic currency you need to pay. Or else, it is basically an equation wherein the units of the domestic currency are given in the form or an equivalence of a foreign currency. That is, if you have $1, if you want to convert it into rupees, at this particular exchange rate, you will receive 80 rupees in India. But if you want to receive $1, if you want to earn $1 so that you pay for your exporter, you pay for the one who has sold you the goods, then you need to pay 80 rupees to get this particular $1. Right? This is generally the concept of an exchange rate. And in the market, based on the exchange rate, the domestic currencies are converted into foreign currency and vice versa. Now, some of you simply raise a question, sir, like how do we determine this particular exchange rate? On what basis do we come to a conclusion that, sir, $1 is equal to 80 rupees? And that is the concept of the methodologies or the types of exchange rate mechanisms. In case of exchange rate mechanisms, there are three types. One is called as a fixed exchange rate mechanism. Second one is called as a floating exchange rate mechanism. And the third one is called as a managed exchange rate mechanism. Okay, our third one is basically a mixture of fixed as well as a floating features as such. Now the question is, sir, what do you mean by fixed exchange rate? What do you mean by floating exchange rate? And the third, what do you mean by managed exchange rate? Now in the context of a fixed exchange rate, before I start the discussion, just understand the logic here. In the context of a fixed exchange rate, the two very important terminologies that will come across are one, devaluation, and the second one, revaluation. Is okay. What do you mean by all these terminologies? We will discuss it in detail. Please do not worry. But please understand in the earlier slide, if you have seen this, I've given these particular terminologies. So whenever you come across the term devaluation and revaluation, simply remember it is associated with the fixed exchange rate mechanism. And there are two more terms, right? Namely, the terms depreciation and appreciation. And these particular terminologies of depreciation and appreciation are associated with the concept of a floating exchange rate mechanism. Okay, floating exchange rate mechanism. Now the question is, sir, what do you mean by fixed exchange rate mechanism? And what do you mean by devaluation, revaluation? Let me start with this. In case of a fixed exchange rate mechanism, whenever the exchange rate is determined by the government, is it okay? I'm using the term government. But if government fixes up an authority who will determine the exchange rate under the term determine or fix the exchange rate, then such type of an exchange rate is called as a fixed exchange rate mechanism. I'll repeat it again. whenever there is a government or the central government which will decide the exchange rate, which will notify the exchange rate, and that is the exchange rate which should be used in the market for converting the currencies. Such exchange rate mechanism is called as a fixed exchange rate mechanism. And in the context of fixed exchange rate mechanism, there are two terminologies, devaluation and revaluation. And understand the logic here. In case of exchange rate mechanism, we are comparing the value of one currency against another currency. Is it okay? I'll repeat it again. In case of exchange rate mechanism, we are comparing value of one currency against another currency. That is, if I have let's say 100 rupees, using this figure 100 rupees, how many dollars will I be able to purchase in the market? Or else, if I have let's say $20, using this figure $20, how many rupees will I be able to purchase in the market? So essentially, what we are doing with exchange rate is we are comparing the value of two assets. Currencies are nothing but assets. So we are comparing the value of two assets using which one currency can be converted into another form. Now, in the context of fixed exchange rate mechanism, I stated that the devaluation, revaluation, other terminologies associated with this. Let me start with a simple example here. Imagine today a particular government decides $1 is equal to 50 rupees. Is it okay? Right? Let's assume, right? Here's a government which has decided the exchange rate. As far as today is concerned, the exchange rate will be $1 is equal to 50 rupees, which essentially means what? If you have $1, you can convert that, you can sell that and get how many rupees? 50 rupees. And if you have 50 rupees, you can sell those particular rupees and get how many dollars from the market? You get $1 in the market. Now, what if tomorrow or let's say after 1 month, the same government changes the exchange rate to this, right? Today it is this much. After 1 month, the government says $1 is equal to let's say 60 rupees. What has happened to both of these currencies? If you take this side of the equation, that is the rupees. Today, for every 50 rupees, you will be able to purchase $1 from the market. But after 1 month, what has happened? Rather than paying only 50 rupees, and now you will have to pay 60 rupees to get the same dollar. That is, you're forced to pay more money, more rupees to purchase the same dollar. Can I simply say that the value of a rupee has come down in this particular equation? I'll repeat it. Today, for every $1, you need to pay 50 rupees. After 1 month, what is happening? To get the same dollar, you're forced to pay 60 rupees. So the value of a rupee in terms of purchasing the dollars or other asset in the market has actually come down. Right? So this particular situation where the value of, let's say, the domestic currency, because rupee is the domestic currency, value of one currency comes down against another currency. I'll repeat it. Value of one currency comes down against another currency. That particular currency is said to be devalued if the value is changed by the government. I understand this? It is not the market which is deciding the exchange rate here. It is the government which is changing the exchange rate. Today, the government had decided $1 is equal to 50 rupees. After 1 month, the government has changed this exchange rate to $1 is equal to 60 rupees. As a result of which, the value of a rupee has actually come down against the dollar. You are now paying more rupees to get the same unit of a foreign currency, which essentially means the value of the currency that you're actually holding has come down against another currency. So whenever this particular change happens, whenever the value of one currency comes down against another currency, but that is under the exchange rate, that is a fixed exchange rate. It is happening because the government is making this particular exchange rate or deciding these particular exchange rates. In such situation, we simply use the term devaluation of the currency. Is it okay? Devaluation of the currency. So in this particular example, rupee value has been devalued. Remember this. Rupee has been devalued against a foreign currency. Value of rupee has been reduced. So rupee has been devalued in this particular equation. Now what about the other side of this? What about the other side? Imagine today the exchange rate is $1 is equal to 50 rupees. Okay, this is the exchange rate today. But what if after 1 month the government changes the exchange rate to $1 is equal to 35 rupees? What has happened? Today to get $1, you're supposed to pay 50 rupees in the market. But after 1 month, to get the same dollar, you need to pay only 35 rupees. You are able to get the same unit of a foreign currency, but by paying lesser amount. As a result of this, I can simply say that the purchasing power of the value of a rupee has actually increased compared to foreign currency. As against a foreign currency, value of Indian rupee has been increased. But this increase in the value has happened because the government has changed. The government has fixed the exchange rate. In such situation, we simply use the term revaluation. Is it okay? So understand this. Devaluation, revaluation are associated with the fixed exchange rate mechanism. And under the fixed exchange rate mechanism, there are different types. Again, you don't have to worry about all the classifications. In simple terms, remember this. A fixed exchange rate mechanism is the one wherein the government will decide the exchange rate. Government fixes the exchange rate. Hence, this is called as a fixed exchange rate mechanism. Now, some of you will be thinking, sir, why is government deciding the exchange rate? Whenever you have a fixed exchange rate mechanism, there is certain certainty attached to the exchange rate market. Right? For example, if you are an exporter today, understand the logic here. If you are an exporter today, what if for today's exchange rate is $1 is equal to 50? Is it okay? What if today's exchange rate is $1 is equal to 50? Now, what if I were to say that you do not know what is going to happen to this exchange rate tomorrow or after 1 month? Don't you think you'll be concerned about how much will your export earnings after 1 month? Because today it is $1 is equal to 50. After 1 month, what if it changes to $1 is equal to 30 rupees? Will it have an impact on your export earnings? Definitely yes. Some of you will be thinking, sir, how? I'm able to understand here. Let me take the same example, elaborate. You're exporting, let's say $1 worth of a good in the international market. And generally understand this, whenever you're exporting or importing, the international rate generally, not always generally, is denominated. Is designed in such a way that these are denominated in foreign currencies. Is it okay? Right? So if I'm exporting certain goods to USA, the importer there will always enter into a contract saying that I will pay you in dollars. And if I'm importing something, the exporter there will simply say, okay, if I export this much, you'll have to pay me in dollars. So generally, these kinds of freely convertible currencies in the international market are used in the international trade. And if you ask me, sir, why is not rupee used in such kind of transactions? Generally, in the international market, the practice or the convention is that we tend to use those particular currencies which are freely convertible in the international market. We do not want to accept or pay in terms of the currencies which are very volatile, which are not accepted in the international market. So generally, the argument here is the freely convertible currencies are generally used for conducting international trade. Best example for that is the US dollar itself. So have a look at this. I'm simply saying that you're an exporter. You're exporting $1 worth of a good. You'll receive $1. You will convert that into rupees. So how many rupees you will be earning? 50 rupees. And the same dollar, what if you were to earn after 1 month and the exchange rate has moved like this? Your earnings will be affected. So rather than being worried or concerned about what kind of a movement is going to happen in terms of exchange rates, there is certain comfort that is provided to the exporters as well as importers whenever you follow a fixed exchange rate mechanism. There is no uncertainty in the market. The exporter knows what is the exchange rate after 1 month. The importer knows what is the exchange rate after 1 month. It will provide certain comfort to the market because there is no uncertainty. That is generally the reason why many of the countries earlier actually follow the concept of a fixed exchange rate mechanism. Now the question is, sir, did India follow fixed exchange rate mechanism? Yes. Right? Initially, just after independence, we actually followed the concept of a pegged exchange rate mechanism, which is a type of a fixed exchange rate mechanism itself, wherein our currency was actually pegged. Our currency was actually linked to the British pound as such. So to begin with, generally we followed the concept of a gold standard. I'll come to that. But the intermediate currency, the currency using which the exchange was done in case of India was actually the pound. Later, post 1970s, when the Bretton Woods system actually collapsed, rather than following a pegged exchange rate mechanism where we actually pegged our exchange rate, we actually shifted to a concept of a basket determined exchange rate or basket based or basket of currency based exchange rate, wherein RBI basically chose a certain basket of currencies, and against this basket of currencies, the exchange rate was actually determined. But post 1990, because of the implementation of LPG reforms, liberalization, privatization, and globalization reform, we have discontinued even this concept of exchange rate. And today, in case of India, generally the government says we follow floating exchange rate mechanism, but to be more precise, it is actually a managed float exchange rate mechanism. Now, what do you mean by floating exchange rate and managed float exchange rate? We will try to understand this. So this is a discussion with respect to fixed exchange rate mechanism. What about the other side? Floating exchange rate mechanism. In case of the floating exchange rate mechanism, please understand this. The exchange rate in the market is determined by the market forces. Is it okay? The exchange rate in the market is determined by market forces. Now, some of you simply say, sir, what do mean by market forces here? Market forces essentially are referring to the supply and the demand forces for these particular currencies. Is it okay? These are referring to the supply as well as the demand forces for these particular market, or let's say the currencies in the market. Now, what do you mean by this? Let me start with an explanation here. To understand this, just understand certain very important basic points. First, is it okay if I say that the currencies are nothing but assets? Is it okay? Currencies are nothing but type of assets only, right? A dollar, rupee, pound, yen, yuan, etc. All of these are nothing but assets, type of assets. First one. Second, important point. Whenever supply of anything increases in the market, understand the logic here. Whenever supply increases, what do you think will happen to value? Okay, whenever supply of anything increases in the market, what will happen to value of this particular product, or let's say asset in the market? The value should come down. Is the logic okay here? And whenever supply of any asset reduces, what do you think will happen to value? Value will increase. Is it okay? I'll repeat it again. Whenever supply of anything increases in the market, value comes down, and when supply reduces, the value should increase. That's the second very important. Third very important point, because many of these particular economies are open economies, there are various forces in the market, there are various transactions in the market at various points of time, which will either require conversion of the domestic currency into foreign currency and conversion of foreign currency into domestic currency. Is it okay? I'll repeat it again. Because many of these particular countries, such as India, they are following a concept of an open economy. There will be a need to convert your foreign currency into domestic currency and vice versa. And whenever I'm saying that there's a need to convert your domestic currency into foreign currency, what do you mean by this? Let's take a very simple example here. Imagine you need $1. Now, if you ask me, sir, why should I need $1? Right? Let me elaborate or let me extrapolate the example here. Imagine you are an importer. Okay, imagine you are an importer. You have imported a particular commodity, or let's say a product, and the value of this that you're supposed to pay to the exporter is $1. So you will require $1. Now, what will happen? If you need $1, you will go to forex market. You will sell rupees. Is it okay? You will sell rupees and you will buy dollars. Is the logic okay here? I'll repeat it so that you understand it much more clearly. Imagine you're importing this particular pen, and the value of this particular pen hypothetically is $1. So if you imported this particular pen, you will have to pay dollar to the exporter. What do you need to do? You need to convert your rupees. You need to sell rupees in the forex market, and you need to purchase dollars from the forex market. So you will sell rupees. Can I simply say that when you sell rupees, the supply of a rupee will increase? I'll repeat it. When you will sell rupees means what? You are supplying rupees in the domestic market, or let's say forex market. Supply of rupee increases, and instead of rupees, now you will take a dollar from the forex market. And can I simply say that because you are buying a dollar, the demand for the dollar is increasing. I'll repeat it. You will sell rupees, supply of rupee is increasing, and you will purchase a dollar, demand for the dollar is increasing. Essentially, because of this particular transaction, only one transaction I'm looking at. What has happened? Supply of rupee increases, and demand for dollar increases. So whenever supply of any commodity increases, what should happen to value of the commodity? I'll repeat it. Whenever supply of any commodity increases, what will happen to value of this particular commodity? The value of this particular commodity should come down. And whenever you're going to buy a particular commodity, let's say an asset, and the demand for this particular asset increases, what will happen to value of this particular asset? The value of this asset should increase. So in this particular transaction, right, in this particular example that I've taken here, because I'm selling rupees, supply of rupees is going to increase, and the value of rupees is going to come down. And because I'm going to purchase a dollar, demand for dollar increases, value of a dollar increases. Now, this particular concept of increasing the value, decreasing the value of the currency is basically represented in the form of appreciation and depreciation. Is it okay? Appreciation and depreciation. That is, simply remember this, in case of a currency whose value will come down against another currency, that particular currency is undergoing depreciation. I'll repeat it. Whenever value of one currency goes down against another currency, that is called as depreciation. In this particular example that I've taken just now, value of rupee is going down. Is it okay? Value of rupee is going down. And when the value of rupee goes down against a dollar, can I simply say that rupee is depreciating? And on the other hand, whenever value of one currency goes up against another currency, that is called as appreciation. Is it okay? Value of one currency goes up against another currency, it is called as appreciation. And in the previous example, what has happened? Right, the value of a dollar has started going up, has started rising up against rupee. So I can simply say in the previous example, rupee has depreciated, dollar has appreciated. But please understand the difference here. In case of fixed exchange rate mechanism, the value of currency either goes up or comes down because the government is fixing the exchange rate. Government is changing these particular exchange rates. Whereas in this particular example of floating exchange rate mechanism, it is not the government, rather supply and demand for these two currencies in the market are determining the exchange rates. Is it okay? Right, now you simply say, sir, will always we see that rupees are depreciating? Not necessarily. Not necessarily. Please understand this. In the example that I've taken, I've assumed that only one transaction is happening in the market where rupee supply increases. Can the vice versa also take place? Definitely. Why not? Let's take another example here. I'll write here example 2. In case of example 2, what happens? Imagine only one transaction is happening in the forex market wherein you are the exporter. Again, you're importer. Now imagine you're an exporter, and when you export a particular good, let's assume the same pen here. You have exported this particular pen to the international market, let's say to USA, and the importer in USA will pay you $1. Is it okay? He will pay you $1. Can you use the dollar in the domestic market? No, it is not allowed. So what do? You go to the forex market. You will sell the dollar and purchase or buy rupees. You're going to convert this particular dollar into rupees. You will pay the dollar. You will purchase the rupees from the forex market. Apply the same logic now. Whenever you sell a commodity or let's say an asset in the market, what will happen to supply of this? Supply increases. And whenever an asset supply increases in the market, what will happen to value of this asset? Value should come down. On the other hand, you're buying rupees, so you are demanding more and more of rupees. And whenever the demand of a particular asset increases, what will happen to value of that asset? Value will also increase. So in this particular example, what is happening to dollar? Dollar is depreciating, and what is happening to rupee? Rupee is appreciating. Is it okay? So understand this. Based on the supply and demand for these particular currencies, domestic as well as international currencies or foreign currencies in the forex market, rupee will either appreciate or rupee will either depreciate. But strictly speaking, understand the logic here. India, although we say that we are following a floating exchange rate mechanism, it is not completely a floating exchange rate mechanism. There is a third type of exchange rate mechanism which is referred to as managed floating exchange rate. Is it okay? Managed floating exchange rate. Now, what do you mean by managed floating exchange rate? In case of a floating exchange rate, only the market forces of supply as well as the demand should determine the exchange rate. Is the logic okay here? Only the supply and demand for the foreign currencies as well as the domestic currencies should determine the exchange rate. But in case of managed floating exchange rate, in addition to the market forces are as usual present here. Okay. In addition to the market forces of supply and demand for these particular currencies, there is also a role of the government. And instead of using the government, they'll simply use a role of the central banker. Because in case of India, the role of managing the exchange rate. Again, please be very careful. I'm not using the term fixing the exchange rate here or determining the exchange rate. I'm simply using the term managing or stabilizing the exchange rate has been given to RBI, which is the central banker of India. Is it okay? Now, question is, so how does RBI stabilize or manage the exchange rate? Now, earlier we have seen that whenever you say floating exchange rate mechanism, there is a demand for the domestic currency or demand for the foreign currency, which will determine the exchange rate. But there are certain situations where an uncontrolled appreciation will not be good for Indian economy, and uncontrolled depreciation will also be not good for the Indian economy. Because whenever you allow only the market forces to determine the exchange rate, there could be a sudden inflow of dollars in the domestic market. Is okay? Sudden inflow of dollars can happen in the domestic market, and if these particular dollars are coming into India, you need to convert the dollars into rupees. Is okay? Dollars cannot be spent in India, right? Either because of exports that you have done, right? Service exports, merchandise exports, or foreign investments are coming into India, remittances are coming into India. For various reasons, the dollars can flow into India. But the argument here is, if there is uncontrolled inflow of these particular dollars into the domestic market, what might happen is the supply for dollars will increase, demand for rupees will increase. So dollar will depreciate, rupees will appreciate. As a result of which, there is certain impact that is going to be felt. Right? And in essence, what is actually happening here with this particular dollar inflow into India, rupee will appreciate and dollar will depreciate. Is it okay? And whenever rupee is going to appreciate uncontrolled manner, okay, in an uncontrolled way, there is definitely going to be certain impact on the Indian economy. Now you simply ask, what kind of impact are you talking of here? For this, let me do a very simple table. Understand the table very carefully. Right? What I'm going to do is, on one side, I will write appreciation and depreciation. Okay, AP stands for appreciation, DP stands for depreciation. And on the other hand, I will write what will happen to imports, what will happen to exports. Okay, what will happen to imports and what will happen to exports. Now let's start here. In case of appreciation, I can write an example of appreciation here. $1 is equal to, let's say, 50 rupees, and $1 is equal to 40 rupees. So whenever you're paying lesser amount of rupees to purchase the same foreign currency, we'll simply say rupee has appreciated. And on the other hand, I'll write an example of depreciation also. $1 is equal to 50 rupees, and then $1 is equal to 6 rupees. Let's start now. Whenever rupee appreciates, what will happen to imports? What will happen to exports? Whenever rupee appreciates, right, what will happen to imports? Let's start. Imagine you're importing $1 worth of a good. Okay, could be anything. Don't worry about it. Imagine you're importing $1 worth of a good into India. And last month, imagine this was the exchange rate. So last month when you imported $1, you paid how many rupees for that? You paid 50 rupees, right, to purchase a dollar and pay for your import. But today, for the same dollar, rupee has appreciated. As a result of which, you need to pay only 40 rupees. Which means what? You are able to import this particular pen at the same price of $1, but to get $1 today, you are supposed to pay only 40 rupees. Can I simply say, as a result of that, the imports will become cheaper? Is the logic okay? Last month you paid 50 rupees to get $1. The pen will cost $1. You need to pay $1 in essence. Last month you paid 50 rupees, got $1, paid to the exporter. Today, for same dollar, you need to pay 40 rupees. You get the dollar, you will pay, and you will receive the pen. So what has happened to the imports? Imports will become cheaper. Is it okay? Imports will become cheaper. Right? That is one very important outcome. Second, what will happen to the exports? If there's rupee appreciation, what will happen to the exports? After the same logic. $1 equal to 50, $1 equal to 40. Last month, you're an exporter, you're exporting this particular pen, you will receive $1, you will get converted that into rupees. How many rupees will you get? You get 50 rupees. Today, you're exporting the same pen, you're receiving $1, you will convert that into rupees. How much rupees will you get? You'll get 40 rupees. So the earnings of the exporters, I understand this, earnings of the exporters will be affected. Earnings will come down. Done? So this is the impact of rupee appreciation, let's say against the dollar, in terms of impact on imports and exports. What about the rupee depreciation? What will happen because of that? Let's start. Rupee depreciates. I've taken an example here. As a result of this, what will happen to the imports? Last month you imported this particular pen. Let's start the circus again. Last month you imported this particular pen. To get $1, you need to pay how much rupees? 50 rupees. So you would be paying 50 rupees to get this particular pen into India. Today, you're importing the same pen, price is same $1, but the exchange rate has changed. Rupee value has gone down. To get the same dollar that you need to pay to the exporter, now you should spend, you should have to pay 60 rupees for it. So as a result of this, earlier you had spent 50, now you're spending 60. You are paying more to get the same dollar worth of input or import into India. What will happen to imports? Imports will become costlier. Is it okay? Imports will become costlier. And the last one, in this particular 2x2 matrix, what will happen to exports? What is going to happen to exports? Imagine you're exporting this particular pen. Last month you exported, you receive $1 and you got it converted into rupees, you will receive how much? 50. Today, there is rupee depreciation. So I will get this for every $1, you're going to earn how much? 60 rupees. So rather than this, understand this, rather than this, what generally happens in the market is, you would want to earn 50 rupees because the cost of the pen is 50. So what do you do? Rather than pricing your exports at $1, let's say hypothetically, you will price your exports at $0.9. Is it okay? Because you know rupee has depreciated, you will not be earning less than 50 rupees. So what do you do? You will reduce the cost of your export from $1 to $0.9. Now some of you say, sir, you're going to earn lesser here. No, I'm not going to incur loss here. Why? Rupee has depreciated now. As a result of depreciation, what will happen? Even if you sell it at $0.9, your earnings are going to be 54 rupees here. Is it okay? Your earnings are going to be 54 rupees. So what will happen? You will reduce the value of your exports. You will price your exports at a much lower level. As a result of this, exports will become much more competitive in the international market. Is it okay? Exports will become much more competitive in the international market because of the dollar appreciation and rupee depreciation. More importantly, rupee depreciation. Done? So whenever rupee depreciates, we expect our exports to become much more competitive. Okay, we expect our exports to increase in the international market. But in reality, please understand, apart from the exchange rate, there are other factors also which will determine whether our exports are going to increase or not. Theoretically, yes. Necessarily, if everything else remains the same, nothing else changes in the market, our exports should increase with rupee depreciation. But in reality, there are other factors such as inflation rate, the tariffs as well as non-tariff measures imposed. What about the exchange rate of other currencies, etc. There are so many other factors which will determine ultimately whether our exports are going to increase or not whenever there is a rupee depreciation. Done? So these are the outcomes that you can expect whenever there is rupee appreciation or rupee depreciation against a foreign currency on import and export. Now talk about import and export. You can extrapolate the discussion even to, let's say, investments into India. Right? What will happen to the foreign investors in India if rupee appreciates or rupee depreciates? What about the rupee investments or, let's say, domestic investors who have invested in the foreign economy? What about the borrowings that have been done? To what extent rupee appreciation depreciation will have an impact? So that is the reason generally what we say is, in case of a floating exchange rate mechanism, the market forces will determine the exchange rate, but you cannot allow the rupee to continuously appreciate as well as depreciate without any control on this. Because whenever there is an uncontrolled appreciation of rupee, imagine there is a continuous appreciation of the rupee. What will happen because of this? Right? Our earnings in case of exports are going to come down and our imports are going to become much more cheaper. Now some of you simply say, sir, it is good. No, not necessarily. Already India is a net importing country. Is it okay? India is a net importer. What do you mean by net importer? You are exporting as well as you are importing. I understand this. In case of merchandise, you are exporting as well as you are importing. Whenever the value of the imports is higher than the value of exports, I'll repeat it. Whenever the value of imports is higher than the value of exports, you are a net importer. Okay, India is a net importing country, net importing economy. And in this particular situation, if your rupee appreciates, if your domestic currency appreciates against a foreign currency, what will happen to the imports? Imports become much more cheaper. Can I simply say that imports into India will continuously start flowing? Because imagine this particular pen manufactured in foreign market, manufactured in India, but because of rupee appreciation, this particular pen when imported from the foreign market will become much more cheaper in India. So don't you think Indian domestic consumers or the consumers such as you and me will prefer to purchase an imported pen because it is cheaper compared to a pen which is manufactured in the domestic market? So whenever rupee appreciates without any control, uncontrolled appreciation, this will definitely have an impact on the imports as well as exports. You do not want that to happen. Is it okay? And on the other hand, if there is a continuous depreciation that is going to take place, again there are certain outcomes which are not necessarily good for the Indian economy. For example, right, have a look at this. Right, what will happen to imports? Imports are For example, fuel, petrol, diesel, raw material, intermediate goods, etc. All of them are going to become costlier. What about the finished goods which are imported into India? They will also become very, very costlier. Don't you think that will again have an impact on the Indian economy? So that is the reason. Uncontrolled appreciation, not good. Uncontrolled depreciation, also not good. Hence, what we have in case of India was 1994. Initially started in 1993, but established in 1994. We have introduced the concept of a managed floating or a concept of a floating exchange rate mechanism, where RBI plays a very, very important role in the forex market and tries to stabilize. Underline the term stabilize here. Do not use the term RBI fixes the exchange rate. If you use the term RBI fixes the exchange rate, that will be wrong, because no, we do not follow fixed exchange rate mechanism. Rather, we are following a concept of a floating exchange rate mechanism. Earlier, I used the term gold standard. Gold standard is a type of a fixed exchange rate mechanism where generally value of one currency was determined in the form of gold itself. Is okay? Value of one currency was always given in the form of gold. How much grams of the gold? And generally, when you have multiple currencies being given in the form of terms or in terms of the gold weightage as such, you can simply convert one currency into another currency without having to go through gold. Generally, in concept of a gold standard, what it essentially means is, imagine for one currency, let's say hypothetically 1 rupee is equal to 0.5 grams of gold. Is it okay? Again, this hypothetical situation. Today, 1 rupee will not get you 0.5 grams of gold. No way. But essentially, let's take a hypothetical situation here. This is an example of a gold standard. It simply means that for every 1 rupee, you can get 0.5 grams of the gold in the market. Right? RBI or the central bank will stock gold, using which you can basically convert or exchange the domestic currencies. Now, how the gold standard was used to convert one currency to another currency. Let's take another example here. On one side, you have 1 rupee is equal to 0.5 grams of the gold. What if I were to say that $1 is equal to, let's say, 1 gram of gold? Is it okay? $1 is equal to 1 gram of gold. Now, can I convert 1 gram of gold into 0.5 grams? Yes. Right? That essentially will mean $0.5 is equal to 0.5 grams of the gold. And this will be the conversion rate. That is 1 rupee is equal to $0.5 or half a dollar. Again, this hypothetical situation. Today, the exchange rate is much, much different. But idea here was, wherever countries follow the concept of a gold standard, which we did earlier, the gold was an intermediate. Gold was a mediator to convert one currency to another currency. And that is the precise reason the central bankers around the world were forced to stock a huge amount of gold, because that was used as a means to represent these particular currencies. Over a period of time, because the need for storing the gold became very, very high, we have discontinued the concept of a gold standard. Rather than that, today we are basically following a concept of the fiat money. We have displaced the concept of a gold standard with the concept of a fiat money, and using this particular fiat money, we are basically comparing the currencies of different countries. Today you have comparison between the rupee to dollar, rupee to pound, pound to dollar, etc. These kinds of conversions are actually used in the form of exchange rate today.
Now, one more question that you will be having is, sir, you are again and again saying that RBI will be
following, or RBI is basically involved in the concept of a managed floating exchange rate, and RBI plays a very, very important role in stabilizing this particular exchange rate. But how does RBI stabilize this particular exchange rate? We want to understand that. Very valid. Let me give you one example. Imagine a situation wherein there is a huge outflow of the foreign currencies from India. Okay, there could be multiple reasons. You don't have to worry about it. Imagine a situation wherein dollars are flowing out of India without any control, or there is huge outflow of the dollars which is taking place. As a result of this, what will happen? Whenever you have an outflow of a dollar, you are basically seeing this kind of an exchange in the forex market. You need dollars to take out of India. You have invested rupees, let's say in India. I'm taking one example here. Let's say investments by foreign investors. Okay, foreign investors have invested in the Indian stock market. So they want to take out their investments out of India. Let's say take it to USA, take it to European market, wherever they want to take it. So what they do? They will sell the shares, they will sell the debt instruments, etc. Collect rupees, go to the forex market, sell rupees and buy dollars. Is okay? Sell rupees and buy dollars, and take these particular dollars out of India. As a result of this, what is actually happening here? Rupee is being sold, supply of rupee increases, rupee will depreciate. Is okay? Rupee will depreciate. And on the other hand, dollar is being purchased, demand for dollar increases, dollar will appreciate. But more importantly, have a look at this. There is uncontrolled depreciation of a rupee that is taking place. Do you want this to continue? No. In this particular situation, what does RBI do? RBI is basically maintaining forex reserves. I remember this. RBI maintains or is in charge of forex reserves. What are the components of forex reserves? Most important component of forex reserves is basket of foreign currency assets. Basket of foreign currency assets. That is, there are currencies such as dollar, yuan, pound, etc. So there is a basket of foreign currency assets which is there with RBI. In addition to this basket of foreign currency assets, what else is there in the forex reserves? You have gold reserves. Is it okay? You have gold reserves. You have special drawing rights, and the fourth one is reserve position. Reserve position of India and IMF. Okay. Together all of these four components, you will have forex reserves. So here is RBI, right, which is holding huge amount of forex reserves. And on the other hand, in the market, what is happening? There is a continuous selling of rupees and buying of dollars. As a result of which, rupee is continuously depreciating against the dollar. So understand this, in market, rupee is being sold, dollar is being purchased. So demand for dollar high, supply for rupee high. What does RBI do at this particular situation? Exactly opposite to what is happening in the market. What is happening in the market? In market, rupees is being sold and dollar is being purchased. Is okay or bought. What does RBI do? RBI is having huge amount of foreign currency assets. RBI basically will start selling, will start supplying the dollars in the market and starts purchasing rupees from the market. I will repeat it again. Understand this? In the market, rupee supply is continuously increasing. Dollar buying is continuously increasing. As a result of which, rupee is getting depreciated, dollar is getting appreciated. You do not want to leave it uncontrolled, because it will definitely have an impact on the Indian economy. So what RBI does is, RBI is having huge amount of forex reserves. RBI will start selling the dollars in the market, starts purchasing rupees from the market. Exactly opposite to what is happening in the market. So when RBI does this, what will happen? The demand for rupee will start increasing, supply for dollar will start increasing. So rather than having uncontrolled depreciation of the rupees now, there is a pullback, or there is a force that is being used by RBI to pull back the value of the rupee to stabilization. The RBI will use the forex reserves that it has to stabilize the exchange rate in the market. And that is the role of RBI here. That is the role of RBI. RBI doesn't fix the exchange rate. RBI simply stabilizes the exchange rate. Okay, RBI simply stabilizes the exchange rate. Remember this. So whenever there is a requirement, RBI sells dollars, purchases rupees, and whenever there is a requirement, it does exactly opposite to that, to stabilize the rupee value in the exchange market or the forex market as such. And that is the precise reason in the context of India we use the term managed floating exchange rate. And one more term that is generally used by IMF with respect to this is a dirty float. Remember the term dirty float. Okay. So in case of India, RBI intervenes in the market. RBI basically tries to stabilize the exchange rate in the market. Right. So that is the reason we refer to this as a managed floating, but government generally says we follow floating exchange rate mechanism. So these are the three methodologies which are used to determine the exchange rate in the market, and the terminology is associated with this. Okay. The devaluation, revaluation is associated with the fixed exchange rate mechanism. The appreciation and depreciation is associated with the managed floating or floating exchange rate mechanism. And in case of India, the terminology is that we generally use is the term depreciation as well as appreciation. And understand this. In the context of countries such as China, generally there is an allegation that the country devalues its currency. Now there is a logical reason why does China go for devaluation of its currency or tries to devalue the domestic currency. That is for a simple reason. Understand this. Earlier we have discussed what is the impact of a depreciation. Okay, what is the impact of a depreciation on imports as well as exports? And understand the logic here. Whether you use the term depreciation or devaluation, the force is same or the outcome is same. But that is the value of one currency goes down against another currency. The only difference between depreciation and devaluation is in depreciation it is because of the market forces, whereas in case of a devaluation it is because of the government. Is it okay? Because government intervenes, tries to change the exchange rate, as a result of which value of the domestic currency goes down or goes up. That will either lead to devaluation or revaluation respectively. Has government ever gone for devaluation or revaluation of domestic currency? Yes, there are instances. But post 1994, because we are basically following a concept of a floating exchange rate mechanism, no, we have not gone for devaluation or revaluation. Before that, yes, we have gone for a devaluation multiple points of time. Okay, especially post 1991, we have gone for two-step downward devaluation of the rupee against the foreign currency itself. But in the context of a depreciation or devaluation, the outcome is same. The effect is same of a domestic currency losing value against a foreign currency. So the impact on imports and exports will also be same when you talk of devaluation. Now, in the context of China, many of the times there is an allegation by developed economies such as USA that Chinese government is actually devaluing its currency. There is an allegation that the Chinese government or Chinese yuan is getting devalued. And why do they go for devaluation? Simple logic is whenever you go for devaluation or there is a depreciation in the economy, what will happen to imports? Imports will become costlier. Is it okay? Just go back to the discussion earlier that we had. Imports will become costlier. And whenever you go for devaluation or there is a depreciation in the market, what is the impact of that on exports? Exports will become much more competitive. Is it okay? Now, China is a net exporter. I understand this. China is a net exporter. And when you are a net exporter, if there is a devaluation or depreciation in your domestic currency, your exports competitiveness will increase, which is as per your strength. Your strength is in exports. And if your exports competitiveness increases, that is adding to your strength. Your exports are going to further increase in the international market. But what is going to happen on the other side? Your imports are going to become costlier. And China, please understand, it is a net exporter. It is more dependent on the revenue from exports and not much dependent on the imports. They want to curtail the imports, let's say from USA. In such a situation, if Chinese government goes for devaluation, its exports to, let's say, USA will increase, and on the other hand, US's exports to China, which will become costlier, will become lower and lower. The imports into China will become lower. And so it's a win-win situation for China whenever they go for devaluation like this. And that is the precise reason. Whenever a country goes for devaluation like this, the other countries or trading partners can approach International Monetary Fund (IMF), which is the authority in terms of investigating these particular occurrences of a devaluation done by the domestic countries or domestic governments, and file a complaint against the respective country at IMF, which is going to investigate this particular occurrence. And so these are some of the very, very important points with respect to appreciation, depreciation, revaluation, devaluation, fixed exchange rate mechanism, floating exchange rate mechanism, dirty float, managed float. And what is the role of RBI in all of this? Now, in some of your minds, I'm pretty sure either this question that popped up or now it is going to pop up. Sir, what will happen if $1 is equal to 1 rupee? I get asked this particular question in every class. Right? In every class, whichever batch I teach, I get asked this particular question. So what will happen if $1 is equal to 1 rupee? Don't break your head. Imagine currently the exchange rate is $1 is equal to 80 rupees. Is it okay? Imagine the current exchange rate is $1 is equal to 80. What are the exact exchange rate? This will not be the one I know that. It could be $1 is equal to 77 rupees, $1 is equal to 69 rupees, $1 is equal to 50 rupees, 24 paisa. It could be anything. But when you say $1 is equal to 1 rupee, what essentially you have done is you have basically appreciated the value of rupee. I can understand this. There is an appreciation in the value of rupee. I can understand. Because earlier, or let's say today, $1 is equal to 80 rupees essentially means what? To purchase this particular dollar, you're supposed to pay 80 rupees. But when you boil it down, when you bring it down to $1 is equal to 1 rupee, what does it mean? You're paying 1 rupee to purchase $1. So the value of your currency has actually increased. So what will happen if there is $1 is equal to 1 rupee? Essentially means what will happen if there is rupee appreciation? I can understand this. What will happen if there is a rupee appreciation? That is a simple answer. Now what will happen if there is a rupee appreciation? First point, can I simply say that imports will become cheaper? Is it okay? Imports will become much more cheaper. Why? Imagine earlier, this particular pen you imported, exchange rate was $1 is equal to 80 rupees. Essentially means you paid 80 rupees for this particular pen. Now it is $1 is equal to 1 rupee. You need to pay only 1 rupee to get this particular pen into India. Or you have paid 1 rupee to import this particular pen into India. So don't you think imports will become cheaper? So if $1 is equal to 1 rupee, good news, petrol and diesel is going to become much more cheaper. Assuming the central government and state government will reduce their taxes on petrol and diesel. But essentially, imports will become cheaper. First thing. Second very important thing. Generally, we are able to attract investments in India. Understand this. We are able to attract investments in India. We attract a lot of investments into India in the form of a foreign direct investment. Now if you ask me, sir, what do you mean by foreign direct investment? In the later modules, we'll discuss the idea of FDI in detail. But as of now, simply understand this. FDI refers to investment done by foreign companies in India, in development of infrastructure, in services sector, etc. Right? For example, a foreign company will come into India, set up a manufacturing facility. A foreign company will come into India, set up a service sector enterprise. These kinds of investments are referred to as foreign direct investment. And one of the reasons why we are able to attract this investments into India is the cost of labor in case of India is much cheaper compared to international market. That is, let's say hypothetically, in case of India, you need to pay 50 rupees in the form of a salary. Then a foreign company will pay up, let's say $1, assuming the exchange rate is $1 equal to 50 rupees, to get 1 unit of labor. I'm just taking a hypothetical example here. But the same unit of labor in case of USA will cost the company much higher. So because of this particular exchange rate, this works in favor of a foreign company because the cost of the labor, cost of let's say raw material, cost of other inputs, etc. will become cheaper for these particular companies compared to investing let's say in USA. But if $1 becomes 1 rupee or the exchange rate changes to $1 is equal to 1 rupee, then in such a situation, this advantage that India was enjoying will be lost. Because when they invest $1 in USA and the conversion rate of the let's say exchange rate is $1 is equal to 1 rupee, then there is no difference. They are spending the same amount even in case of India. So the advantage that India would have enjoyed, that would be lost. Is okay? The advantage would be lost. The investments would be affected. And the fourth one, our exports will become very costlier. In international market, our exports are going to become very, very costlier. So these are some of the outcomes that we can expect if $1 becomes 1 rupee or the exchange rate appreciates to 1 rupee equal to $1.
Now, having looked at all of these issues or concepts, let's look at another very important idea here. That is, what are the factors? Okay, what are the important factors which will be influencing the exchange rate? I have listed certain very, very important factors here. One, terms of trade, current account deficit, inflation, interest rate, public debt, political stability, and economic performance. In addition to this, are there any other factors? Yes, because I've written interest rate here. We can simply say monetary policy of a particular country will have an impact on this. Income
in a particular country will also have an impact on this. How will we connect it? Do not worry. Third one, speculation in a particular economy with respect to exchange rates will also fuel the change in the exchange rates. Now, what do you mean by all of these particular factors? How these factors are going to have an impact on the exchange rate? Let's start the discussion. First one, the concept of terms of trade. Terms of trade basically is a ratio. Okay, it's a ratio of value of exports divided by value of imports. Or else, in simple terms, it's a ratio comparing the value of exports to imports. Now, what's the importance of this? Imagine there's a particular country, XYZ. In this particular country, if the value of exports done by the country are very, very high compared to the value of imports, which means what? For every unit of imports that you have done, what is the value of exports that you also have done? So when this particular comparison is made, it basically will give an idea of whether overall, because of imports and exports, is the money flowing into this particular country or flowing out of this particular country. That is, if the terms of trade are in favor of a particular country, it essentially means what? The value of exports are increasing at a much faster pace, or they are higher than the value of imports. And whenever you are going to export, you are going to earn dollars. When you are going to import, you are going to pay dollars. So if the terms of trade are in favor of a particular country, it essentially means there is an inflow of the currencies in a particular country. And if there is a net inflow of the currencies, let's say net inflow of dollars into XYZ, then can I simply say that the dollars need to be converted into rupees, and because you need to convert dollars into rupees, you will sell the dollars, you will purchase rupees. So will it have an impact on the exchange rate? Yes, that's the first very important factor. Second very important one, current account deficit. Now, as of now, we have not got balance of payments, which we will cover next. But essentially, how CAD, current account deficit, will have an influence over the exchange rates. Current account is a type of account within the balance of payments. Is it okay? I'll repeat it. Current account is a type of account within the balance of payments. First point. Second very important point. In case of the current account, there is an inflow of the foreign currencies or outflow of the currencies because of either remittances, because of the inflow or outflow of goods and services. These are certain very important points with respect to current account. And generally, when you talk about the current account in a balance of payments, it refers to those particular transactions which deal with income of a particular country. Is it okay? It deals with income statement or income account of a particular country. How much is the earnings because of, let's say, exports, imports, or production, etc. Now, the argument here is, when we are talking about the current account, I stated that there is an inflow of the foreign currencies as well as outflow of the foreign currencies. Now, whenever the value of outflow of the currencies, let's take a very simple example here. Imagine India has exported $20 worth of exports and has imported $50 worth of imports. As a result of this, what is happening? Because the value of imports is much higher, it simply means on net basis, when I'm comparing imports as well as exports on net basis, the difference, that is $30, is flowing out of India. That is a net outflow of dollars. And because in a current account, the expenditure side is higher than the revenue side or the income side, this situation is referred to as a current account deficit. And whenever there's a current account deficit, can I simply say that in the Indian market, or let's say in the India's forex market, the rupees are being sold, dollars are being purchased because there is a net outflow of $30. You need to pay this $30. So whenever there is a net outflow like this, that will definitely have an impact on the exchange rate. Second factor. Third factor, inflation. How does inflation have an impact on the exchange rate? Understand this very, very carefully. Let's take a simple example. Imagine there are two countries, country A and country B. In both the countries, a similar product is being manufactured. Let's say this particular pen. This pen is manufactured in country A as well as country B. Now, what if I were to say that cost of this particular pen is, let's say, $100 in country A and $95 in country B? So in a sense, cost of manufacturing or producing this particular pen is lower in country B compared to country A. Is there an export potential of the product here? Can the manufacturer from country B produce at $95 and start exporting it to country A? Definitely yes. Why? Because the cost of production is much lower. But to this particular explanation, add the factor of inflation. What if I were to say that because of the inflation in these two economies, cost of this particular pen increases from $100 to $101 in country A and from $95 to, let's say, $103 in country B. Because of higher inflation rate, will it increase in country B? Definitely yes. And because the inflation rate is very, very high, let's say cost of capital is very high, cost of raw material is very high, cost of, let's say, transportation is very high. Because of the inflation rate, the cost would also increase by a much higher margin in country B. So what I'm trying to say here is, inflation in country A is comparatively lower. Is okay? It is much, much lower compared to the inflation rate, which is sustained, which is much higher, which is occurring continuously in country B. As a result of this, what has happened? Now, at $101 and $103, do you think exports will flow from country B to country A? No, exports will not be taking place. So always remember this, any country which experiences a higher inflation rate, the exports will be affected. I understand this? Any country which experiences a higher inflation rate, the exports will be affected. Remember this particular statement, right? And when the exports are affected, do you think it will have an impact or not on the exchange rate? Definitely yes. Now here itself, I just want to discuss one more concept. Majority of the students will get confused here. Why? On one hand, we will be using a statement which I'll say that with higher inflation rate, exports will be affected. Then any country which experiences a higher inflation rate, exports are going to come down. First statement. Second statement, any country wherein there is a depreciation of a rupee. Is it okay? Any country wherein there is a depreciation of a rupee or like a depreciation of the domestic currency, the exports will increase or the export competitiveness will increase. Second statement. Third statement, generally it has been seen that any country with higher inflation rate, the domestic currency of that country will experience a depreciation. I'll repeat the statements. Understand this very carefully. First statement, any country with high inflation rate, exports are going to be affected, exports are going to come down. Second statement, any country whose domestic currency experiences a depreciation, its exports will increase. And third statement, generally any country which experiences an inflation rate, its domestic currency is found to be depreciating. Now some of you simply say, sir, all the statements are not making sense. There is a certain contravention between these particular statements. Because on one side you're simply saying, with higher depreciation, exports must increase. And second statement you're saying, with higher inflation, there is a depreciation of the domestic currency. And third you're simply saying, higher inflation rate will reduce your export competitiveness or will reduce your exports. These three statements are opposing to each other. They're not making sense. The reason for this is simply understand this. Whenever you talk about exports as a function of a depreciation, is it okay? Whenever you talk of exports as a function of a depreciation, that is, if I'm considering only exports and depreciation, yes, the statement makes sense to say that with the depreciation, export competitiveness will increase. Understand this? With the depreciation, export competitiveness will increase. That is, when the value of the domestic currency comes down, your exports should increase. It makes sense. But please understand this. Whenever I add inflation to this particular mix, the statement will not be holding true. Or else in simple terms, I can write it like this. Your exports are a function, are directly related to the depreciation and indirectly are negatively related to the inflation rate in a particular country. Is it okay? Now generally what happens is, whenever a country experiences a very high rate of inflation, what are you would have had because there's a depreciation in the domestic currency. That advantage will be wiped off because of inflation rate. I'll repeat it. Yes, it is true that with depreciation of the domestic currency, exports must increase. But in reality, what happens is, along with the depreciation of the domestic currency, what if there's a huge inflation rate in that particular country? That increasing inflation rate, which increases the price of the product, will basically wipe out whatever advantage you would have earned because of a depreciation of the domestic currency. And that is the precise reason. Always remember this. Whenever you talk exports as a function, as only an outcome related to depreciation of the domestic currency, yes, the outcome is correct. That is, exports should increase. But if I add to that even the concept of inflation, generally it has been found that inflation will eat up whatever advantage an exporter would be getting because of a domestic currency depreciation, as a result of which generally it has been found that with higher inflation rate, despite having a depreciation of the domestic currency, exports will not increase, rather exports will come down. Done? So this is one of the very important feature. That is, any country with a higher inflation rate, exports will be affected. If exports are affected, exchange rate will also be affected. Next one, interest rate. Now understand this, interest rate is a part or is an outcome of a monetary policy. Generally it has been found that any country which has a higher returns rate or any country which offers a higher interest rate, investments will move towards that particular country. Is the logic okay here? Because imagine you're an investor. You have an option of investing in two countries. Let's take a simple example. You're an investor. You can invest in country A where the returns that you're going to earn is let's say 6%. Or you have an option of investing in country B where the returns are let's say 9%. In which country you would be investing? Obviously you would be investing in a second country. If I were to ask you why are you investing in second country, your answer is sir, returns are much better. Now some of you simply say sir, you're talking about returns rate, but the terminology written there is interest rate. Please understand this. There's a very close linkage between the interest rate and the returns rate or the rate of returns here. The linkage is that the rate of interest in an economy is determined by so many factors. Okay, whatever is the rate of interest is determined by so many factors. The most important factor which has an influence over the rate of interest or the interest rate is the monetary policy or the policy of the central banker. Because the central banker influences the interest rate either by selling G securities, by buying G securities, by adjusting the repo rate in case of India, etc. And because the central banker uses the tools within the monetary policy, interest rate is going to change. And whenever the interest rate is going to change, the borrowing in the form of let's say bonds in a particular market. Okay, understand this. Interest rate is not just associated with loans. Bonds are type of a borrowing only. Even in case of bonds, there is a coupon rate, there is a yield rate. So the interest rate fluctuations in a particular country will definitely have an impact on what is the coupon rate, what is the yield rate on these particular bonds. And when the coupon rates will change or the yield rates will change on these particular bonds, either you can expect a lot of foreign investments to come into India or a lot of Indian investments can move out of India or a lot of foreign investments that are present in India can move out of India. Let me take an example and elaborate the discussion on this here. Understand this concept very, very carefully. Generally in case of discussion on exchange rates or let's say forex reserves, there is a discussion related to concept of Fed tapering. Okay, Fed tapering. Now what is the idea of Fed tapering? First and foremost, Fed here refers to the central banker of USA, United States of America. Now in case of USA, just like any country, the central banker there will try to adjust the flow of the money based on growth rate. That is, imagine there is a recession, there's a slowdown in this particular economy, or let's say USA. The central banker there would want to supply more money, reduce the interest rates in the market so that more and more loans are taken, money supply in the market will increase. And please understand the logic here. The concept of a quantitative easing. There are two terms here. One, quantitative easing and Fed tapering. Both of these particular policy instruments are not used by the Federal Reserve during normal times. During normal times, there are different tools which are used, using which the Federal Reserve in USA will try to adjust the flow of the money in the market. But during crisis situation, during let's say recession, during very, very low rates of growth, and that particular situation, the Federal Reserve will use the instruments which are not used by it during normal times. That is the reason whenever they discuss the concept of a quantitative easing as well as a Fed tapering, and these kinds of technologies are applicable to all the central bankers. The term Fed tapering is famous for a simple reason. This is used by the Federal Reserve. Hence, the name Fed is used here. Okay. So, if I were to say that RBI can it use quantitative easing? Yes. Right, in the recent times, RBI has actually used the methodology of quantitative easing, wherein it has ensured that through different tools, through the usage of uncommon tools, it has ensured that there's a huge amount of money supply in the market. So, understand the logic here. Generally, these kinds of the methodologies are not used by the central bankers during normal times. Whenever there's a crisis in the economy, whenever there's a huge requirement of money supply in the market because of certain issues in the market, these kinds of unconventional monetary policy tools are actually used. So, in case of unconventional monetary policy tools such as quantitative easing and Fed tapering, what has been done by the Federal Reserve? The Federal Reserve, under the quantitative easing, will generally reduce the federal funds rate, okay, or Fed funds rate, just like repo rate in India. In USA, there is a Fed funds rate, and will also start repurchasing huge number of treasury bills from the market. As a result of this, what will happen? On one hand, they have reduced the federal funds rate, so the borrowing of the banking sector from the Fed will become cheaper, so money supply is expected to increase. And on the other hand, Federal Reserve will start repurchasing a lot of these treasury bills or treasury bonds which are present in the market. And just like government of India issuing G securities, even in USA, the government there issues these particular treasuries. So when the Federal Reserve will purchase these particular treasuries, what will happen? The money supply in the market will increase. So on one side, money supply increases, and using the second tool also money supply increases. As a result of this, overall money supply in the market increases. Interest rates in the market will come down, and the borrowing will increase. Investments will increase. That will create employment. There is a recovery that will take place in the economy. That is the utilization of the quantitative easing. But on the other hand, whenever there's too much money supply in the market, funds are available at a cheaper rate of interest. There is always a concern of higher inflation rate. Is it okay? Because after a certain point of recovery, if the money supply continues to be the same, there is always a concern of inflation. Generally, we say that GDP growth rate as well as inflation rate, right, both go hand in hand. And it is the duty of the central banker to ensure that we keep on attaining GDP growth rate without fueling the inflation rate in the market. And so when there is a recovery in the economy, there is a danger that there will also be an inflation rate. And so what does the Federal Reserve do? It will opt for opposite of a quantitative easing. It will basically shift the strategy and go for Fed tapering strategy. It is opposite to quantitative easing. Okay. In case of Fed tapering, wherein there is a tightening of liquidity, what does the Federal Reserve do? It will start increasing the federal funds rate, and it will reduce the amount of government securities that it was actually buying or repurchasing from the market. So when you start increasing the federal funds rate, interest rates will start increasing. When you reduce the value of the treasury bonds that you're actually purchasing, the value of money supply that you're basically pushing into the market will also come down. As a result of this, as a result of Fed tapering, what are the outcomes? The dangers or the concerns associated with inflation will be addressed. First point. Second very important point, the amount of money supply in the market will come down. Third very important point, the interest rates will start increasing. Interest rates in the market will start increasing. Now, when the interest rates in USA will start increasing, what will happen as a result of this? Imagine here is an investor who's sitting in India, who has invested in the Indian stock market, and he sees that interest rates in the US market start increasing. What do you expect him to do? He will basically withdraw his investment from India. Imagine he has invested in the stock market, he will sell the shares, collect the money, go to the forex market, convert the rupees into dollars, take out the dollars, start investing in the American market using these particular dollars. So that is essentially what will happen whenever the monetary policy tools are used. Interest rates will rise or will fall in a particular economy or a particular country. So understand this. When Fed tapering is done in USA, it's okay. At the end of the day, you need to connect everything to UBSE. Some of you are thinking, sir, you're telling the story about USA. How is it concerned related to UBSE? Tell me that. Answer to that is, if there's a Fed tapering in USA, there is outflow of the money from India. Dollars will flow out of India. But if the dollars have to flow out of India, first you need to convert the rupees into dollars in India. You need to sell rupees in the forex market, purchase the dollars from the forex market, take the investments to USA. But in the process of converting these rupees into dollars, what is happening in the forex market? Rupee supply will increase. Demand for dollars will increase. Rupee will depreciate. Dollar will appreciate. And whenever this kind of outflow happens without any control, whenever there's a huge outflow because of these kinds of issues, it is RBI which will try to stabilize the exchange rate in India. And that is the importance of RBI, right, in terms of Fed tapering being conducted in USA. So whenever there is a discussion about the interest rates, will interest rates have an impact on the exchange rate? Definitely, yes. In a particular country, if the interest rates rise up, foreign investments will come in search of better returns. Invest in India. Right? As a result of this, dollars need to be converted into rupees. So there's an impact on the exchange rate. If interest rates in America start increasing, these foreign investors will take out their investment, but in the process will sell rupees and purchase the dollars and take these dollars to invest in USA, and in the process will have an impact on the exchange rate in India. So interest rate, definitely yes. What are the public debt? In simple terms, remember this. Whenever you have a public debt, means what? Government borrowings are very, very high. Whenever government borrowings are very high, it is associated with inflation. Is it okay? Whenever government borrowing is very, very high, it is associated with inflation. And when there is inflation, will it have an impact on the exchange rate? Yes. Next, political stability and economic performance. Any country which has a stable government, any country which has a huge growth rate, those particular countries will be finding it very easy to attract foreign investments. Because foreign investors are in search of those particular economies where they can easily invest and also earn better returns. So any country where the government is stable, policies are in favor of the investors. There is growth rate being achieved in these particular economies. Foreign investors will bring in a lot of money, invest in such an economy. And the foreign investors bringing money means what? Dollars are flowing into India. You need to convert them into rupees. Dollar supply increases, will have an impact on the exchange. In addition to this, I've written two more factors here. One, the income of a particular country, and speculation. How does income, let's say, in a country, that is the income of, let's say, households, when it increases, how does it influence the exchange rate? What is the connection here? Whenever income, let's say, of households start increasing, the demand for goods and services will increase. And when the demand for goods and services increase, let's say, for example, India, all the goods that we consume are not produced in India. Even if they're produced in India, it might happen that some of the raw materials could be imported. Some of the intermediate goods which are used to manufacture this particular product are imported. So when the demand for goods and services increases, can I simply say that imports of luxury products will increase, imports of finished goods will increase, imports of raw materials, imports of intermediate goods will increase, and that will definitely have an impact on the exchange rate, because when the imports increase, you need to convert your rupees into dollars, you need to pay dollars, so obviously it will have an impact on the exchange rate. And finally, speculation. How does speculation have an impact on the exchange rate? Imagine you're an importer, you need to pay certain dollars to the exporter after 1 month. But what if you speculate that after 1 month, exchange rate will be different? That is, let's say hypothetically, currently the exchange rate is $1 is equal to 50 rupees, and after 1 month you expect this to be $1 is equal to 60 rupees. What does it mean? Okay, you have to pay only $1 in the future, that is after 1 month. So if you purchase the dollar today, keep it with yourself and pay it after 1 month, essentially you have paid how much to get the $1? 50 rupees. But after 1 month, if you want to purchase the same dollar, you have to shell out, you have to pay 60 rupees. So speculation with respect to changes, with respect to volatility in the exchange rate, will force these kinds of investors in the market either to buy or sell the currencies in the market. And when they will either buy or sell the currencies, the supply and demand factors will be affected. When supply and demand factors are affected, exchange rate will also be affected. So these are some of the very important factors that will have an impact on the exchange rate in particular economy. Now earlier I discussed that the central banker will play a very important role in stabilizing the exchange rate. Just to prove this particular point, I've given a graphical representation here, where we can see that at various points of time, the central banker has intervened in the forex market either by selling or purchasing the currencies so as to stabilize the exchange rate. Now should you mug up this particular graph? Not at all. Please do not mug up this particular graph. All I'm trying to tell you is that there is a role of the central banker which we already established, and now I'm trying to show that through a graph. That's it. Okay. In addition to this, in the context of the exchange rate, there is one more concept of NER as well as REA. NER stands for nominal effective exchange rate, and REA stands for real effective exchange rate. Now what do you mean by nominal and a real effective exchange rate? Let's try and understand this. Now generally when you discuss the concept of nominal and real in the context of exchange rate, what does it mean? Whenever you read in the newspaper that $1 is equal to, let's say, 60 rupees, they're basically referring to nominal exchange rate in the market based on the supply and demand for these particular currencies. What is the exchange rate today? It is a nominal exchange rate. But please understand this. The exchange rates, apart from looking at the nominal exchange rate, there is also a real exchange rate. Now you simply say, sir, what is the difference between a nominal and a real exchange rate here? The price levels of the goods and services in different countries will be different. For example, what is the price level of this particular pen in India will be different compared to the price of this particular same pen in a different country. And that happens for a simple reason. The price levels will be different. The inputs will be different. Cost of labor will be different. So the price levels of the goods will be different in different countries. But when you talk of, let's say, the exchange rate in terms of the nominal exchange rate, you are not considering the inflation rate or price levels in different countries. And that is the difference here. When you talk about the nominal exchange rate, you're simply looking at the exchange rate which is determined in a forex market. But when you talk about the real exchange rate, is okay. When you talk about the real exchange rate, you're basically comparing the price levels in two different countries based on the price levels of commodities in these particular countries. That is the real exchange rate. First point. Second point here. In case of the exchange rates will not just stop at nominal exchange rate and real exchange rate. In addition to this, we'll also try to introduce the reality. What is the reality? The concept of a nominal exchange rate, such as let's say $1 equal to 60, is only applicable when you have only two countries trading here. That is India conducting trade with the USA. If this was the only situation, then maybe the calculation of a rupee versus a dollar, either in real terms or nominal terms, will make sense. But in reality, understand this. In reality, what is going to happen is India will not just conduct a trade with USA. It will also conduct a trade with UK, Japan, China, etc. So having an exchange rate where you're going to compare rupee versus a dollar is not going to make sense when you have multiple trading partners. And one very important point here, the trade that you're going to conduct with these particular trading partners is different. Imagine you have exported 100 goods. It's okay, from India, you have exported 100 goods. Now if you export all the 100 goods only to USA, yes, the exchange rate, that is a rupee versus dollar, is important. And any volatility in this exchange rate, either in nominal terms and especially in real terms, will definitely have an impact on this particular trade. But in reality, what happens? If you're exporting 100 goods, out of 100, 40 could be exported to USA. Remaining 60 could be exported to remaining these particular three countries. Out of this, let's hypothetically 25 exported to UK, right? 18 exported to Japan, and 17 exported to China. So what you're doing here is you're basically considering the total trade that is being conducted between India with the rest of the world. Hence, the exchange rates between rupee to pound, rupee to yen, rupee to yuan, and pound to dollar, yen to dollar, and yuan to dollar, etc. All of these exchange rates will be very, very important. Why? If I simply say 1 to 60, value of a dollar changes because the value of a yen as well as a dollar is changing. Don't you think? When this dollar value changes against the yen, then it will also have an impact between the exchange rate between dollar as well as rupee. Definitely yes. So when you discuss the exchange rate between one currency with another currency, there's a narrow viewpoint. But in reality, what will happen is different countries are trading with different countries, different trading partners are there, different currencies are used, and because the value of the currencies against other currency, other currencies are changing, your exchange rate or your domestic currency exchange rate with other currencies are also getting affected because of this. That is the precise reason. Rather than simply stopping at nominal exchange rate and a real exchange rate, we will shift to a concept called as nominal effective exchange rate. Is okay? Nominal effective exchange rate and real effective exchange rate. What's the basic difference here? Whenever you're simply talking about nominal exchange rate, I use the short forms here, NER, and real exchange rate, RER, you are comparing one currency against another currency. And difference between both of them is, in case of a nominal, I'm looking at the market, supply and demand forces determine the exchange rate. In case of a real exchange rate, what is the impact of a difference in the price levels between these two countries that will determine the exchange rate. Again, there's a formula, there's a methodology, you don't have to mug up all of it. But what I'm saying is, if you stick yourself to the discussion related to NER and RER, that is a narrow viewpoint. You are only looking at one country trading with another country. But in reality, one country will be trading with multiple countries, and the exchange rates will get influenced by so many other factors. That is the precise reason. What we do is, rather than sticking to NER, RER, we'll shift to a concept of nominal effective exchange rate and real effective exchange rate. And the difference between a NER and a RER is that in case of a NER, I'm not adjusting the price levels in different countries. In case of a RER, the price levels between these particular countries will also be considered. That is, the inflation rate amongst these particular countries will also be considered. You take a NER and adjust that with inflation rate between these countries, that is called as a RER. Is okay? Now, in case of a NER as well as RER, another very important point, we do not compare one currency against another currency. Rather, we compare one currency against a group of currencies. Is okay? We compare one currency against a group of currencies. That is the important difference between these two as well as NER and RER. That is the first very important point. Now, who calculates a NER and RER? In case of India, it is calculated by Reserve Bank of India. And RBI basically calculates these particular effective exchange rates by taking two baskets. In one basket, we'll consider 6 currencies, and in another basket, we'll consider 40 currencies. Now, if you ask me, sir, why two different baskets like this? These are the most important trading partners of India. And again, these are included here. There is a wider basket of currencies which is considered. So, what is the value of Indian rupee against these particular basket of currencies is compared, and that is what we call it as NER, nominal effective exchange rate. Now, if you take the nominal effective exchange rate, adjust that with inflation rate or price levels in these two countries or these group of countries, what you get is real effective exchange rate. Okay, so RBI calculates a RER using 6 currencies. These are the 6 currencies, and there is one more basket which consists of 40 currencies. Now, how the calculation is done, not important. Please don't run behind that. Simply understand the logic here. Rather than comparing rupee value against one currency, that doesn't make sense for a simple reason. India conducts trade with the different countries, and the volume of trade will also vary. Hence, we are going to adjust the value of rupee against all of these particular currencies, not only in terms of exchange rate, but also in terms of how much trade India conducts with these particular countries. That calculation is called as a nominal effective exchange rate. And NER will give you basically how competitive is India's rupee against other currencies. Is okay? What is the competitiveness of India's rupee against a basket of currencies? That is, export competitiveness of rupee against a basket of currencies is determined using NER. And RER will give you idea of how much competitiveness does India's trade enjoy in the international market. How competitive are India's exports, or let's say the overall trade that is conducted by India with the rest of the world, is determined by using real effective exchange rate. Right? So these are the two very important concepts here. Please be very, very careful. Now, having seen the concept of exchange rate, let's move on to the next important concept, idea of balance of payments. Now, in the balance of payments, what you need to understand from UPSC perspective are very simple. You need to understand what you mean by balance of payment account. You need to understand certain important deficits and surplus within the balance of payment. Then there's a BOP crisis, what is the role of RBI, and the idea of convertibility. If you understand these concepts, more than sufficient for UPSC exam. Now, let's start the idea of or the concept of balance of payments. Now, to understand balance of payment, I'll go to the definition later, don't worry. Let me start with the basic idea. That is, we say that Indian economy is an open economy. Is okay? Very often you come across this particular terminology in the newspaper, in the book, etc. They say that Indian economy is an open economy. What do you mean by open economy? Imagine India is this side and there are other countries, okay? Or else I'll simply say the rest of the world. So India is there and this is the rest of the world. So whenever there are multiple transactions which are taking place between a country with the rest of the world, what kind of transactions am I talking about? India will import goods and services from India. The capital movements will go to the rest of the world. That is, let's say FDI and FII. And the same way, from the rest of the world, capital movements will enter into India. Indian companies will invest abroad. Foreign companies will invest in India. People from India will move to the rest of the world for working purposes. And same thing will happen with the foreign citizens who will move into India. So essentially what is happening is here, there are multiple transactions which are taking place between one country and the rest of the world. Is okay? Multiple transactions which are taking place between a country and the rest of the world. And whenever this situation exists, that multiple transactions are happening between one country and the rest of the world, we'll simply say this country or this economy is following an open economy model. Is okay? It is following an open economy model. India is an open economy. Right? So India is a mixed economy. That was basically mentioned in the Industrial Policy Resolution of 1948. India is an open economy now. Now have a look at this. When you have an open economy such as India, can I simply say that there will be multiple transactions which will lead to outflow of dollars from India, and same way there will be multiple transactions which will lead to inflow of dollars into India. This is logical. Okay, I'll repeat it again. When you have a multiple transactions like this between India and the rest of the world, some of these particular transactions will lead to outflow of currencies from India to the rest of the world, and there are certain transactions which will lead to inflow of currencies from the rest of the world to India. For example, imagine here is an exporter. He will export goods to USA and receive the payment in terms of dollars. So there is an inflow of foreign currencies into India. In the same way, imagine here is an importer. He will receive or he will import certain goods from USA and he will have to make payment in terms of dollars. So dollars are flowing out of India. So in an open economy, right, there are various transactions which will lead to outflow as well as inflow of the currencies. And all these particular transactions, I can understand this, all of these particular transactions will have to be recorded, and that particular record is referred as a balance of payments. I will repeat it. I'm essentially taking the definition of balance of payments now. Balance of payments essentially refers to what? The record of all the import as well as export transactions that are happening between one country and the rest of the world. And when I say import and export particular transactions, I'm basically referring to those particular transactions which are leading to either inflow of currencies or outflow of currencies. Right? So we'll keep a record of all of these particular transactions that India is conducting with the rest of the world, and that is called as a balance of payment. Now, who will maintain this particular balance of payments? Who will prepare this particular balance of payments? In the context of India, the balance of payments records are basically prepared by Reserve Bank of India. Is okay? RBI is the responsible authority for preparation of these particular balance of payments accounts. The next point. Within these particular transactions, right? Within these particular transactions, generally we divide these particular transactions into two accounts. That is, based on the nature of transactions, we are going to divide these particular transactions into two types. One is called as a current account, and the second one is called as a capital account. Now, to be very, very precise here, IMF, International Monetary Fund, essentially says that rather than having two divisions, rather than having two accounts like this, there shall be three accounts. One, as usual, current account. Second one is a capital account, and the third one is a financial account. Is okay? First is the current account. Second one is a capital account, and the third one is financial account. Now, what does RBI do? RBI basically publishes the balance of payments accounts considering only two accounts, or dividing the transactions into two types of accounts. One, they basically say current account transactions, and the second one, they will say capital account plus financial account of transactions. Now, how do you differentiate between what is the current account transaction and capital account transaction? And to be more precise, again, understand this. As per IMF, it basically states that you have to prepare the balance of payments accounts, not considering only two accounts, rather than three types of accounts. One is a current account, second one is a capital account, and the third one is financial account. Okay, third one is financial account. Now, generally, what does RBI do? RBI will give you transactions related to current account, and second, RBI will basically club the capital and financial account will give you transaction. Now, essentially, the difference between all these accounts is that in context of current account, generally we place transactions which are related to income, which are related to, let's say, export or import of goods and services. For example, imagine here is an exporter from India. He will export certain goods or services to USA, will receive payments, let's say, in dollars, and let's say hypothetically it is $100. So, under which kind of an account do you think this $100 will be provided? It will basically be kept under the current account. First, in current account, and second, this $100 is an inflow. Is okay? It is an inflow for India. So, essentially, it is not just kept under the current account; it is kept under the revenue side of the current account. That is, this transaction has essentially brought in $100 into India. That is the concept of a current account transaction. For example, let's take another one. India will import certain goods or services. Okay, let's say $200 worth of goods or services. So, when you're importing goods and services, there is a dollar outflow from India. So $200 will flow out of India. So essentially, this particular number $200 will be kept under the current account, yes, but it will be classified under the expenditure side of the balance of payment. Is okay? Expenditure side of the balance of payment. So any transaction that leads to either inflow or outflow, and it is either related to income, import and export of goods or services, it will be classified under the current account. Right? For example, I will get this. Imagine you have invested certain amount of money outside India, and on this particular investment, you are earning certain amount of income. So you will basically classify this under the context of the current account. And in the same way, if you borrowed something from outside India, you will have to pay in terms of dollars. You will basically be classifying that under the concept of debt service payments. In the same way, there are in remittances, out remittances. What do I mean by this? Imagine here is an individual, right? Indian. He will move from India to USA. He will work in USA, let's say for a duration of 6 months. He will send the remittances or income back to India. So essentially, it will come in remittances. In the same way, there is a foreign individual, foreign citizen who is working in India. He will take this particular earnings back to America. That will come out remittances. So in remittances and out remittances. So any transaction which is either related to income, either incoming, outgoing, and if it is related to imports and exports of goods and services, it will be classified under the current account. That's the first thing. Second, what about capital account? What about the financial account? In the context of capital account, generally we provide transactions such as, let's say, forex reserves. Is okay? Forex reserve transactions. We will provide transactions related to the government procuring certain assets outside India, or foreign government procuring assets in India. Right? Foreign companies acquiring, let's say, patents, drilling rights, trademarks, copyrights, etc. Right? Across the globe, across the countries like this. These kind of transactions are provided within the capital account, and generally we see that out of the total balance of payments, what is the value? A very small amount of value is generally in the form of a capital account. And in the context of India, I've told you, what does RBI do? It basically club the capital account as well as the financial account and provide it in a single form or under single category. And basically, in the financial account, financial type of a transaction, we provide certain types of assets. Is okay? Transactions related to assets are classified under this particular financial account. For example, foreign investors investing in the Indian stock market, purchasing bonds, purchasing securities. Foreign companies investing in India in the form of foreign direct investment. So I've written FDI, foreign direct investment, foreign institutional investment, foreign portfolio investment, etc. All of them are nothing but the classical examples of financial assets itself. Done. So there are three accounts as per IMF, and in the context of India, we generally follow two accounts like this: current account and simply capital account. But RBI clearly says, right, I'll club the capital plus financial account like this and give the information to you. Now, what is the importance of studying all of this? Why should you study what is the current account transaction? What is the capital account transaction? What is the financial account transaction? What is the need for you? Very simply, you need to understand overall whether the government of India or let's say the whole Indian economy, does it have to repay or does it have to pay dollars to the rest of the world, or is it going to receive a net inflow of dollars into India? Meaning what? Imagine here is a household, right? Just like the economy, imagine here is a house. It is conducting transactions with the rest of the economy. That is, it is purchasing certain goods and services. It is borrowing certain money. It is investing certain money. It is earning income, etc. So don't you think this particular house should maintain a record of how much money is coming to the house from the rest of the economy, and how much money is going from the house to the rest of the economy? This is exactly what we are doing in the context of the whole Indian economy as such, right? Rather than house, we are considering Indian economy, and rather than rest of the economy, we are simply replacing that with the rest of the world. So there are so many transactions which are being conducted between India and rest of the world. In a nutshell, whether India is receiving overall, whether India is receiving, let's say the currencies. Let me replace the currencies with the dollar. So overall, whether India is receiving the dollars from the rest of the world, or India is supposed to pay dollars to the rest of the world, we are going to keep a record of all of this. And as already mentioned, who will keep the record of all of this? It is the Reserve Bank of India, RBI. Now, let's enter into each of these particular accounts. In the current account, I stated that there are exports and there are imports. Is okay? There is a revenue side to the current account. Revenue side essentially means what? This transaction is bringing currencies into India, and there's expenditure side to the account, which essentially means from India the dollars are flowing to the rest of the world. So within this, let's focus on the exports as well as the imports. Is okay? Exports as well as imports. Now, whenever you look at exports and imports, these particular exports could be in the form of the merchandise. I'm using the term merchandise, right? Instead of this, they can also use the term goods. Is okay? So in the context of exports and imports, it could be merchandise or goods. It could be services. It's okay? It could be services. And by the way, services are part of invisibles. That is the basic difference between the goods and services is that I can see the goods. Is okay? I can see the goods. There is a physical shape, physical structure of the goods. What about the services? There is no physical structure for the services. These are invisibles. For example, the ride that you take, let's say in a railways. Railways is visible, no doubt. But the travel that you're making, that is invisible. Right? In the same way, the haircut that you take, it's a service. The restaurant is services. Ola and Uber services. I understand. So generally, these are invisibles. You cannot define these particular services based on physical parameters. For example, take a look at this particular pen. Is it visible to all of you? Yes. You should say yes, by the way, right? It should be visible to you. So this particular pen is visible. Clearly can you basically characterize this particular pen? Yes, some of you say, sir, right, the pen is a black color, the length of the pen is this much, right, the width of the pen is this much, right, the pen is a tapered at the top, and so basically you are defining the physical characteristics of this particular pen. In the same way, services. Can you define services based on physical parameters? Can you define a service such as, let's say, Ola service based on the length, based on, let's say, the breadth, the height, etc.? No, the physical parameters, right, are not available there. Right? You cannot define the services in the context of physical parameters, and that is the reason I'm simply saying services are part of invisibles. Okay. So merchandiser can be exported, imported. Services can be exported, imported. Done. Best example: tourism services, healthcare services, financial services, etc. So you can either export them or you can import them. So generally, the exports and imports can be divided into two parts like this. And why this is important? Now, in the context of balance of trade, let's start. What do you need to understand? The trade balance or balance of trade. Generally, understand this can be discussed in the context of merchandise. Is okay. Can be discussed in the context of merchandise. Can be discussed in the context of services. So what do you mean by this? Let's start with an example. Imagine for a particular time period, India's exports. Is okay. India's exports and imports. So India's exports for this particular time period were $80 billion and imports were $60 billion. I'm just going to calculate the number here. So for a time period, India's exports in merchandise was 80 billion, import was 60 billion. So within this particular merchandise trade, India has received a net inflow of $20 billion. So this particular situation is referred as surplus. Is okay. This is referred as surplus. So within merchandise, it has exported $80 billion, it has imported $60 billion. So which essentially means I have exported, received a payment of 80 billion, I have imported and I have paid $60 billion to the rest of the world. So there is a net inflow which is referred as a surplus, right, within the merchandise trade. Can the vice versa, right, be possible? Definitely yes. Imagine the exports are worth, let's say, $50 billion and imports are worth, let's say, $65 billion. In this particular situation, to the rest of the world, I'm actually paying an additional amount of $15 billion, and this is called as deficit. Is okay. This is called as deficit. So in the context of a merchandise trade, there could be a surplus, there could be a deficit. That's the first point. In the context of services, I can tell you the same thing, right? Imagine the export value is, let's say, $50 billion and import value is, let's say, $35 billion. Right? Essentially, there is a net inflow. Is okay. There is a net inflow of services for which we will receive the payment. And it is vice versa. That is, let's imagine we are exporting the services worth $60 billion and we are importing services, let's say, worth $90 billion. So there is a net outflow in the services. Is okay. Right? So this is generally the idea of the balance of trade. But please understand, rather only discuss only for merchandise, only for services like this. They can also talk about overall trade balance. Okay, overall trade balance or balance of trade. What will happen in case of overall? Imagine the overall imports, goods plus services. The overall imports were $100 billion and overall exports were, let's say, $120 billion. In this particular situation, there is a surplus. Is okay, trade surplus. And if it is vice versa, that is, let's say the import value is $150 billion and the export value is, let's say, right, $90 billion. Then there is a trade deficit. Is okay. Then there is a trade deficit. These are the kinds of terminologies which are generally used in the newspaper while discussing the idea of a balance of trade. Please understand and remember all of this. Now, what is the importance of studying all of this? If there's a surplus, always a good situation for Indian economy, which essentially means we are actually receiving excess dollars from the rest of the world. We are importing, we are exporting, but there is a net inflow of the currencies into India, which is good. But if there is a net outflow, that is, if there is a overall trade deficit, which essentially means there is a net outflow from India to the rest of the world. And whenever there is a net outflow in this particular context, let's say $60 billion, there are two ways how can you address this particular situation of a net outflow or a deficit in the balance of trade. That is, let's say, in the current account. Right? In the current account, if there is a deficit, I'll come to the current account deficit also in a minute. In a current account, if there is a deficit like this, generally, right, there are two ways. One, either, right, there is excess in the capital account, is okay, capital and financial account. We will take this particular surplus, use it to bridge the deficit which is there in the current account. For example, in the trade deficit like this. Or else, if it is not possible, generally the RBI, right, which is the central banker in India, will go for selling of reserves. Is okay, sales of reserves in the forex market. Now, what do you mean by this? RBI has a huge amount of forex reserves. All of us will agree with this. RBI has huge amount of forex reserves. Right? What are the components of forex reserves? Special drawing rights are there. Reserve position or a gold tranche at IMF is there. Okay. Then there is a foreign currency assets. Then there is a gold reserves. If you put together all of these four components, you will get the component or the total of forex reserves. So RBI is sitting on a huge amount of forex reserves. It will basically take these forex reserves, let's say such as foreign currencies, sell them in the forex market, and this is basically called as sale of official reserves. And generally, RBI does this whenever there is a deficit in the balance of payments. Is okay. Whenever there is a deficit in the balance of payment. Right. So what if there is only trade deficit? Because there are other types of deficits which we will discuss in some time. What if there is only trade deficit? We generally try to address this particular deficit in the current account by having a surplus in the capital account. Now, what if you don't have surplus in the capital account? Essentially, you have to focus on sale of the official reserves then. And in the context of India, who will conduct the sale of official reserves? It is the Reserve Bank of India, RBI. Is okay. It is the Reserve Bank of India. So who will maintain the balance of payments records? RBI. Who will conduct the sale of official reserves? It is again Reserve Bank of India. Let's go ahead. So far, we have only discussed the concept of a balance of trade. But in addition to balance of trade, there is also the idea of a current account deficit and current account surplus. Is okay. Current account deficit and current account surplus. So what do you mean by this? Go back to the earlier picture. There is a current account. In the current account, there were two sides: revenue side, expenditure side. Now let's start. Look at only the current account now. What if I were to say that in the current account, the total amount of revenue is, let's say, right, $150 billion, $150 billion, the sum total of all the revenue side transactions. What about expenditure side transactions? Let's say it is $140 billion. So when you consider all the transactions within the current account on revenue side as well as expenditure side, you're getting a sum total of $150 billion in terms of revenue, $140 billion in terms of expenditure. What is the meaning of it? Under the current account transactions, you are receiving $150 billion from the rest of the world and you are paying $140 billion to the rest of the world. And whenever the revenue side is greater, is okay, the revenue side is greater than the expenditure side, this is called as current account surplus. Then this is referred as a current account surplus. On the contrary, what if it is like this? The sum total of revenue side is, let's say, $160 billion and sum total of expenditure side is $200 billion. In the second case, the expenditure side is greater than the revenue side, which essentially means from India there is a net outflow of $40 billion. And this situation is called as current account deficit. Is okay. This is referred as current account deficit. Done. So one, right, within the balance of trade, there could be a trade surplus, there could be a trade deficit. And please understand, when I calculate the trade, the surplus or trade deficit, I can do that individually with countries. For example, generally India has a trade surplus with a trading partner such as USA, but on the other hand, India has a trade deficit with a country or a trading partner such as China. So I can calculate the idea of a trade surplus or trade deficit for individual countries, or I can even calculate for overall rest of the world. And in the context of India, remember this, generally India has a trade deficit. Is okay. Generally, India has been having a trade deficit. That is one point. Second, trade, that is the goods, services, etc., are part or component of current account. Now I'm looking at overall current account. Is okay. I'm looking at overall current account, in the current account, what is the total of revenue? What is the total of expenditure? Is the revenue side greater or is the expenditure side greater? Based on that, I will arrive at either a current account surplus or a current account deficit. And what is the situation in context of India? Right, generally India has been having a current account deficit. India has been having a current account deficit. Done. Now please understand this. Either having a current account deficit or a trade deficit, it is not necessarily a bad thing. Is it okay? Whenever we have a CAD, that's a current account deficit, or a balance of trade deficit, yes, there is a net outflow of currencies from India to the rest of the world. But remember this: having a deficit, such as a balance of trade deficit, is not necessarily a bad thing. Okay, understand? Why? Consider a developing economy such as India. India is a developing country. Done. Now, developing countries such as India, if they want to become a developing country, would want to produce more and more goods and services, will have to increase production in various sectors. But to do that, you require, let's say, machines. You require, let's say, raw materials. You require intermediary goods, etc. Do you think we have all the required machinery in India? Do you think we have all the raw material that is required for production of goods and services in India? No, that is not the case. Let me give a very simple example. In automobile sector, which is one of the major contributors within the manufacturing sector, a large component of spare parts or raw materials we actually import from the rest of the world. For example, we import from China. Is it okay? In pharmaceutical industries, which is again one of the rising sectors in case of India, we are one of the major producers of pharmaceutical products, that is drugs in the global market. And when I say drugs, I'm talking about pills, I'm talking about tablets, etc. Now we are one of the major producers, no doubt. But to manufacture these particular drugs, you require raw materials. Do we have all the raw materials to produce these particular pharmaceutical products? No. For example, in pharmaceutical sector, the raw material, there is a segment called as activated pharmaceutical ingredient. Is it okay? Activated pharmaceutical ingredient. We import a lot of this particular API for various production of the drugs, especially from China. Is it okay? Especially from China. Even in case of automobile sectors, we import a lot of these particular components, spare parts from China. Now you will ask me, sir, why are we importing it? Why can't we simply produce it in the domestic market? We are importing, it doesn't necessarily mean that we are not manufacturing them in India. Yes, we are manufacturing. But the demand is so high that we end up importing a lot of this from the rest of the world. And second very important reason as to why we import these is a cheaper cost. I understand. These are much cheaper compared to the same or similar products which are available within the domestic market. And this basically leads to what? It leads to a lot of these particular products being imported into India. So have a look at this. What we can do is these particular imports can be divided into two parts. Is okay? These particular imports can be divided into two parts. One, necessary or essential imports, and non-essential imports. Is okay? Essential imports, non-essential imports. For example, crude oil. India imports more than 80 to 85% of crude oil requirement from the rest of the world. Essential. I can understand this. Can you imagine Indian economy running a day without consuming crude oil in India? Without consuming petrol, diesel, or let's say aviation turbine fuel, etc. Can you imagine Indian economy sustaining a single day? Civil aviation market runs on aviation turbine fuel. Transportation of goods and services requires consumption of petrol and diesel. So the crude oil is a very essential input, or let's say, and commodity required for Indian economy. So we have to import it. There is no option available for us. And the process of importing essential commodities such as crude oil, such as raw materials in various industries, intermediate goods in various industries, activated pharmaceutical ingredients, etc. If there is a trade deficit, nothing wrong with this, because these are essentials. We'll have to import it. There is no other option available for us. Then there is a constraint. So we are importing. But what about the non-essential imports? Let me give a very simple example. During festivals, all the households in India, or lot of households in India, we purchase plastic products. I can understand. During festivals, right? You might have done it, I have done it, and every Indian would have done it. We end up purchasing a lot of these particular plastic products from the market. For example, we purchase plastic toys, we purchase electronic goods, etc. Right? Again, plastic related. But most of these particular plastic products we end up purchasing are not produced in India. They are produced in the global factory, which is nothing but China. I can understand. These are majorly produced in China, and they will keep on exporting these commodities to the rest of the world. I don't think if I don't purchase a plastic toy, I can understand. If I don't purchase a plastic product from the market, right? Indian economy can sustain. Indian economy can achieve growth despite me not purchasing this plastic toy from the market. Definitely yes. But even then, we import a lot of these commodities, and we end up basically adding to the trade deficit of Indian economy. So understand this: having a trade deficit is not inherently a bad thing. What is the reason for the trade deficit? Is it because of essential imports? Right? No option available. You will have to import them. Or is it right because of non-essential imports? In that particular case, it simply means you will have to go for reduction of non-essential imports. You will have to reduce the imports such as non-essential commodities. Right? So this is in the context of the current account so far. That is the idea of the trade deficit, trade surplus, current account deficit, current account surplus. So for majority period of the time, India has been having a trade deficit. India has been having a current account deficit. But it doesn't mean that we have not experienced a trade surplus or a current account surplus. Yes, in the last couple of years itself, because of the pandemic, in many of these months or quarters, we have actually ended up having a trade surplus. We have actually ended up having a current account surplus also. Done. These are two concepts. Let me go ahead now. In the same way, we'll calculate even for capital account. Okay, capital financial account. Is there a surplus? Is there a deficit? And generally, whenever there is a current account deficit or a trade deficit, we try to bridge that particular deficit using the surplus within the capital account. Now, next point, there is something called as balance of a payment. Is okay, balance of a payment, surplus and deficit. Is okay, balance of payment, surplus and deficit. Now, what do you mean by balance of payment, surplus or deficit? Now, remember that particular picture: current account, capital and financial account, revenue side, expenditure side. Take the sum total of revenue side, take the sum total of expenditure side. Is okay? Take the sum total of revenue side and take the sum total of expenditure side. And when I'm saying take the sum total of revenue and expenditure side, I'm simply saying the capital account, financial account and current account. Is okay? All the three types of accounts take the sum total. Now let's say the revenue side, right, is $500 billion. Okay, revenue side is $500 billion and the expenditure side is $400 billion. Is okay? The revenue side is $500 billion and the expenditure side is $400 billion. So in essence, it means that there is a net inflow. Is okay? There is a net inflow of how much? $100 billion. And this situation is called as a balance of payment surplus. And India generally has a balance of trade surplus. Now, some of you may be thinking, so just some time ago you stated that we have a trade deficit, we have a current account deficit also. But now you're simply saying that we have a balance of payment surplus. How is that possible? Very simple. We have a balance of payment surplus for a very simple reason. There is a current account deficit, but the amount of a surplus in the capital and financial account is so high that, right, even after adjusting, even after taking care of the current account deficit, there is a certain amount of money left. What do you mean by this, sir? Let me give a very simple example. So imagine this is a balance of payment account. One is the first current account. Second one is a capital and financial account. Now in the current account, let's say the revenue side, expenditure side. The revenue side is $100 billion, the expenditure side is, let's say, $120 billion. In a nutshell, can I simply say that there is a current account deficit here? Because the expenditure side of a current account is higher than the revenue side in the current account, so there is a current account deficit. But what if I tell you that the second type of account, that is the CFA, right, the capital and financial account, the amount is so high, that is the current account is in a surplus, right? For example, let's say, right, the revenue side is, let's say, $500 billion, is okay, $500 billion, and expenditure side, let's say, is a $200 billion. Again, just hypothetical numbers here. So have a look at this in the capital and financial account. There is a huge amount of a surplus. Is okay, there's a huge amount of a surplus, and that is the reason I basically stated that whatever is the deficit we have in the current account, we generally try to bridge that by borrowing from the international market. That is basically, let's say, the capital account, right? And there is a capital and financial account. There are external loans are taken, right? We are borrowing from international market, etc. So that is the basic idea here. So there's a surplus here, and this particular surplus will be sufficient to bridge the gap between, right, the revenue and expenditure side in the current account deficit. Hence, the overall outcome will be that there will be a balance of payment surplus. Is okay, there will be a balance of payment surplus. If you just calculate whatever numbers are given in the second example, the total revenue side is $600 billion, and the total expenditure side is $320 billion. So there is a surplus, a balance of payment surplus of $280 billion in the context of India. Done. So you can have a current account deficit. You can have a trade deficit also. Despite that, you can generally also have a balance of payment surplus. Nothing wrong with that. Okay. So in this particular example, let's get back to the first example here. There is a net inflow of $100 billion, and generally whenever there is a balance of payment surplus, this additional $100 billion currency, that is, these particular dollars will get accumulated in the forex reserves. Is okay, will get accumulated in the forex reserves. First point. Second, what will happen if there is a deficit? And imagine this is $500 billion, and the expenditure is $700 billion, which essentially means there is a net outflow. Is okay, there is a net outflow of $200 billion. From where will you get this particular $200 billion units of right, currencies in the Indian market? Okay, understand? In India, you can have rupees, but you need to pay additional $200 billion to the rest of the world. Generally, these particular $200 billion will be taken from the forex reserves itself. So if there is a BOP surplus, it gets accumulated right in the forex reserves. If there is a BOP deficit, which is the second case here, from forex reserves, the dollars will be sold by RBI in the market, and the currencies will be supplied like this. Done. So this is balance of payment surplus, balance of payment deficit. Now let's go to the next one. There is one more concept called as balance of payment crisis. Is okay? Balance of payment crisis. Now what is this balance of payment crisis? Let's start. In the context of balance of payment crisis, there is a balance of payment deficit. The central banker is trying to bridge that particular deficit by basically selling the forex reserves. But what if I say that the balance of payment deficit is so high that I will sell off, I will exhaust all the forex reserves. Even then, I will not be able to bridge this particular deficit. That is in the process of taking care of the BOP deficit. I will exhaust all the forex reserves. And if I basically exhaust all the forex reserves, let's say the dollars that I have, and even then there's a deficit, how do I bridge this particular BOP deficit? I don't think that becomes a problem. And this situation, follow this. This situation where the forex reserves are held by RBI in India will be exhausted, and even then there's a deficit is called as BOP crisis. Is okay? This is referred as BOP crisis. We are going to exhaust all the dollars that we have. Right? Do we have a BOP crisis in India today? Absolutely no. Earlier, yes. Right? In 1991, we were on the verge, the threshold of the BOP crisis itself. As per various surveys, we had only around the sufficient amount of dollars to pay for, let's say, around 14 to 15 days worth of crude oil import into India. And at that point of time, the international prices of the crude oil had actually ballooned, were very, very high. So earlier, yes, right, we have faced a BOP crisis situation in case of India. But post that, we have been building our forex reserves. Today, our forex reserves are more than $600 billion, which will provide certain comfortable position to the market or to the economy. Done. So these are some of the very, very important concepts related to the idea of a balance of payments. Now, if there is a balance of payment deficit, is okay, there is a balance of payment deficit. How will you address this with the balance of payment deficit? One, you can increase exports. Definitely yes. In fact, please remember this. Most of the experts agree that a long-term way out or a long-term strategy to address the situation of BOP is always to promote more and more exports. Is okay, it is always to promote more and more exports. Apart from this, right, one angle that is connected for exports is balance of payment, no doubt. But apart from this, please understand this. Whenever you promote more and more exports, it essentially means what? The production in India is increasing. Is it okay? The production in India is increasing. Imagine last year we produced 100 goods, out of which we exported, let's say, 30 goods. Now this year, what if I say that the exports have increased from 30 goods to 40 goods? Assuming the consumption in the domestic market has remained same, right? Because earlier the domestic consumption was how much? 70 goods. Assume the domestic consumption has remained same. So the total output from India will start increasing from 100 to 110. So if the production increases, can I simply say that employment increases? Correct. Contribution to GDP from this particular sector increases? Yes. Right. As a result of this, right, can I also say that demand for raw materials which are required for these particular companies will increase, and all of this will have multiple benefits. Is okay, all of these will contribute multiple benefits to the economy. That is the first one. And second one, have a look at this. Import dependence is also expected to come down. Right? Imagine, let me give a very simple example. Imagine the products such as Apple phones. Is okay, Apple phones or multiple types of cars. Earlier, these Apple phones were not manufactured in India. We used to actually import it from the rest of the world. For example, from China. Now what has happened is these particular companies such as Apple, right, Foxconn, etc. They've invested a lot of money in India. They're manufacturing these particular products in India. So rather than importing, now we are basically promoting exports of these particular products. So import dependence one will come down, contribution to economy will increase, employment generation will increase, and all of these are basically nothing but the multiple benefits that I was talking of. Done. So the GDP of any country can be promoted either by promoting domestic production and consumption, by promoting domestic production and exports, and you can do both of them simultaneously. That is what the government of India is doing in India. Right? For example, government of India has implemented schemes such as RODTP, remission of duties and taxes on exported products, ROACTL, that is a rebate of state and central taxes and levies, production linked incentives, MEIS, merchandise exports from India scheme, which we will discuss in some time, SEIS, etc. So one, you can promote exports, that will reduce the BOP deficit. Second, decrease imports. You can decrease imports and automatically balance of payment deficit will come down. You can do both of the above simultaneously. Rather than decreasing all the imports, you can reduce the non-essential imports. That will also help, right, in reducing the balance of payment deficit. You can encourage more and more inflow of foreign direct investment, foreign institutional investment. You can go for currency devaluation, which will basically improve your export competitiveness. Right? So these are some of the ways through which the balance of payment deficit can be addressed. Now next, there is this particular concept of convertibility. Okay, there is the idea of convertibility. First and foremost, what do you mean by convertibility? Let me start with the definition. Convertibility essentially means what? There are no restrictions, there are no guidelines which the government of India has imposed on the conversion of, let's say, the foreign currency into domestic currency and the domestic currency back into foreign currency. And then say guidelines, again I'm referring to, let's say, some of the conditions. Is okay? So have a look at this. Whenever the government imposes certain restrictions, certain conditions in terms of converting one currency into another currency, there is the domestic currency into foreign currency, and foreign currency into domestic currency. We'll call this as partial convertibility. Is okay. We'll refer to this as partial convertibility. And if there are no restrictions, no conditions whatsoever for you to convert your rupee to dollar and dollar to rupee, that is called as complete convertibility. Is okay? It is referred to as complete convertibility. I'll repeat it again. It is important to understand this. When a government doesn't have any restrictions, any conditions with respect to converting a foreign currency into domestic currency and vice versa, that is called as a complete convertibility. And if the government in fact has imposed certain restrictions on how you can convert this, in what market you can convert this, at what rate you can convert this, that is basically called as partial convertibility. So how do we understand the concept of convertibility in India? We'll discuss the concept of convertibility based on the two accounts which are there in the balance of payments. That is one, the current account, and the second one is the capital account. Again, there is no separate discussion of financial account. Same thing is applicable, right, within the capital account itself. Because as already mentioned, RBI in fact gives the details of BOPs under only two accounts like this. Okay, so let's start. Current account convertibility, capital account convertibility. Now, what has happened in case of current account? Earlier, that is basically between 92 to 93, we had in fact implemented a concept called as liberalized exchange rate management system. Is okay, I'll repeat it. 92 93, we actually implemented a system called as liberalized exchange rate management system. As often simply says, you're saying that we introduced a liberalized exchange rate management system in 92 93. But before that, what happened? What kind of system we had in India? Historically, understand this. India's exchange rate, that is Indian rupee, was pegged to the British pound. Is okay, it was pegged to British pound, right? And later, after the breakdown of a Bretton Woods system, what we did was we basically de-linked Indian rupee with the British pound and linked the Indian rupee against a basket of currencies. Is okay, basket of currencies somewhere in mid 70s. So till 1991, we basically followed this linkage where rupee was linked to a basket of currencies like this. In 91, again, there was a devaluation of Indian rupee. We'll discuss that under industries. And in 92, we actually introduced the concept of liberalized exchange rate management system. And 93, we again replaced this with a liberalized exchange rate management system, and we basically went for full convertibility within the current account. Now, before coming to full convertibility, what do we mean by the concept of partial convertibility? Imagine under the partial convertibility, understand this. Imagine you're an exporter. You have exported certain goods and services to USA. You have received, let's say, $100. Is it okay? You have received $100. Now, when you have received this with $100, the government imposed certain conditions or restrictions with respect to how can you convert this with $100 into Indian rupee. That is, 40% of the amount that you have received was supposed to be exchanged at notified exchange rate, which was notified by the government. And remaining 60% of these currencies was supposed to be converted based on the market exchange rate. Is okay? I'll repeat it again. Under liberalized exchange rate management system, imagine you're an exporter. You have exported certain goods or services and you have received $100 for that. Now, how you convert this with $100? 40% of these dollars were supposed to be converted based on notified exchange rate. Whereas remaining 60% of these dollars were supposed to be converted on market exchange rate. How that would be done? I'll just throw in a calculation here. Please do not mark up the calculation. UPSC will not ask you the calculation. What you need to simply understand is this. Learn that is liberalized exchange rate management system is applicable to one current account, and second one was basically an example of partial convertibility within the current account. Was introduced in 92, withdrawn in 93. Now after 93, what has happened, sir? We have introduced a floating exchange rate system. Is it okay? And whatever is the currency exchange you want to make under the current account transaction, right? We will allow full convertibility there. That is, you can simply convert it at whatever is the market determined exchange rate now. So have a look at this. Imagine the government of India at that point of time, I just want to arbitrate number here. Imagine that notified exchange rate of $1 is equal to 20 rupees. Is okay? $1 is equal to 20, and the market exchange rate was, let's say, $1 is equal to 25 rupees. So if you convert this to $100 now, for every dollar under notified exchange rate, which will be how much? $40. For every dollar, you'll be getting 20. So for $40, you'll be getting how much? 800 rupees. And here, at remaining 60%, you will allow to exchange it at 25 rupees per dollar. So 25 rupees is $60, you'll be getting 1,500. So totally, you'll be receiving 2,300 rupees for converting $100 under the partial convertibility. That is a liberalized exchange rate management system. We have discarded this. Today we are not following this. We have basically provided full convertibility under the current account. Now, what is the situation in the context of capital account? What kind of situation exists, right, under the capital account? In case of capital account, understand this. Even today, there is a partial convertibility. Is it okay? Even today, there is a partial convertibility that is allowed. So what do you mean by partial convertibility? I've already told you, whenever the government imposes certain conditions or restrictions, it essentially means you cannot freely convert your currencies from one form to another form. You'll have to abide by certain conditions. Now, in case of capital account, even today, we have a partial convertibility. And in the last couple of years, Reserve Bank of India, through various policies, has been promoting more and more convertibility, has been liberalizing convertibility under the capital account. And RBI has clearly stated that we will not treat the capital account convertibility, that is providing full convertibility to the capital account, will not be a single event like this. In a single policy, we will not do that. It is a gradual process. I understand, it will not be an event. It will be just a process, which essentially means it will be done very, very slowly and steadily by Reserve Bank of India. Immediately on a single reform, they are not going to do that. Now, what do you mean by partial convertibility within the capital account, sir? I'll give you an example here. Under the context of a financial market, is okay? Under the idea of a financial market, we discussed one concept called as external commercial borrowing. Is okay? External commercial borrowing. Under external commercial borrowing, earlier we discussed that the Indian companies which are functioning in a sector where FD is allowed can simply go to foreign market, borrow from the foreign market. That is, essentially, they can take loans from the foreign market, they can issue bonds in the foreign market, they can issue debentures in the foreign market, and borrow from the foreign market. But do you think this particular Indian company will be allowed to borrow any amount of money from the foreign market? RBI simply says no. I will not allow you to borrow any amount of money. There is a restriction on this, and RBI right now has imposed a restriction of 750 million borrowings that can be done by these particular companies on annual basis. Is okay? So annually, you'll be allowed to borrow only up to $750 million under external commercial borrowing. So the loans which are taken basically is a part of a CFA. But please understand this. There is a restriction on how much loans you can bring from the rest of the world. I'll give you another example. Liberalized remittances scheme. Is okay? Liberalized remittances scheme. LRS. Under LRS, every Indian citizen, is okay? What is this particular scheme? It is a scheme launched by the RBI. Under the liberalized remittances scheme, every Indian citizen is eligible to basically remit out $2.5 lakh annually. I'll repeat the statement here. Annually, the citizen of India can take out up to $2.5 lakh from India. For what purposes? If you want to invest in a real estate outside India, yes. If you want to invest in the bond market outside India, if you want to invest in the stock market outside India, yes. Right? Up to $2.5 lakh rupees, you can basically remit them out of India. But have a look at this. Can you tell RBI, it is my money, and I can simply convert it into any number of dollars, and I will take everything out of India? RBI simply says, you are not simply taking out rupees, you are basically remitting out dollars. I understand, you are not simply transferring rupees from India, you are transferring dollars from India. And when you are transferring dollars from India like this, RBI regulation will come into force. And annually, you will not be allowed to take out more than $2.5 lakh from India. That is a liberalized remittance scheme. Next one, right? There are also limits on how much foreign companies can invest in the debt market in India. Is okay? There are restrictions with respect to how much foreign institutions can invest in the debt market within India. Right? For example, if a particular company issues, let's say bonds, can a foreign institutional investor purchase any number of bonds here? No, there is a restriction. If government of India issues bonds, G securities are sold in the market. Can a foreign institutional investor purchase any number of bonds of government of India? No, there are restrictions there. So within the capital account, you can see that RBI, through its policies, has imposed certain restrictions, certain limitations, certain conditions like this. And whenever these particular conditions are in place, you can simply say, sir, it is a partial convertibility. So in the context of capital account, there is a partial convertibility. Now some of you might be thinking, sir, why is RBI having a partial convertibility in the first place? should we not go for a full convertibility or a complete the convertibility like we have in the current account? Yes, you're right. Many of the experts, best example, Tarapore committee, which we'll see later, has actually recommended that we must go for full capital account convertibility. But please understand this, there are so many conditions, so many repercussions that the capital account will have on the overall economy. For example, if a full capital account convertibility is provided, foreign investors can freely come into India, invest in any debt instruments, purchase them, sell them, move out of India. That creates volatility in the market. I understand. The economy becomes more and more vulnerable, and that is the precise reason under the capital account, even today, we have partial convertibility. Is okay, we have partial convertibility. Done. So this is a discussion with respect to concept of convertibility. Now in the context of convertibility, there is one committee which is important for UPSC. Generally, questions on this particular committee have been asked in the UPSC prelims. And if at all, let's say in the mains, there is a question which has been asked on the idea of convertibility, you can quote this particular committee in the answer. Now the name of the committee is ESS Tarapore committee. Okay, ESS Tarapore committee. This particular committee was set up in two rounds or was set up twice like this. Once back in the 1997, recommendations were given. Again in 2006. Let's have a look at what are the recommendations are. Right, in the first round, this particular committee basically recommended that we must go for capital account convertibility. It's okay, we must go for capital account convertibility. Now if you ask me, sir, why should we go for capital account convertibility? That we have discussed some time ago. Answer is very simple. Whenever you have a capital account convertibility, the companies in India will be able to borrow from international market at a lower rate of interest. Is okay, under the concept of external commercial borrowing. That is what we discussed. But there is a restriction on how much you can borrow under ECB route. That is $750 million per annum. So if you simply open up this particular capital account as such, fully convertible, then essentially the Indian companies will be able to get access to more and more cheaper loans in the international market. You can expect a huge amount of foreign investments in the form of, let's say, FDI to come into India. That will contribute, let's say, to manufacturing sector, services sector, etc. By introducing the idea of convertibility, you'll be helping the Indian economy to grow. And that is the reason why experts again and again keep on demanding for the capital account convertibility. So the first round of recommendation was given in 1997. In a span of 3 years, that is specifically from 98 to 2000, the committee recommended that we must go for capital account convertibility. Right? So make it fully convertible. But please understand, because the time frame was very, very small, the time period that was recommended by the committee was very, very small, we were unable to, right, to go for capital account convertibility. Having said so, understand this committee recommended that for having a successful implementation of capital account convertibility, there will be certain important conditions. Why? For example, having a stable financial market or financial system is a prerequisite. For example, banking sector, performance of various financial institutions, there should be a better regulation of these particular systems, or let's say participants in the market, which are part of financial system itself. Because these particular capital account transactions will definitely have an impact on these particular participants in the system. So there is a sudden inflow, sudden outflow should not have an impact on the participants, which will destabilize the whole financial system as such. And that is the precise reason this particular committee had put certain preconditions, such as controlling the non-performing assets, the controlling the fiscal deficit of the government of India, having a huge amount of forex reserves, controlling inflation rate, maintenance of a consolidated sinking funds. Now some of you might be very new to the idea of a sinking fund, consolidated sinking fund. Generally, the consolidated sinking funds are set up by the government, using the funds within which we will be reducing the fiscal deficit or the debt of the government. The liabilities of the government will be repaid from the proceeds of the consolidated sinking fund like this. Monetary exchange rate bands, etc. So these are some of the preconditions which were put by the SS Tarapore 1 committee for implementation of capital account convertibility, which has not been done. Again, in the year 2006, second round of recommendations from the SS Tarapore committee 2 were given. And now, basically, the committee assumed that the capital account convertibility is actually taking place. It is an ongoing process. That is the reason they recommended, based on the concept called the fuller capital account convertibility. Is okay, I'll repeat it again. They assumed that capital account convertibility as a process is actually taking place. They recommended that we must go for fuller capital account convertibility. So the time frame which was recommended, right, within which the implementation should be done was between 2006 to 2011. But essentially, they broke down this particular time frame of 5 years into implementation of the reforms in 3 phases. 6 and 7 was the first phase, 7 to 9 was the second phase, and 9 to 11 was the third phase. And what are the recommendations under this? They recommended easing or increasing external commercial borrowing limits, allowing NRIs, non-resident Indians, to invest in the capital markets, strengthening the banking regulation, right, prohibiting the investment of FIIs in the P-notes. And what is the idea of P-notes? We'll discuss that later under investment models. So these are the recommendations of the Tarapore committee, SS Tarapore committee, for moving towards the capital account convertibility. So this is in detail the discussion about the balance of payment. Now let's go to the next important concept, foreign trade policy. FTP, foreign trade policy. Now first and foremost, understand this. Foreign trade policy is recommended. Okay, is a basically a policy which is implemented by the central government. That is the first point. It is a policy which is implemented by the central government. Generally, the convention or the practice is that this particular policy is announced for a duration of 5 years. Is okay. This particular convention is that it is announced for a duration of 5 years. But here's a caveat. This particular foreign trade policy, which is supposed to be implemented from 2015 to 2020, that is for 5 years. 15, 16, 16, 17, 17, 18, 18, 19, 19, and 20 financial years. Right. So this particular foreign trade policy was supposed to be implemented for this particular duration. But government of India, looking at the situation in the economy, for example, the pandemic situation, has extended. Is okay. Has extended the application period of this particular policy. Is okay. Has extended the application period of this particular policy rather than being implemented till 31st March of 2020. This has been extended till 31st March of 2022. Is okay. 31st March of 2022. That's the first point. Next, originally, what was the target? Right, was kept under the foreign trade policy. We wanted to achieve a foreign trade of $900 billion of exports of goods and services. Both goods and services, the value of the exports that we wanted to achieve during this period was $900 billion worth. Right, that is a foregone target. Don't worry about it. What are the important points related to foreign trade policy? First and foremost, have a look at this. We want to promote exports of goods. Okay, we want to promote exports of goods. These particular goods will be referred to as merchandise. And to promote exports of merchandise from India, earlier we had multiple schemes. I'll repeat it. To promote exports of merchandise from India, earlier there were different schemes. What government of India has done is it has merged all of these particular schemes into only one scheme now, and that is a merchandise exports from India scheme. I'll repeat the statement here. To promote more and more exports of goods or merchandise from India, government of India has introduced a scheme called as merchandise exports from India scheme. That's the first one. And to promote the exports of services from India, there were multiple schemes. And government of India has merged all of these particular earlier schemes into one scheme now. SEIS. And SEIS stands for Service Exports from India scheme. Done. So to promote merchandise, MEIS. To promote services, SEIS. Now, what is the use of this particular scheme? Government of India has notified certain exports, either goods or services, and based on the value of exports done, government would be providing incentives to the exporter. I will repeat the statement here. Government of India under the FTP notified a certain merchandise as well as services. Based on the value of exports done for both of them, government of India would be providing certain incentive to the exporter. Let me give a very simple example. Imagine you're the exporter and the government. And you're exporting, let's say, 100 rupee worth of either goods or services. Doesn't matter. You're simply exporting 100 rupee worth of exports. Now, government of India will simply say, I will give you 5% incentive for having exported this particular 100 rupee, which essentially means if you export 100 rupee worth of goods from India, government will give you an incentive of 5 rupee. Is okay. Government will give you an incentive of 5 rupee. That's the first point. Now, let me go to the last point in the slide here. Have a look at this. These particular incentives in the example that I've taken was incentive 5 rupee. This particular incentive was not given in the form of a cash. That is, you're the exporter. You have exported 100 rupee worth of a good from India. I'm supposed to give you incentive 5 rupee. I will not give this particular 5 rupee in the form of a cash. I will not transfer that into your account. No, I will not do that. Rather, government would simply give this in the form of a duty credit script. Is okay. The government would simply issue something called as a duty credit scrip. Now, what do you mean by this? Imagine here's an exporter. The exporter will have a ledger account. All these are technical aspects, and don't worry about this. The exporter will have to open a ledger account with one authority called as Director General for Foreign Trade, DGFT. Now, in this particular account, government would simply transfer this particular 5 rupees. Is okay? Government would simply transfer this particular 5 rupees. So that 5 rupees was not given to you. Rather, you will have a ledger account with the DGFT, and that 5 rupees will be transferred there. Now, what is the use of this? Government simply says, imagine you're importing something. Is okay? You're importing a certain raw material. And when you're importing certain raw material, you'll have to pay taxes or customs on this particular import. And let's say hypothetically, right, the tax, customs, or duty on this product is, let's say, 5 rupees. So government simply says, you don't have to additionally pay 5 rupees now, right? In the ledger account that you have with the DGFT, there is already incentive 5 rupees sitting there. I will simply take this particular 5 rupees. That is, you can simply use this particular incentive, which is there in the ledger account, and you can pay for the customs and duties on the imports. This concept is called as a duty credit scrip. Is okay? This is called as duty credit scrip. The incentives will not be given to the exporters. Rather, they will be transferred into the ledger accounts of the exporters. And they can use these particular incentives to pay for service tax which they owe to government of India. They can pay excise duties that they owe to government of India. They can use it to pay for even the customs duty that they owe to government of India. So both for MEIS and SEIS, incentives were issued in the form of a duty credit scrip, and the exporters could pay for these kinds of taxes. Now, some of you think, sir, what if I don't want to use it? Right? What if I don't import anything? What if in the future I'm not able to pay any taxes to government? There is no situation where I'm supposed to pay. Let's say, then what will I do with this particular 5 rupees? Then the government simply says, you may not require this particular scrip. Again, you may not require it. What if your friend who's an importer needs to pay certain taxes to government? Then simply transfer this particular scrip to that particular person. Is okay? Imagine I issue a scrip in your name. You don't have any use of it. You can transfer it to any other importer who will require to pay certain taxes to the government. This is a concept of a duty credit scrip. In addition to this, if you are exporters from, let's say, SCCs, special economic zones, right? You are an exporter in labor intensive sector, right? You are exporter in, let's say, e-commerce, etc. If you are a participant in any of these, then government would be giving you higher amount of rewards under this particular scheme of merchandise exports from India scheme. Done. So these are some of the important points with respect to the foreign trade policy 2015-2020. Let's have a look at some of the important the provisions within this FTP. Export obligation under EPCG was reduced to promote domestic capital goods manufacturing. Now, what do you mean by export obligation here? All of this is very technical. Let me simplify this. Export promotion of capital goods. This is one type of a scheme or a program introduced by the government. Export promotion of capital goods. Under this particular export promotion of capital goods, imagine you are a capital goods manufacturer. Okay, you are a capital goods manufacturer. But to manufacture this particular capital goods, now some of you might be thinking, sir, what do you mean by capital goods? The capital goods are essentially those particular goods which are used to manufacture other goods. Is it okay? I'll repeat it. The capital goods are essentially those particular goods which are manufactured, but these goods are used to manufacture other goods. For example, let's take a very simple example. You want to manufacture this particular pen. Is it okay? You want to manufacture this particular pen. But to manufacture this pen, you will require to purchase a machine from the market. Is it okay? You have to purchase a machine from the market, which essentially means this particular machine is a product of some other company. That is, imagine there is a company XYZ which manufactures the machine, and you will purchase this particular machine. Using the machine, you will produce this particular pen. So in this particular case, the machine that you're using is a good, and you're using this particular good to manufacture another good. Right? So these are called as capital goods. So have a look at this. Right? In order to promote the domestic manufacturing of capital goods, government introduced something called as export promotion of capital goods. Under this particular scheme, imagine you have imported, let's say, spare part of this particular machine, okay, or certain raw material which is used in the production of this particular capital good. Government of India simply says, because you're using this particular spare part or let's say intermediate good or a raw material in producing the capital good, I will not be imposing any customs or duty on this. Is okay? You're using a particular intermediate good for production of another capital good. So I will not impose any customs or duty on this import, provided in the next certain number of years, you will have to export certain amount of goods. Is okay? I'll repeat it. Under the export promotion of capital goods, the importers who are importing, let's say, spare part which was used to manufacture a capital good, on this customs duty was not imposed by the government, provided this importer will export certain value of the goods in certain number of years. Right? That was the obligation under EPCG. Government of India under FTP 2015-2020 relaxed some of these obligations. The foreign trade policy will be aligned with the Make in India, Digital India, Skill India schemes. Center will be helping the states to prepare export strategies as well as targets. Okay. Then basically, the FTP also recommended that the foreign trade policy should be reviewed after 2.5 years. And Government of India has reviewed this particular foreign trade policy in 2019-2020 and has made certain important changes. Now, what are these important changes? The first 3 points are very, very technical. You don't have to mug up these particular points. In a nutshell, let me put all of these particular right, 3 points in a single line. The incentives that were provided by the government for various commodities under both MEIS as well as SEIS scheme. Is okay? The incentives which are provided by the government under both MEIS as well as SEIS scheme, the incentives have been increased. I'm telling you not to mug up this for a very simple reason. The incentives that were announced by the government were different for different sectors. You don't have to mug up the whole list just to write this particular point in the UPSC. So the incentives that were announced by the government for various commodities which are covered under MEIS as well as SEIS, incentives were actually increased by the government. That's the first point. Second important point is related to duty credit scrips. Okay, duty credit scrips. We have discussed this already under the earlier discussion on FTP. The government of India issued the duty credit scrips, which are nothing but the incentives which government of India gave to the exporters. Now have a look at this. First issue was these scrips had a validity time period. Is okay? There was a validity period applicable for these particular scrips. That is, earlier, once the scrip was issued in your name, you are supposed to utilize this particular scrip in the next 18 months. If you don't utilize the scrip in the next 18 months, this scrip becomes useless. That's the first point. Second point is, remember this, these particular scrips could be transferred by you to someone else in the market. Government told you to do that. If you are unable to utilize it, transfer it, sell it to someone else. But there is one more problem. That is, when you transfer the scrip from you to let's say someone else, the government imposed a GST of 12% on such a sale. Is okay? When you transfer the scrip from your name to somebody else's name, government imposed a GST of 12% on such a sale or transfer of the scrip. So don't think that's a problem now. So under the midterm review, first point, government increased the validity period of the scripts from 18 months to 24 months. That the validity period has been increased from 18 months to 24 months. Second, the GST rate of 12% which is applicable on the transfer or the sale of the scrip now has been reduced to 0. Right? You don't have to pay any rate of a GST if you transfer or sell the scrip to somebody else in the market. Next, government also introduced a new self-ratification scheme, trust-based self-ratification scheme to allow duty-free input for export production under duty exemption scheme with a self-declaration. Such a very, very complicated statement. Let's simplify this. Imagine you're manufacturing this particular pen and you're exporting it. But to manufacture this particular pen, you will require plastic. Is okay? You require plastic. And this quality plastic, imagine it's not available in India. You will import it. So when you're going to import this particular plastic, one, government would impose a customs on this, first one. Second, even to import it, you'll have to take the approvals from an authority called as Director General for Foreign Trade, DGFT. Now when the government imposes customs, that will add to cost of the production, which will increase the market price of this pen, and this particular pen will become less competitive in the international market. So what government said, I will basically make this particular input duty free. That is, you don't have to pay any import duties on import of this particular plastic which you are importing to manufacture and export this particular pen. First point. Second point, even if it is a duty free import now, you are supposed to go to the authority DGFT, submit the documents, wait for the authority to give you approvals to import this particular plastic. That will again take time. It is a time consuming process. Now in order to make it much more easier, if you are importing a duty free raw material, is okay, right? If you are importing a duty free input which is used for what? Production and exporting of the commodity, you don't have to take the approval from the DGFT like you used to do earlier. Now what you need to do is simply go to DGFT, submit a self declaration. Is okay? Go to this particular authority, submit a declaration which basically says that it is a duty free input and it is for export promotion. So he will simply give you the approvals. You can import this particular raw material without having to wait for the approvals like this. So this will make it much easier for you to import duty free imports. Next one, a new logistics division has been created in the Commerce Department. Right? This particular logistics division, remember this, it is under the Commerce Department, first one, created in 2017. And next important point is the logistics division will oversee the development of logistics sector in India. Is okay? It will oversee the overall development of logistics sector in India. It can give certain policy recommendations to the government. It can prepare an exhaustive policy for logistics, give it to government. It can recommend certain changes to be done by the government by taking certain measures in the market. If there are any issues or hurdles in the logistics sector, that will be overseen by this particular division. Okay, logistics division has been set up. And finally, e-wallet for exporters has been set up. And what is this e-wallet? Imagine you're supposed to receive certain refunds, tax refunds from the government. You're an exporter. Delay in the tax refunds essentially will affect your performance. Is okay? Any delay in the refunds will affect your performance. Right? So what they've done is they have basically set up a wallet in the name of the exporter. Is okay? In the name of the exporter, e-wallet, electronic wallet has been set up. These refunds will be transferred right to this particular e-wallet, and the exporters can simply use it to pay, let's say, GST to the government. So these are some of the very important reforms which have been announced by the government under the midterm review.
Next, let's have a look at
Economic integration. Okay, in the context of economic integration, first and foremost, what we need to understand is whenever you're talking about economic integration, it simply means it's a policy approach. Is okay? It's a policy approach which is followed by a country wherein it is going to favor one country or let's say group of countries over other countries. Is okay? Economic integration essentially is a process, right? It is a policy which is followed by the government wherein in terms of a trade, one country will favor either another country or group of countries over other trading partners. Because please understand this, in economic integration, the whole objective is to promote a trade between these particular group of countries. And when I say group of countries, this particular group can consist of only two countries, then it basically is a bilateral group. Is okay? Or it would consist of multiple countries, which essentially is a multilateral group. Is okay? For example, India and Australia, right? Once they sign this particular agreement, it is a bilateral agreement. India, England, India, USA, India, ASEAN, India, Japan, India, South Korea, right? These are nothing but bilateral agreements only. But if India signs, let's say, an agreement with RCEP, Regional Comprehensive Economic Partnership, right? Or India becomes a member of RCEP, which it has not become now, that will be a multilateral agreement because multilateral countries are present in this particular group. So essentially, in economic integration, the trade, right? Sometimes beyond trade also, it will come to that also. The relations between these two countries or group of countries is improved over a period of time. Such a policy is followed by these particular countries. Now, in case of the economic integration, follow this. Generally, the integration will start from the concept of a free trade agreement. Many of the books, again, rather than starting a free trade agreement, they will start at the preferential trade agreement, PTA. I also, right? Generally, in the books, either they might start from PTA or FTA. It will move from FTA to customs union, from customs union to common market, then to economic union. Do not worry about political union because political union is beyond economic integration. After full economic integration is done, generally we talk about the political integration, not relevant for economy as a subject. Now let's focus on these particular terminologies. Preferential trade agreement. Let's start. Generally, there are two countries or more than two countries like this which have come together and they will basically reduce the tariffs which they are going to impose on each other. In case of preferential trade agreement, I will repeat it understand this very carefully. Imagine two countries will come together and they will identify certain products from each other's exports and they simply say that we will reduce the tariffs on these particular products. So what do you mean by this? Let's start. Imagine there are two countries, country A and country B. And country A is exporting, let's say, 100 goods, right, to B, and B is exporting, let's say, 120 goods. So have a look at this. So both the countries will come together, hold negotiations, and will come to this arrangement. Country A will simply say, out of 120 goods, I will reduce the tariff on, let's say, 30 goods. Is it okay? Out of 120 goods that you are exporting into my country, on 30 goods, I will reduce the tariff. And country B, out of 100 goods, will identify, let's say, 25 goods, and will tell A, right, on these particular 25 goods, I will reduce the tariff. Tariff essentially means what? The taxes which are imposed when the product is being imported. Is okay? Imported duties, customs are nothing but tariffs itself. So what both of these particular countries have done is, out of the total number of commodities, which is much larger, few of the commodities have been chosen, and both the countries have arrived at an agreement to reduce the tariffs on each other's exports. And what's the advantage here? When they enter into such an agreement, the exports from A to B will increase, at least of these particular 25 goods, and exports of these particular 30 goods, right, from B to A will increase. Now, you'll ask how exports will increase. Let's take a very simple example. Imagine this particular pen is one of these particular 25 goods. Is okay? A is exporting this particular pen to B. Along with A, there are many other countries which are exporting similar pen to country B. Now, what if, right, because of the taxation relief or tariff reduction, this particular pen, what if it becomes very, very cheap when it will land into country B? Is okay? Compared to other countries' products, this particular country, that is A, right, which is exporting the pen, the products will become cheaper compared to other countries' products for a simple reason. Country B has reduced the tariff. So obviously, it becomes cheaper. Demand for this increases. Exports from A to B will increase. So that is the basic idea. A and B will enter into agreement like this to promote each other's trade. And such an agreement is called as a preferential trade agreement. Is okay? Preferential trade agreement. And remember the feature here. It could be multilateral or bilateral. Most of the times it is bilateral. Okay. Second, it doesn't cover all the goods or services which are exported. Very few of the goods are actually covered. And that is the reason the goods which are actually covered, right? They basically call this as a positive list of commodities. Okay. Positive list of goods. So the positive list of a country will consist of how many goods? 25. And positive list of country B will consist of how many goods? 30. But 25 or 30, right, are very, very small number of goods compared to overall export of goods done by both A and B. Very small number of goods. Then what about free trade area? Right? What free trade agreement? Remember this, free trade agreement is much more ambitious compared to preferential trade agreement. Right? Even in case of free trade agreement, same thing will happen. That is country A, country B are coming together. Right? They are going to reduce the tariff or eliminate the tariff on the exports which are done from each other. That is, A will export certain goods to B. We will either reduce or eliminate the tariffs on most of these particular products or a large number of these particular products. We will export goods to A on most of these particular products. A will either reduce or eliminate the tariffs. So have a look at this. Concept-wise, free trade agreement and preferential trade agreement, same. Right? Same thing happens. Tariffs are reduced or eliminated. But please remember this, free trade agreement is much more ambitious compared to PTA. Why? One, most of the times we will eliminate the tariffs. In PTA, we reduce the tariff. And second, which is most important difference, in case of a FTA, large number of goods are covered, whereas in case of PTA, very small number of goods are actually covered. Right? That is the reason I said the FTAs are much more ambitious compared to preferential trade agreements. And please understand this, in case of FTA, they will have a list of goods. Is okay? They will have a list of goods which are traded by both A and B like this, on which the tariffs will not be reduced. And that list is called as a negative list. Is okay? That particular list is called as a negative list. So that is a free trade agreement. Next, what is the customs union? Those particular countries which are part of free trade agreement. Let's say A and B have signed a free trade agreement now. So these particular two countries, A and B, this particular group will have common external tariffs. I'll repeat the statement. Both of these particular countries, A and B, will now have common external tariffs. Now, what do you mean by this? A and B, imagine they are trading with countries C, D, and E. Now, A and B will have a same rate of tariffs applicable on any trade that is done with countries C, D, and E. If A and B are importing certain products from all the three countries, they will have same tariff. Is that okay? That is the concept of customs union. Next, common market. Right? What will happen in a common market? Those particular countries which are part of customs union now will allow free movement of capital, free movement of services, etc. Right? That is called as a common market. Best example, European Union. European Union was set up basically somewhere in 1950s and 60s. But in 1993, the European Union countries started allowing free movement of capital as well as services. And 1993 will simply say European Union became a common market. Done? What about economic union? Much higher integration. So in a common market, there is a group of countries. They will simply eliminate the barriers for trade. They will allow free movement of labor. They will have same tax rates. Monetary policy and fiscal policy could be same. That is essentially, imagine this is the European Union consisting of multiple countries. And within this European Union, imagine a product is manufactured in this country. They can simply export it, move the product across the countries without having to pay any kind of a customs. Right? So free movement of labor is allowed. Free movement of the services is allowed. Free movement of capital is allowed. All the countries put together, they can have a common currency. They can have a same monetary policy, fiscal policy, etc. Best example for economic union is the European Union itself. Done? So this is the phases of economic integration. Now, let's talk in the context of India. India and free trade agreements. What has happened? Have a look at this. India has entered into multiple regional trade agreements. For example, India has entered into the agreements with South Korea. We have entered into an agreement with ASEAN. We have an agreement with many other countries, etc. So there are multiple free trade agreements wherein India has entered into this particular agreement. But in the recent times, understand this, in the recent times, there has been a rising criticism against these particular free trade agreements. Right? What is this rising criticism? Whenever the free trade agreements are signed like this, it is expected that both the member countries will benefit out of such an agreement. Is okay? Imagine I'm one country, you are the other country. Both of us have signed a free trade agreement. What is the expectation? I will also get the benefit out of this particular agreement. You will also get the benefit because the trade between both of us is going to improve. But what if I simply say that after signing an agreement with me, my country's exports into your country have skyrocketed, have increased multiple times, whereas many of the sectors which are covered under the free trade agreement in your country, they have been negatively affected. Right? Do you want to be part of such an agreement? Obviously, you will have a concern. You will raise concern against this. That is exactly what has happened in the context of India's FTAs with many countries. For example, in this particular picture, the FTAs with Japan has been provided, FTA with South Korea has been provided, and FTA with ASEAN has been provided. And what you can understand by looking at this particular graph is you're looking at import to export ratio. Is okay? You're looking at import to export ratio, which essentially represents what has been the value of imports compared to value of exports. And what you can realize from this particular graph is that India's performance or India's returns from these particular agreements have been very, very poor. Right? Have been very, very poor. Again, you don't have to mug up these particular numbers. You don't have to mug up these particular numbers. I've given certain more points here. Have a look at this. As per NITI report, the trade deficit, right, with ASEAN, that is India and ASEAN, has actually increased from $5 billion to $10 billion between 2011 to 2017. And right, during the same time period, the trade has increased from $50 billion to $70 billion with ASEAN, which essentially means what? The total trade that is conducted between India and ASEAN, definitely yes, it has increased. That is reflective of this number. But during the same period of time, the trade deficit that we have with ASEAN has actually increased, which essentially means the other country or other group of countries such as ASEAN has benefited from this particular trade agreement, not India. Right? And about this, the report also has stated that right, India has eliminated tariffs on around 75% of around 12,000 products, which has excluded around 1,300 products and has kept 1,800 as sensitive tax. You don't have to remember all of this. Right? And despite giving so much favorable terms of trade to the other trading partner, right, what has happened? The trade deficit in 13 out of the 21 sectors covered under this particular trade, the trade deficit is actually widened for India. So essentially, all they're trying to say is, we have signed an agreement. Okay, we have signed an agreement, but the benefit of this particular agreement majorly is going to other trading partners, not to us. And not just this. This is not the only problem. In addition to this, it has also been seen that the imports have become cheaper now in India. And imports from ASEAN, right, have increased, and they have basically made the domestic manufacturing companies' life difficult. So what do you mean by this? Let's imagine this particular pen. We have signed an agreement with ASEAN, so the customs has come down. This particular pen becomes cheaper when exported from ASEAN into India. Don't you think the domestic manufacturing company now will find it difficult to match the price of this particular imported pen? So the imports have become cheaper. They have inversely affected, right, the domestic manufacturing in India. Right? That is the precise reason. Indian government very recently has stated that we want to rework all of these particular free trade agreements where we are not getting the benefit, but the other party is getting the benefit. Done? So that is one point of discussion. Next one, concept of RCEP, Regional Comprehensive Economic Partnership. Is okay? Regional Comprehensive Economic Partnership. Earlier, right, have a look at this. This particular RCEP was a group or a block of 16 countries. The proposal was to have 16 countries. Government of India simply said we do not want to join RCEP. Is okay? Government of India simply said we do not want to join RCEP. We want to remain out of RCEP. Now, as a result of this, remaining 15 countries have gone forward, have signed this particular RCEP, and these particular 15 countries are 10 countries within ASEAN, China, New Zealand, Australia, South Korea, and Japan. Done? So 10, 11, 12, 13, 14, and 15. 16th one was India. India has said we do not want to be part of the RCEP as such. This group will represent 30% of global GDP and will emerge as one of the largest free trading agreements in the world. And what is the advantage whenever you sign such bigger multilateral agreements? One, you'll be able to get access to larger markets. That is, if India was part of RCEP, it would have exported to other 15 countries. Preferential treatment would have been provided. Right? More integration obviously means more trade that will conduct, and it will allow free flow factors between India and these bigger countries. Again, this is not happening now because India is not a part of RCEP. Now, what are the concerns? Right? What basically was the concern which was cited by government of India to withdraw from RCEP? Have a look at this. The most important concern that India basically raised was its trade with China. Is okay? India was concerned about the trade that it has with China. So, what do you mean by this? India already has a huge amount of a trade deficit with China. Now, when you sign this agreement, where China is also part of it, the trade deficit will further expand. Right? So China will start exporting more and more the goods into Indian market. The trade deficit with China will budge like this. That was one concern. Second, India wanted a very tough rules of origin. Now, what is this? Tough rules of origin? Let me simplify this. Whenever you are exporting a particular good from one country to, let's say, another country, let's say from G to, let's say, another country H, you will have to provide the details about from where this particular pen, or let's say the product, has actually originated. Has this particular pen been manufactured in country G, or it has been manufactured in some other country and simply brought and sold in the country H? So what is the origin of this particular product? The details should be provided. And this is a demand that was kept by government of India. We wanted to have a very tough rules of origin. Right? RCP was not agreeing to this. Okay? We wanted an automatic mechanism for safeguard duties to protect the domestic industries. That is, imagine you become part of RCP. Now China will be able to export more and more goods at cheaper prices into India. Sudden surge of imports will have an impact on the domestic manufacturing. So generally, whenever there's a sudden surge of imports like this, to protect the domestic manufacturing, the government can impose safeguard duties. That is, additional taxes would be imposed on the imported products. So government of India wanted a mechanism wherein whenever the imports crossed a certain level, automatically the safeguard duties would be imposed. Right? Again, this was not accepted. RCP wanted the drug makers to accept very strict patent rules. It was opposed by domestic pharmaceutical companies. As basically, patenting, right, is a basic process where intellectual property rights are protected. So there was a very strict regime with respect to providing protection to intellectual property rights, especially in pharmaceutical industries. The domestic companies in India did not accept to this kind of a demand. Okay? Access to services, India wanted more access to services from other countries. It was not accepted. Base year for the trade barriers, India wanted the base year for trade barriers to be 2019. RCP wanted a different base year. Essentially, the tariffs would be reduced. It's okay, tariffs would be reduced. India wanted a year when the tariffs were higher, so that the tariffs when they are reduced, India doesn't have to reduce the tariff by a large margin. That was the demand for India, right, with respect to the base year for reduction of tariffs. And as usual, India's experience with the FTAs has not been very fruitful. India has been bearing the brunt of these particular FTAs. So citing many of these particular reasons, Indian government has said that will not be joining RCP. Okay. Now, what India will be missing out? What is the problem if India doesn't join RCP? One, it will not be part of global value chains that will be formed within RCP members. What do you mean by global value chain? Understand this. A production process. Understand, right? That is basically there are multiple stages, right, in producing and selling a good. I repeat it. There are various stages in producing and selling a good. For example, designing, manufacturing, transporting, warehousing, raw material sourcing. There are so many stages. Whenever you talk about global value chain, it essentially means that all of these particular processes or activities are not done in a single country. Rather, they are spread throughout. Is it okay? All of these particular activities are not done in a single country. These are spread throughout like this. That is called as a global value chain. Right? So when you have RCP members like this, they can be part of a global value chain. Now, India will not be part of that. We will not be able to attract export-oriented FDI because the objective was if you become a member of RCP, now you will be able to attract more and more FDI because now you can export to more countries. That is basically the idea of export-oriented FDI. Because you're not part of RCP, you will not be able to attract that amount of foreign direct investment now. Majority of the global trade is happening in trade groupings, and India has basically decided not to join a trade grouping. Right? So this is some of the issues related to the government of India deciding not to join RCP. So what is the way forward then? Basically, India has to accelerate multiple trade agreements that they are negotiating, so that although they will not get access to this particular RCP group, they will be able to export it to other countries now. Right? So we will have to negotiate more and more free trade agreements. Okay? Target the other markets, right, such as the Britain's market or European market, right? Enter into trade deal with USA, etc. So these are some of the recommendations that can be provided for government of India to move forward. That is basically after RCP. Now we have discussed the concept of the RCP and the integration, etc. Then now let's have a look at certain other important concepts. One, there is this particular idea of trade war, which is generally discussed in the context of USA and China. Let's try and understand what we mean by that. First and foremost, please understand, trade war essentially means not that two countries are going at war with guns, tankers, missiles, etc. No, that is actual war. When you say trade war, it essentially refers to a situation wherein two countries, let's say A and B. I'm just saying an example of two countries. Can they be a group of countries on one side and one country on the other side? Yes, it could be having multiple types of combinations like this. But simplify the concept here. Two countries are there. The trade is happening between two of these particular countries. Okay, A is exporting goods and services to B, and from B it is importing goods and services. Done. So this is the trade that is happening between these two countries. Now what might happen is, imagine country B will impose more tariffs. What do you mean by tariffs here? Import taxes or import duties. Is it okay? So imagine country B will impose more of these particular tariffs on the goods and services which are coming from country A. Okay. Now country A will look at this situation. It will not be happy with it. So it will also retaliate. What do you mean by retaliation? Country A will identify certain goods and services which are coming from country B, and the country A will impose more tariffs on these particular goods and services. So first step, country B has imposed certain tariffs on goods and services which are coming from A, and in retaliation, okay, country A has identified certain goods and services which are coming from country B, and it has imposed a tariff on this. Now essentially, this particular cycle will continue. Right? Let's say hypothetically 100 goods are here and 120 goods are here. Initially they will target 10 goods here, 10 goods here. Then it will snowball into 30 goods and services. It will snowball into let's say 50 goods and services. So this particular cycle will continue. B has started. A will retaliate. Now B will look at it again. It will target some of the goods and services. Impose tariff. Again, A will retaliate. So it's a continuous cycle, and this is essentially called as a trade war. So what is the definition of a trade war? Trade war essentially refers to a disruption in the global trade or disruption in the trade between the countries or trading partners, which happens because competitively the trading partners are imposing tariffs like this, are imposing restrictions. Right? And when these restrictions are imposed in competition like this, it will lead to a situation which is called as a trade war. And what will happen because of a trade war? That is more important. What will happen because of a trade war? Please understand this. The governments, whenever they keep on imposing the tariffs like this or restrictions like this, the overall trade that will be conducted between these two countries would be affected. Is it okay? Overall trade that will be conducted between these two countries would get affected. Imagine for a particular year, A exported $100 billion worth of goods and services to B, and B exported, let's say, $150 billion worth of goods and services to A. So total trade that was conducted between two countries was $250 billion. But because of the trade war, what has happened now? The exports from A will be affected, they will come down. Exports from B will be affected, they will also come down. So rather than conducting and increasing the trade from 250 to 300 to 350, etc., now the overall trade between A and B might fall down to, let's say, $100 billion overall, mind you. Overall trade might simply fall down to $100 billion. So the trade between the countries would be disrupted, would be affected. That is the first one. And second one, understand this. Whenever you're talking about the trade, even other countries will also get affected now. Is it okay? Why? Please understand this. Imagine you're a manufacturer. Okay, you're a manufacturer. And you're manufacturing this particular marker or pen as such. So when you're manufacturing this particular marker, you would import the raw material that you require for manufacturing from some other country. Right? Imagine you import it from country XYZ. So you're manufacturing this marker. You're exporting it to USA. Now, the USA government will impose very high taxes on this. So, your exports of this market to USA will come down. When the exports will come down, can I simply say that you as a manufacturer will require less of raw material. And when you require less of raw material, the import of the plastic that you will do from, let's say, China, the import will also come down. Or from country XYZ, you're importing certain other raw material, that import will also come down. So, it is not just the situation where the two countries which are involved in the world will get affected. It is also other countries which have a contact, which have a trade relation with these countries, they will also be affected. And this process which I've explained just now, that is for production of one particular good or for a good to be manufactured and sold, not just one country is involved, there are multiple countries. Right? Understand this? Whenever we're talking about a product such as the marker that I'm holding in my hand, production is just one stage. Is okay? Production is just one stage in the whole supply chain. There will be designing of this particular market, right? There will be hiring of labor for this particular market. There will be marketing which is done in case of this particular market. Now, what if I simply say that for producing and selling this particular market, design for this particular market is done in one country, production is done in another country, assembly is done in the third country, packaging is done in the fourth country, and finally, the marketing and sales of it is done in the fifth country. So, have a look at it. Just to supply this particular market, how many countries are involved? The producers or the suppliers from 5 countries are actually involved in this. This particular supply or this particular chain essentially is referred to as global value chain. Is okay? Essentially, this is referred as a global value chain. I'll repeat it again. It essentially means for manufacturing and sales of one product, just one country's producer is not involved. Today, they have spread it across many countries like this. For example, very often you'll come across this. Apple office is located in California, that is in USA. Designing is done in USA, but the manufacturing of iPhones is done in China. Marketing is done from some other country. Finally, the sales is done in India. So there are so many countries, or the producers from so many countries are involved to manufacture and sell this particular product. This is called as global value chain. And when a country such as China is involved in a trade war, the trade is disrupted. Then you can ensure that, or you can simply say that the whole global value chain system will get disrupted. The global trade will get disrupted. It will also have an impact on other countries also which are involved in trading with these two countries. And it will also affect the domestic market. Right? How? Understand this. Imagine he is a manufacturer in USA. He will import steel from China, manufacture a product, sell it in the domestic market. Now, when government of USA will impose a higher tariff on import of steel, this manufacturer will import the steel but pay higher prices for the steel. He will manufacture a product using the steel now. So cost of production would be higher. And when the cost of production is higher, what do you think will happen to the selling price? The selling price will also increase. Okay, the selling price will also increase. Don't you think that will affect the domestic market? Definitely yes. Right. So these are some of the issues related to trade war. Now the primary question is, why are the countries going for a trade war then? There's so many issues involved. Yes, sir, we understood that. Why are these particular countries going for a trade war? Many of the times, the countries enter into a trade war, get into a trade war just to protect the domestic market. They want to protect the domestic manufacturers. The government will say that I want to protect you. So what I do is I will impose higher taxes on the goods which are coming from, let's say, another country, so that their imports into our country will come down and the domestic manufacturers can manufacture more, sell in the domestic market. Right. So that is the general argument that is given by countries which go for a trade war. Okay. Now this is one concept here. Next one is a currency swap agreement. Okay. Currency swap agreement. Now what do you mean by currency swap agreement? It is an agreement or a contract which is signed between two countries or two central banks to exchange the currencies at certain predetermined terms and conditions. So what do you mean by this? Imagine India is entering into such an agreement with the USA, that is Federal Reserve. In fact, we have it. We have a currency swap agreement with the Federal Reserve, that is the central banker of USA. Here is RBI and here is the Federal Reserve. Now, if RBI requires a huge amount of dollars, or if there is a requirement of dollars for RBI, so why will RBI require dollars in India? Very simple. What if there is a continuous imports of goods and services on one side, and the foreign investors are taking out the dollars from India? At this particular point of time, don't you think the amount of forex reserves, foreign exchange reserves will start getting depleted? The amount of dollars or other currencies we have in India will start coming down, and as a result of this, please understand, there will come a point of time when RBI might simply say, I'm running out of these particular dollars. Anything after this date, I will not have dollars to supply to the economy, to the market, precisely. In this situation, that is in case of emergencies like this, RBI will basically borrow dollars or will take dollars from the Federal Reserve. And when they will take the dollars like this, for every dollar, RBI will pay certain rupees into the Federal Reserve. Is okay? RBI will give rupees and take the dollars from Federal Reserve and use these dollars to address the emergency situation or contingency situation in India. Now, after let's say a certain period of time, RBI will return back the dollars to Federal Reserve and the Federal Reserve will give back the rupees that it has purchased or it has taken from Reserve Bank of India earlier. And please understand this. Whatever could be the exchange rate at this particular point of time, the exchange of the currencies will be done at a specific exchange rate itself. That is, let's say hypothetically, when RBI will take dollars from Federal Reserve, it has taken at $1 is equal to 40 rupees. That was the exchange rate. And when Federal Reserve will give back the rupees and take the dollars from RBI, it will be done at the same exchange rate. Is okay? Whatever could be the prevailing exchange rate in the market, that is not the concern. The exchange rate, right, will be determined, and this will remain fixed for both the transactions that will be conducted. Now, it will be used to ensure that the countries or the central bankers have adequate foreign currencies to address the BOP crisis. Now, understand this. RBI has entered into such an agreement with Japan. RBI has such an agreement with Federal Reserve, that is the USA. Right? RBI has also revised such currency swap agreement with SAARC countries. Right? And we also have a currency swap agreement with Sri Lanka till November 2022. Right? So this is how the currency swap agreement will be used to stabilize the BOP issues. Next, what reforms have been undertaken by the government to promote exports from India? First one is RODTEP. What is the long form of RODTEP? Remission of duties or taxes on export products. Now, what is the meaning of this? Let's try to understand. Earlier, we had a scheme by the name of Merchandise Exports from India scheme. Now, the issue with respect to the merchandise exports from India scheme was it was violating WTO agreement. And as a result of this, Government of India had to withdraw this particular MES scheme. And 1st January 2021, from that date, government has implemented RODTEP scheme. Now, what is the importance of RODTEP scheme? Understand this very carefully. Imagine here is a manufacturer. Okay, here is a manufacturer. He has paid taxes on various raw materials that he has purchased. Okay, he has paid taxes on various raw materials, and many of these particular taxes are subsumed under GST. Is okay, many of these particular taxes have been subsumed under goods and services tax (GST). Now, whenever these particular taxes are subsumed under GST, government will provide input to tax credit to the manufacturer. So, whatever taxes he has paid on the raw materials, that is given back to him in the form of a credit under ITC. He will not simply transfer this particular tax when he will decide what will the price of, let's say, the export that he wants to do. It's okay. That is in simple terms. Imagine I'm a manufacturer. To manufacture this particular marker, I purchased raw materials. I paid the price on the raw material. I've also paid the GST. And this GST that I paid is given back to me in the form of input to tax credit. So when I will decide the market price of this pen, I will not be adding the tax that I paid on the inputs, that is GST, I will not be adding. But please understand, there are certain taxes which are not subsumed under GST even today. It's okay. There are certain taxes which are not subsumed under the GST as of now. Or there is no GST on these particular commodities in the market. For example, fuels. It's okay. For example, fuel products, petrol and diesel. The GST Council is yet to notify the taxes on the fuels. So what if in the process of manufacturing a product, I consume the fuel product, I pay the taxes to the center as well as the state government, and these taxes are not given back to me, they are not refunded to me. So when I will decide the market price of the product, I will simply add the taxes that are paid on the fuels. So is there an example for this? Let me give an example. In the civil aviation market, whenever you travel from point A to point B, that is you fly from point A to point B, you take a flight, you will pay a certain price for the ticket. The ticket price actually includes the tax is not under GST. There is no GST on the ATF. Central government has a tax, state government has a tax. So when the civil aviation company, that is let's say Indigo, SpiceJet, Air India, which are companies, when they will purchase the ATF, they have paid taxes to central and state. They will use ATF as a fuel to fly the airplanes. And because you're sitting in the airplane, you're purchasing a ticket, these companies essentially will transfer these particular taxes to you. You'll have to pay those taxes. Right? In the same way, a manufacturer, let's say exporter, will also pay taxes at the central level, state level, even to the municipalities, which are not subsumed under GST. And as a result of this, when he will manufacture and wants to export this particular product, he would simply add these particular taxes while deciding the price of the export. Now, this is not required. This is not good. Why? You want to promote more and more exports from India. All of you agree with this? We want more and more exports to happen from India to the rest of the world. But if you're adding the taxes that you've paid, right, and these are not refunded, if you're adding those particular taxes in determining the export price of the commodity will increase, and the prices in the international market, if they're higher, there will be lesser demand for your goods. So on one side, we want to promote exports, but on the other hand, right, there are certain taxes which are not given back to the manufacturer, not refunded, which they're going to add to the market price of the export. Such taxes are called as embedded taxes. Such taxes are referred to as embedded taxes. So now Government of India says that I want to take out the impact of embedded taxes on the exports. I want to provide certain incentive. I want to provide certain refunds to these particular manufacturers in such a way that when they will export the product, the price that is determined, that will not include the embedded taxes. And for that, Government of India has introduced RODTEP scheme. Under this, they basically set up GK Pillai committee, and this committee has given a recommendation to government. And based on the recommendation, Government of India has announced different amount of a remit. Different amount of a remittance, or let's say remission in the taxes that government will provide for different sectors like this. Right? And now the argument is because the government is remitting these particular taxes to you, these embedded taxes, you will not be adding these particular taxes when you're deciding the market price, and your exports will become cheaper now. Your exports will become very, very competitive. And please understand this, because now in the export, no taxes are involved. Okay, understand? When I say this particular pen price is let's say 10 rupees, out of 10 rupees, there is no tax component. There is no absolutely tax component in that 10 rupee value on the market price. Such a situation is called as zero rating of exports. Remember this. Such a situation is referred to as zero rating of exports. Done? Right? So remember this particular concept. Now, how these particular credits, right, or taxes are limited back, the credits are issued, and these particular credits can be used by the exporters to pay basic customs duty on the import of the goods or transfer to other importers. So this is one very important initiative that has been introduced by the government to promote exports. Second is production linked incentive, PLI. Production linked incentive, PLI. Under PLI, what will happen? Government of India will identify the sectors. First point, Government of India will identify the sectors. Right now, how many sectors are there under PLI? 40 sectors are covered under PLI. That's the first point. Second point, to the companies which will participate under these particular sectors. Again, there is a bidding process, etc., etc. You don't have to mug up all of that. Understand this very simply. There are private sector companies which government says, okay, you can participate under PLI. But please understand this, government will give target to these particular companies. That is, investment target will be given, and right, incremental sales will have to be done. Investment target will be provided, and incremental sales has to be done. What do you mean by this? Right, have a look at this. For a particular sector such as, let's say, mobile manufacturing. Mobile manufacturing, government might simply say, for a duration of 5 years. This scheme has been implemented for a duration of 5 years. 2022, you have to invest this much amount. 2023, you have to invest this much amount. 2024, you have to invest this much amount. So investment targets are given by the government. And not just investment target has to be met. These companies will also have to make incremental sales so that the incentives are given to these companies. What do you mean by incremental sales here? Let's say a particular company has been identified under PLI, and the base year for calculation is, let's say, 2020. And in 2020, imagine the company has sold goods worth 100 crore rupees. The government says, in the next 5 years, in every one of them, in the next 5 years, your sales should cross always 100 crore rupees. The amount of sales you do should be more than 100 crore rupees. That is, let's say in 2022, if the company makes a sales of, let's say, 120 crore rupees, then 20 crore rupees will be considered as incremental sales. And based on the incremental sales, the incentive will be provided by the government. Is okay? Based on incremental sales, the incentive will be provided by the government. That is, let's say 10% is the incentive. So how much is the incremental sales? 20 crore rupees. So 10% of 20 crore rupees will be 2 crore rupees. And government will simply transfer this particular money to the company. Give this particular money to the company in the form of incentive. These are certain very, very important points related to production linked incentive. Now, what is the importance of this particular initiative? What is the importance? First and foremost, this will promote investment in India. Whether the domestic companies do or foreign companies do, we are not worried about it. This will increase investment in India. That's the first outcome. Second, capital formation will be aided. Third, dependence on imports will come down. Is okay? That's very important. Now we are promoting manufacturing in India. Fourth, very important, generation of labor opportunities or employment opportunities. Employment generation will take place because of this particular initiative. And rather than importing these particular goods now, we might end up exporting more and more goods to the international market. This will bring in very precious forex reserves into India. So these are some of the likely advantages which are associated with production linked incentive. Next, there is one more initiative, supply chain resilience initiative. Okay, supply chain resilience initiative. Now, what is this initiative? This is generally being discussed between Japan, India, and Australia. Is okay? This is being discussed between Japan, India, and Australia. Right? And the name of this particular initiative is supply chain resilience initiative. Now, why this is holding importance? Again, this is just in the negotiation phase now. During the pandemic, what actually happened was, for various raw materials, we are heavily dependent on China. Is okay? We are heavily dependent on China. And just like us, even Japan is dependent on China. Australia is also dependent on China. But during pandemic, the exports from China, right, and rightly so because of pandemic, were affected. So as a result of which, right, the three depending countries such as the India, Australia, and Japan, the production in these countries was also affected. Because if the raw material is not exported from China, how will we produce in India? So that was affected. So I want to address this particular disruption that can be caused. And please understand this happens when you are overly dependent on one supplier in the market. Again, understand, you are overly dependent on only one supplier. Let me give a very simple example. Imagine you are a producer, you want raw material, and you are purchasing this raw material only from me, and you have the contract only with me. Now, what if in 1 month, for various reasons, I am unable to supply raw material to you? Don't you think your production will be affected? And now you will realize, if I am dependent on only one supplier like this, or a very limited number of suppliers like this, it will have an impact on my production in any time. Right? Because of various issues, it could have an impact on my production. So what is the initiative here? Under this particular initiative, we want to diversify the supplying, right, or access to the raw materials in the international market. Rather than being overly dependent on these particular only one country or limited number of suppliers in the international market, I want to diversify. I want other countries also to start manufacturing these kinds of raw materials or intermediate goods and right, increase the supply of these to the other markets. So the objective here is to attract FDI, infuse the complementaries across the supply chain. We want to diversify the supply risk across these particular countries as such. Okay, and the three countries which are involved in this are India, Australia, and Japan. So this is one more initiative. So these are certain very important points. Let's have a look at the previous questions here. If another global financial crisis happens in the near future, which of the following actions or policies are most likely to give some immunity to India? Okay, there's a crisis in the international market which will provide us immunity. Understand this. We are dependent on borrowings from the international market. We borrow from domestic market as well as international market. But whenever you borrow for a very short duration, right, there is always a risk related to this. That is, whenever there's a volatility, if there's a crisis in the international market, there is a repayment pressure on me. Okay, understand this. If you're dependent on, let's say, borrowing for 30 years, 10 years 30, 10 years 20 years, whatever crisis will happen in the market in the next 20 years, it will be addressed. So it is always better for the companies or let's say even the governments to borrow for longer duration rather than borrowing for a shorter duration. So if there's a crisis in the coming years, what will help us to tide over, to overcome this particular crisis? We should not be dependent on short-term borrowings. That's the first point. Opening up to more foreign banks. No, when you open up to more foreign banks, imagine a bank which is set up in USA is also functioning in India, right? And if this particular foreign bank which is set up in USA crashes, it will definitely have an impact on the functions of the same foreign bank which is present in India. So no, right, you should not be opening up these particular foreign banks if you want to control the impact of these kinds of crises. Maintain full capital account convertibility. If you have full capital account convertibility, please understand, if there's a crisis in the international market, there could be a sudden outflow of the capital from India, and that will create volatility in India. We do not want that. So please also, so right option is option A, that is one only. Next, in the context of India, which of the following factors is or are contributors to reducing the risk of a currency crisis? The foreign currency earnings of India's IT sector. Okay, now look at the statement again. In the context of India, which of the following factors is or are contributors to reducing the risk of currency crisis? Meaning what? Whenever there is a sudden outflow or there is a continuous outflow of, let's say, foreign currencies, you need to have sufficient amount of supply of foreign currencies in the domestic market. Right? So which of the following factors will ensure that there is a supply of foreign currencies in the market? So foreign currency earnings of India's IT sector, yes, that will ensure that there is sufficient number of dollars in India. Increasing the government expenditure, no. Remittances from Indians abroad, yes. Right option will be option B, 1 and 3 only. Next question. Which one of the following is not the most likely measure the government or RBI takes to stop the slide of Indian rupee? Okay. Curbing imports of non-essential goods and promoting exports. Yes, if you can do that, obviously the amount of required dollars or the demand for dollars will come down. And on the other hand, they are promoting exports, dollar inflow will increase. So can it be done to control the rupee slide? Yes. Again, what do you mean by slide in the Indian rupee? Depreciation. Okay. Can this be done by the government or RBI to control the depreciation in the rupee? Yes, it can be done. Encourage Indian borrowers to issue rupee denominated masala bonds. Yes, this could also be done. Please understand. Let me clear both the B and C. There is something called as external commercial borrowing. Under external commercial borrowing, what happens is Indian companies which are functioning in a sector where FDI is allowed, they are allowed to borrow from external market. Is it? They are allowed to borrow from external market, and who will regulate it? Generally, RBI regulates this particular route of ECB. But the argument here is, if there is an Indian rupee slide, that is rupee is continuously depreciating, it simply means we need to supply more and more dollars, right, in the Indian market, and that can be done by easing the conditions related to external commercial borrowings. And rather than borrowing in the form of, let's say, dollars, we can also borrow in the form of rupee bonds or let's say rupee denominated instruments which are issued outside India. Right, so that is also one way through which ECB is done. So following an expansion monetary policy, when the RBI will follow an expansionist monetary policy, money supply will increase, interest rates will come down, and when the interest rates will come down, the foreign investors generally take their investments and start moving outside India. Why interest rates in India are lower now? They better invest in some other instruments, they will get better returns there. It is a measure which will not be used by RBI to control the sliding rupee as such. Now some of you will be thinking, sir, how, right, the sliding interest rate or lower interest rates will have an impact on Indian rupee? Very simple. Lower interest rates, foreign investors will withdraw the funds from India, they will take out the dollars, but in the process they will sell rupees, and it will lead to depreciation of Indian rupee. So option D, right, that is the step D will not be taken by the RBI. Right, so that is the right statement. Now these are the various aspects as well as the questions related to this particular module. Thank you.
The first article basically discusses the connection between rupee appreciation and the exports. Now let's try and understand the very important points. We'll link it to article. First and foremost, understand this. If Indian economy wants to achieve a higher GDP growth rate, it simply needs to produce more goods and services. For example, when the production increases, the value of GDP increases, and when GDP increases, GDP growth rate from 1 year to next year will keep on increasing. Now, these particular goods and services which are produced in Indian economy, either they can be sold in the domestic market or these can be exported to the international market. What I'm trying to basically say is this. Even by exporting more from India to the international market, we can achieve a higher GDP growth rate. First point. Second very important point. In recent times, there has been a slowdown followed by contraction in the Indian economy, which essentially means the consumption, that is the domestic consumption of goods and services, is on the lower side. So if India wants to have a positive growth rate in the coming days, it essentially needs to produce more and also export more from India to the rest of the world. That's the second very important point. Third very important point here. There is a very close linkage between the export growth rate as well as the GDP growth rate. For example, the article mentions the time period between 2003 to 2008. Now during this particular time period, it is said that India on an average achieved a GDP growth rate of around 9%. And this particular 9% growth rate was basically compared with the export growth rate, and the export growth rate during this particular time period was around 17.8%, average of 17.8%. And during the same time period, the domestic consumption, the growth rate in the domestic consumption is 7.2%, which essentially means this particular growth rate of 9% was essentially driven by the export growth rate. This is a third very important point, which essentially connects the exports with the GDP growth rate. Now we have established that to achieve high GDP growth rate, we can do that even by promoting exports. But the article mentions there is one very important problem with respect to this. What is the problem? There is a rupee appreciation which is happening in the economy right now. Now what is the idea for rupee appreciation? Understand this. Whenever there is a floating exchange rate mechanism which is followed, which essentially means the market forces of supply and demand are determining the exchange rate, the value of the domestic currency against the foreign currency will keep on floating. That is, it will keep on changing. Now the two technical terms that are generally used in such a floating exchange rate mechanism is the term appreciation and depreciation. Now if the value of a rupee compared against a foreign currency, let's say a dollar, if the value of Indian rupee increases, we simply say rupee is appreciating. And if the value of Indian rupee against a foreign currency such as a dollar falls down, we'll call this as a depreciation of the domestic currency. Now understand this, whenever the rupee value will keep on changing, that is either appreciation or depreciation, it generally will have an impact on the imports and exports. To put it in a nutshell, just remember this, whenever rupee appreciates, whenever rupee is seen to be appreciating in the foreign exchange market, it will ensure or it will basically imply that imports will become cheaper. Just understand this, imports will tend to become cheaper and exports will start losing out on the international market. Or in simple terms, the imports will become more and more cheaper, and on the other hand, exports market competitiveness will be lost in the market. So importers will get the benefit, exporters will be affected by rupee appreciation. Now, what is happening in the Indian economy? In the recent times, there has been a net inflow of foreign direct investment and foreign portfolio investment such as FII. Now, as a result of net inflow of both FDI and FII, it is seen that rupee is actually appreciating. What is the meaning of this? FDI and FII will flow into India in terms of dollars, and when these particular foreign currencies or foreign capital is coming into India, can they invest directly the dollars in the domestic market? That is in the Indian market. Can they invest dollars? Not allowed. So what they do, they basically convert these particular dollars into rupees. So in the forex market, rupee demand will increase, dollar supply will also increase. So essentially, rupee will start appreciating, dollar will start depreciating. And when rupee is appreciating, what is the impact on the exports? The exports will get affected because of this particular appreciation in the domestic currency. Now, in this particular situation, a very important role is played by the central banker. What is the role? Understand this? The central banker, that is Reserve Bank of India, will basically, in this particular situation, will start buying the dollars from the market. Understand this? In the current situation, what is happening? There is a huge inflow of foreign capital. There is dollars in the market, as the forex market. Dollars are being sold, rupees are being purchased. Dollar depreciates, rupee appreciates. So in this particular situation, RBI will simply start buying the dollars from the market and start supplying rupees to the market. So rupee is pushed into the market, dollar is sucked out of the market, thereby basically stabilizing the exchange rate. So this is the important role that is played by RBI. And please remember this, RBI always specifically says it will play a role in the forex market only to stabilize the exchange rate and not to decide the exchange rate. Remember these particular terms. RBI tries to stabilize the rupee value in the market and not determine the value of rupee in the forex market. So RBI from time to time will intervene in the forex market, try to stabilize the exchange rate, that is the rupee value. And in the present situation, this is exactly what RBI is doing in order to stabilize, in order to control the appreciation of rupee and ensure that the exports from Indian market to external market will also increase. Now, apart from this, another very important point which is mentioned in the article is the concept of REAL. So understand this, there are two terms. One is NEAR and the other one is REAL. REAL stands for real effective exchange rate and NEAR stands for nominal effective exchange rate. What is this? Whenever I simply mention the exchange rate in terms of a dollar with rupee, that is how many rupees is equal to $1. If I express the exchange rate in this particular format, it is called as nominal exchange rate. This is the first point. But please understand this, India will conduct a trade with US in the same way it will conduct a trade with many other countries also. So what RBI basically does is, rather than being focused only on this particular nominal exchange rate, RBI will focus the value of a rupee against a basket of currencies. I will put the statement here. RBI, rather than being focused only on this particular rupee versus dollar exchange rate, will focus on value of rupee on one side, compare that with value of some of the basket of foreign currencies. So the concept of a NEAR, nominal effective exchange rate, basically RBI will take into consideration basket of 36 currencies. And these particular currencies are basically from those particular countries with which India conducts a trade. Now understand this particular number, that is the 36 currencies, very recently has been changed by RBI from 36 to 40 currencies. Remember this particular number. Now this is the concept of a NEAR. But let's go a step ahead. RBI will be much more focused on the concept of a REAL, not just a NEAR. Now you ask yourself, what is the difference between NEAR and a REAL? Now understand this, the prices of the commodities in different countries will differ. Is okay? If I take a basket of commodities in India, the market price will be different. For the same basket of commodities, the market price in some other countries with which India conducts trade will be different. This happens for a simple reason, there is a differential in the inflation rate across the countries like this. So what RBI does is, it will first take the weighted trades, that is basically, India will conduct different volume of trade with the different countries. If I were to give a simple example, imagine here is India. It conducts trade with the two countries A and B. The total volume of trade, let's say a very simple number, is $100. But if India conducts trade with the country A worth, let's say $80, and with the country B worth $20, can I give equal weightage, equal importance to both of them? Not possible. Highest weightage, that is 80% weightage will be given with the trade, that is basically the trade that is conducted between India and the country A, and 20% weightage will be given to this particular trade. So in the same way, India will conduct different amount of a trade with different countries. So weightages will be allocated to these particular trades which are done by India with other countries. That's the first point. Second, inflation differential, that is basically inflation across these particular countries will also be considered. It's a technical formula, you don't have to remember. All you need to understand simply is this. From NEAR, when we shift it to REAL, nominal effective exchange rate, to real effective exchange rate, basically the idea is here we will try to adjust inflation differential or difference in the pricing of the commodities across various countries. So RBI will keep on calculating REAL, and this very recently has a rebase or has been rebased. Earlier we used to consider 36 currencies, now we are considering a basket of 40 currencies. Not only this, in terms of calculation of REAL, the base year has been changed by RBI. Earlier the base year for the calculation was 2004, 2005. Now this has been shifted to 2015 and 2016. Now this particular 15 and 16 has been chosen as a base year, and RBI has given certain clarifications on why this has been chosen. One, inflation rate for this year was somewhere around 4.9%. GDP growth rate was very high, right? And current account deficit was just around 1% or over 1%. So keeping in mind all of these particular parameters, RBI has basically chosen this as a base year, and based on this, basket of 40 currencies is calculating REAL. This is another very important point. Next important point mentioned or discussed in the article. Government of India on one side says we want to revive the economy, we want to promote exports, but on the other hand has decided not to join RCEP, Regional Comprehensive Economic Partnership. RCEP was basically a proposal, right? The free trade agreement amongst 16 member countries or 16 countries. India basically said I want to opt out of this and citing these particular reasons. So as of now RCEP has been signed and 15 member countries are there. Article simply says RCEP right now accounts for 30% of global GDP, and in a decade, that is basically in the next 10 years, this particular 30% will increase to 50% of global GDP. And India basically said I do not want to be part of RCEP. So where it will start promoting the exports, to which economies it will start promoting the exports. The article says India needs to sign more and more free trade agreements now. But there's a problem with this. But even this, if you consider the cost of production in case of India, the cost of production is on a higher side. For example, the article discusses the cost of manufacturing a mobile phone in India compared that with another country, Vietnam. And the article basically says if the same mobile is manufactured in India, it will cost somewhere in the range of 9.4% to 12.5% more than the cost of production in country that is Vietnam. So you want to promote exports, cost of production is higher, rupee is appreciating. You have basically said I do not want to be part of RCEP. So these are certain very important points mentioned in the article. And finally, one very important point, it has mentioned that government of India earlier provided subsidies or incentives to promote exports through the concept of MEIS, merchandise exports from India scheme. Under this different incentives, a different level of incentives, subsidies were given for exports. Government of India has basically withdrawn this particular scheme and has introduced another scheme, production linked incentive (PLI). And the number of sectors under PLI very recently has been increased from 3 sectors to 13 sectors. But here is the important difference. MEIS provided subsidies which are linked to exports, and that would simply increase the export competitiveness. But on the other hand, PLI, the incentives are provided which are linked to incremental production. And the number of sectors which are covered are just 13 against a larger coverage under MEIS scheme. So these are certain very important points mentioned in this article. Based on this, let's take a question. Consider the following statements. NEAR, that is a nominal effective exchange rate, is calculated and published by CA monthly. No, this is published by RBI. Second, to calculate a NEAR, basket of 36 currencies is taken. Yes, earlier it was 36, now this has been increased to 40 currencies. Even second statement is wrong. Right option will be option D, both are false.
OPEC share and oil imports. See, oil, and we'll be talking about later also, oil generally is important. It's important to us because we as a nation get 85% of all our crude oil from import. So anything related to oil imports is important for the examination because again a trend-based question can easily come. And this one is equally important, it is more important because there is a geographical shift and I tell you why it is happening and what is the general pattern. So what is the static part? OPEC, Organization of Petroleum Exporting Countries, there are 13 countries in it, but some of the important ones are Iran, Iraq, you have Saudi Arabia, Nigeria, which is very important to us, Nigeria, Algeria, Congo, and UAE. There are 13 different countries, but for our analysis, these ones are the most important. More are the important, which are the West African and the African ones, because they are mostly giving us the oil. When you come to OPEC companies, see, what OPEC is called in economic terms is called cartelization. The word cartel itself means you act like as a group which controls everything. That is called, your drug cartels is an oil cartel. What does an oil cartel do is, it controls all production and all prices. Out of the 85%, which makes us actually the third biggest oil importer in the world, out of that 85%, 80% of all imports were coming from OPEC companies. And now, in the gist of this article, what we have seen is that there is an 8% drop in the share of OPEC companies, and we have moved more towards Canadian and USA oil. But why is it? Why have we moved away from OPEC companies to Canadian and USA oil, or United States of America, which is giving us now a better share of oil? This can be understood through the concept of contracts. See, what happens in OPC is very simple. When India goes to the OPEC in Vienna, it says that we need, and hypothetically, we need 100 barrels of oil for the whole year. So there's a fixed contract which is signed between the OPEC companies and India. And what happens is that they say that you tell us month by month how much you need. Some months you will need more, some months you will need less. So what we say that in January we need 10, 20 barrels, then we need 10 barrels. What the OPEC does is, see, you need to understand, oil prices go up and down. They go up and down according to supply and demand. But what the OPEC does is, because it knows that it has to give India 100 barrels, it starts to manipulate the prices. It starts to manipulate the prices in such a way that even though oil has gone down, they will say that there's a supply issue and they're going to bring it up to the same level. What this does is, this is disadvantageous to us. Why? For a very, very simple reason, because we don't have price flexibility. And even when there's a major drop in oil prices, which happened in the heart of in June, July last year, when you had minus $0.8 was the price of the USA oil, we were not able to take advantage of it, because 80% is controlled by them, and they will make sure that even though there's a drop in the prices, we get the same cost for the oil. So what India has done, and what now India is doing, is moving away from OPEC companies, specifically OPEC countries, specifically the West African and African countries, and we are going to what we call as open and spot markets. What happens is, in spot markets, if we want 10 or 20 barrels, hypothetically, we have millions of barrels, but we're talking about in quantifiable terms. If we want 10 or 15 barrels, rather than going to the OPEC companies, we are going to the spot market, which is selling Canadian and USA oil. What we do then is, we are able to get an advantageous deal. So rather than always going to the OPEC companies buying for $10 a barrel, when it is $5 a barrel, we go to the spot market for Canadian and USA oil, and we get more than what we need. And this is a trend which has now started. And now we can quantify that trend by this article, which is now giving us a very, very good understanding of what is the geographical shift. So for your examination, again, UPSC, it's about smart study, what to read, what not to read, and it's about knowing what to come. So the data itself is irrelevant. The point is that what is the trend? What is the trend? What we are seeing is that a trend where we have gone to a 6-year low, where we have shrank by 11.8%, 11.8%, the less demand for this year. Obviously, this is not because we are able to produce more. This is shrinkage in our imports. 11.8% generally because of the COVID-19 pandemic. You and me both are stuck in our houses. We are not using our cars. The issue of price rise and the price of oil is a different issue altogether, because therein the excise duty and the sales tax of the states and the center coming, that is a different story altogether. But the point is that this 11.8% shrinkage is not because of natural causes, but because of the shrinkage of demand due to COVID-19. But what is equally important and more important is that we have seen that from 80% we have gone to 72% mark or share of West African and African countries, and we are moving towards USA and Canadian oil with a further increase. So this has been this shift away. 11.8% has been shrinkage, but we have geographically also moved. So in this, what you need to understand is very, very simple. What is OPEC? You already know what it is. How do they run this market? They run this market through contracts, and these contracts are annual contracts, and what they do is they manipulate prices. They manipulate prices. This manipulation of prices is then disadvantageous to countries like India, which are getting most of their oil through imports. So we are moving away from African and West African, specifically OPEC supply, to more towards American and Canadian. Generally, so as to give you a summary, there has been a decrease of 11.8% in our demand in our import itself, but that is artificial. It will go back to itself when we are coming out of the COVID-19 or the second lockdown itself. But the point is that this shrinkage has impacted the share of the OPEC companies from 80% to 72%, and the American and the Canadian percent is moving. Why? Because these we get to spot markets and markets which are related to, which give you price flexibility. So in the examination, this can come as a question both in a way of a trend question in PT, that our oil demand has been steadily increasing. No, it hasn't. It has just gone down. Second, in the main examination, there will be a question which talks about what is the general trend of our oil imports and how we are trying to change it. I've been trying to give you the basic static issue of it. How do we get our oil? And then the second issue is what is the new trend. So the first article talked about GST, economic revival. This article is now talking about what we get to know about oil. What was the trend? Now let's get into the next topic. Some of you would say, why are we studying vegetable oil? But trend-based questions have become the mainstay and are becoming very, very important in the examination. When it comes to PT and even when it comes to mains examination, they're asking you statement-based question on trends. So any sector where you see some form of variation, either shrinkage or growth or geographical variation is very, very important. You keep this in your mind. I'm giving you this understanding that any trend-based sector, that is why you always read economic survey also. Any trends has become very, very important, because in 2018 also, 2019 also, there were two questions which were talking about trends either of vegetable oil, they were talking about generally export trends, import trends. So with that, let's try to understand what we're talking about. We're talking about edible oil, we talked about crude oil and petroleum under OPEC, now we're talking about an oil which is connected to both you and me. Most probably we are having that right now as we're looking at this video. But the point is that we have seen a new trend. Giving the gist generally before going into the specificities is that India is the largest edible oil importer. And this is technically the irony, because we are one of the largest producers of oilseeds also. But somehow our oilseed demand is not meeting with whatever we are producing, and close to 96% of all oil is actually imported. India has the second biggest market for oil after China. Remember, for edible oil, the second biggest market, but this biggest importer when it comes to edible oil. Remember this point, it is the biggest importer of edible oil. So any data related to it is very, very important. What we saw was in 2019, 2020, we saw a shrinkage of minus 13%. Remember this point again very, very simply, because if there's a question which says that there has been a steady increase in the edible oil imports in India, then it is wrong. It is wrong because 2019, 2020, even before COVID-19 had come, there was already a shrinkage. But this article is important for two reasons. Very, very simple reasons is that we have seen there's a rise of 32% in April. Remember, it's only for April. Over and above, in 2020-21, we saw only 1.6 to 1.7% increase. But April saw a major boom, and that was because there was a new law which was coming into being in Malaysia, which did not allow exports, so we were able to be importing more. But there are two things. First, you need to understand crude palm oil understanding. Then you need to understand what you mean by soft oil and general trend. When you look at the general trend, when you look at the general trend taken by the government of India source, we are seeing that there's an increase. So there was a decrease of minus 13% in the last fiscal. In this fiscal, over and above 2019-2020, we are seeing 17% rise. So this is significant. That there is a rise of 1.7% over and above 2019-2020, and this 13% was for 2018, 2019, 2019, 2020. So there was a decrease of minus 13%. But now we see a rise. But the rise is not uniform. There is a major 32% uptick in April of 2021 in comparison to, remember, in comparison to 2019-2020. Remember this point. It is in comparison to. But generally, over and above, there is 1.7%. So in the examination, please be wary of the term. If it says that there has been an exponential increase in April, then it is correct, because there is an exponential increase. But if it says that there is an exponential increase in our oil imports in the past 2 years, then the statement is incorrect. There has been a steady or minimal increase, 7.7% only. But if it says that there has been a steady increase for the past 3 years, no, there was a decrease of minus 13%. So we shrank, and the shrinkage was generally because of the way the demand was. But you would have noticed one more thing is that soybean oil and sunflower oil has become very, very expensive. So first is this metadata. The metadata is that there is an increase of 1.7% over and above the last two cycles, which is November to April 2019-20 and 2020-21. This is the way. There's a Solvent Extractors Association. This is why this says C of India. Solvent Extraction of India. This is the government of India arm which looks at this data. If you will read this article, you can get confused how they're talking about 32% increase or 1.7% increase. 1.7% increase is with the last cycle. 32% increase is specific to April itself. But what is more important is that there is a geographical shift. when it comes to palm oil. So now I'm going to the second part of it, where what I'm trying to tell you is that you need to remember these country names because it will help you in any examination. UPSC for sure, but for any examination this can come. When it comes to crude palm oil, what do we use it for? Palm oil is used in everything. Generally for cooking also it is used in edible oil, confectionaries, cakes, everything used. Palm oil is used. What we are seeing is that there's a movement away from Indonesia to Malaysia. From Indonesia to Malaysia, remember this one. It says Malaysian palm oil gains over Indonesian oil. And this is because of the geopolitics of that region where we are getting Malaysian oil at a cheaper cost. So when it comes to palm oil, forget the data. Remember that Indonesia and Malaysia are the two important countries that are important. But over and above that, now there's a movement away from, like there was a movement away from OPEC companies, there's a movement away from Indonesia towards Malaysia. But is the growth in the edible oil sector homogeneous? Are all sectors seeing a rise? No. There's a dip in what are called soft oils. And remember this word because it can come in the main examination that the soft oil import of India or export of India gives a standard something trend and then they elaborate. There can easily be a question like this. It is encouraging to see that the import of soft oil has dipped. Elaborate. Now the point is that what are soft oils? Soft oils are over and above that I show you all the oils, but two soft oils are actually soya, sunflower and soybean. Remember this, sunflower and soybean are considered soft oils and there has actually been a decrease. See, 1.7% increase. But the internally there is no homogeneity, there is heterogeneity. The heterogeneity is that sunflower oil and soybean oil have actually gone down. Have actually gone down because of the high prices and that you and me already know that anything which was for 100 rupees per liter has now gone to 150 per liter. This is generally linked to geopolitical context and the import thing. But the point is that there is a decrease. There is a decrease in import because we are discouraged by the prices of edible oil. But again, when it comes to soybean oil, remember the main country from which we are taking it is actually Argentina. It's actually Argentina. And when we talk about crude soybean, we are talking about Argentina. And when we talk about sunflower oil, it is Ukraine, Russia, and Argentina. See, I'll show you the data itself, and this will give you a better understanding. See, these are the countries through which we are getting these oils. When you look at sunflower oil, you can easily see that Ukraine is first, then you have Russia which is second, and then you have Argentina which is third. But when you look at soybean oil, Argentina is the biggest importer for us. Again, I'm giving you a trend based question. You can easily understand how they can make a question. You have to always think like an examiner. When you're looking at this, you can easily understand that they can give you either to arrange them in decreasing or increasing order, or generally ask you one statement question which is the biggest. And when it comes to palm oil, you can see that there has been a movement. Malaysia is now 19,000 and Indonesia only 49,900. Over and above, the data shows that there is increase, but there is internal heterogeneity. And you can see refined oils include refined sunflower oil, palm olive oil, and soybean oil. In the soft ones, we have soybean, rapeseed oil, sunflower oil, coconut oil, and coconut refined, and then you have crude also. See, I'm not expecting you to remember all these things. What I want you to remember is two things: that Ukraine, Russia, Argentina for sunflower. Because see, what UPSC does is ask questions for everyday life. Sunflower we all use, soybean oil we all use. We need to know the trends in this, and this can easily get you one question that could be the difference between clearing prelims or not clearing prelims. And when it comes to soybean, Argentina, remember Argentina, Russia, Ukraine are generally important for soft oils. When it comes to Malaysia and Indonesia, it is important for palm oil. But we have Brazil, Canada, Egypt, Saudi Arabia, South Africa, Taiwan, Thailand, Turkey, USA. As I said, don't expect to remember all of these things, but just I want you to remember is Indonesia and Malaysia and movement away from Indonesia towards Malaysia, and Argentina, Russia, and Ukraine and their share. This article is also saying here. And last but not the least is non-edible oils which are used for soap and lathering purposes. In that import, there has been a period, it has actually gone a little bit down, but has been used generally. It was initially in 2019, 2020 it was down, and now it has gone from 126 million tons. It has now become at 158. So it's very small increase, but non-edible oils is not important to us. So generally, in this article, what are the 3 4 important things which you need to remember? First, remember these things are important. Why? Because trend-based questions are coming. Second, we are the largest importer of edible oils. Third is that there are heterogeneity within the data itself. We have increased, there's an uptick from -13% to now plus 1.7%. But within that, there's a lot of heterogeneity, a geographical movement away from Indonesia to Malaysia. And when it comes to soft oils, Argentina still stands there. Then Ukraine, Russia, and Argentina. And when it comes to non-edible oils, which are used for, as it says, whole chemical industries or soap, it has increased marginally, which was decreasing last year. This is the trend-based question again. It had decreased last year, has now increased again to 1.58, 158,000 tons. Remember these trends. Remember these countries. It's always available to you on YouTube. The point is that trends are important, countries are important, and generally the ranking is important.
Let's go to the next article here, RODTEP. Right now, in the earlier videos, we've already discussed what is the concept of RODTEP. But much more important, right, apart from RODTEP in this particular article was another scheme, ROSCTL. And very recently, if you have been reading the newspaper, Government of India had put very big advertisements in many of these particular national dailies, stating that this particular scheme has been extended. Is it okay? The Government of India says that this particular scheme has been extended. Now, what is this particular scheme that I'm referring to? ROSCTL. Please understand, this particular scheme stands for Remission of State and Central Taxes and Levies. Is it okay? I'll repeat the expansion of the acronym. Remission of State and Central Taxes and Levies. Now, what is the objective here? What is the concept? Understand the concept very carefully. Be it RODTEP or ROSCTL, both of them will basically provide a rebate of embedded taxes. This is the technical term. Now, what do you mean by embedded taxes? For this, when you are a manufacturer, apart from paying some of the taxes, let's say in the form of import duties, in the form of GST, excise, etc., you're also going to pay some other taxes which are not rebated, which are not given back. Because any tax a manufacturer pays has to be given back to him. That's the idea of input tax credit. If it is not rebated, manufacturer essentially what will do? He will transfer it in the form of market prices. That is, if these particular input taxes are not given back to him, right, he will simply transfer it when he decides what should be the market price. Now, have a look at this. Under these particular embedded taxes, examples are the duties that these particular manufacturers will pay on, let's say, fuels that are used for transportation. Some of the duties that they pay for consumption of electricity, so on and so forth. These kinds of duties or charges or taxes which are paid by the manufacturer are not refunded by the government. So what will the manufacturer do? When he decides the market price or the selling price, he will simply add these charges in the market price. Now, what will be the problem with this? The problem is when he will add it to market prices, the market price of the goods will increase. For example, there are textile exports done from India. There are apparel exports done from India. Okay, so these kinds of exports, don't you think in the international market they become more costlier and less competitive? So what Government of India basically did was, in order to provide certain relief to these kinds of exporters, that is the apparel exporters, right, the made-up sectors, so on and so forth, to provide certain relief to these kinds of exporters, government, right, that is Ministry of Textiles, in 2016 introduced a scheme called as ROSL, rebate of state levies. Right, it was initially only state levies, same concept. Embedded taxes will be rebated to the exporters so that the textiles will become very competitive in the international market. Now, in 2019, follow this, in 2019, the same scheme was revamped and named ROSCTL. That is, will not only give a rebate of the state levies or taxes, will also provide a rebate for the embedded taxes which are at the central level. And it was stated in the beginning that in a couple of the months itself, this will be merged with RODTEP. Is it okay? This will basically be merged with another scheme, RODTEP. Now, Government of India says, no, we are not going to merge this particular scheme under RODTEP. It is going to be continued for 3 more years as a separate scheme itself. Is it okay? This will be continued as a separate scheme. Now, what is the advantage with this particular expansion or extension of a particular scheme? Understand this, as such, under RODTEP, already there are various concerns for the exporters. Right? What is the concern? You are an exporter, you need to get rebates under RODTEP scheme, that is a remission of duties and tariffs on exports of products. Government of India so far has not notified the rates at which the rebates will be provided. First one. Second one, because government has not notified the rates of the rebates, this has created certain uncertainty among the exporters. Third one, if you bring more sectors under ROTTP and allocate the limited amount of funding for this particular scheme, don't you think that will create more competition? That will basically ensure, or it will take to a situation wherein amount of refunds or amount of rebate or the allocation for this particular scheme will not be sufficient. So very recently, Government of India stated, no, we are not going to merge this particular scheme under ROTTP. This is going to be run separately itself, and this is expected to provide a certain relief to the exporters who are going to be covered under ROTTP. Now, next important point: all the textiles are not covered under this particular scheme. Is it okay? All the textiles are not covered under this particular scheme. Apparel is there, made up is there, garments is there. That is, these three are covered. Now, apart from this, any other textiles, if they want to get a rebate, they can be covered under ROTTP. And these three, that is apparels, garments, as well as the made-ups, which are already covered under ROSSTL, these exporters will not be getting any rebate under ROTTP. Then, this is another very important change or important announcement that has been done by the Government of India. So, this is a discussion provided here. Based on this, I've given a question here. First one, consider the following statements regarding ROSSTL. Scheme was notified by the Ministry of Textiles and implemented by the Department of Revenue. Statement is correct. I've only given the first part of the statement. Yes, scheme was actually announced by the Ministry of Textiles, but notifying the rate, providing the scripts under this, right, everything will be done by the Department of Revenue. Under this, the embedded taxes are rebated. I've already discussed what is the meaning of embedded taxes, and yes, embedded taxes are actually rebated under this particular scheme. Both the statements are true. Right option is option C, both 1 and 2. Next article is related to India's tariff. Now, understand this? Many of the times these particular arguments will come in the newspaper, or even a question can be asked in the UPSC prelims or mains. What kind of questions? For example, I might give you a trend statement saying that in the last 5 years, the tariffs imposed by the Government of India on the imports have actually increased, and we will analyze this. Don't worry. Or else, in the UPSC means they might give a question, right, saying that the policy of import substitution, right, is going back before the LPG reforms. Evaluate, elaborate. So these kinds of statements also can be given in the means. Now, please understand this. I'll be using two terms here. One, paid weighted average tariff, and the second one is a simple average tariff. And first and foremost, what is the tariff in this particular context? India is importing the goods. What is the tax or what is the customs or import duty that is imposed by the government on these particular imports? That is the concept of a tariff here. Now, what is the basic idea of a simple average tariff? All the tariffs that you have imposed, get the sum total of it and divided by the number of tariffs that you have. That will give you simple average. But in addition to this, there is also a concept of a trade weighted average tariff. The meaning of that is the total amount of revenue that you have generated, right, through these particular tariffs will be considered, and that is how you get the concept of a trade weighted average here. Then, so how will you get this particular graph here? The tariffs which are imposed by the government, the average, simple average tariff, have actually declined as per the W2 report for the year 2020. And as per this particular report, the decline is from 17.6% in 2019 to 15% in 2020. And what is more important is this particular decline is one of the highest in the last decade. Again, I'm saying the percentage decline is the highest in the last decade as such. Having said so, this particular 15% rate is much higher than what it was back in the year 2014, which was 13.5%. With respect to weighted averages, that is the trade weighted averages, it has fallen down to 7% for 2019, and a year earlier it was more than 10%. So if the question is, let's say, based on the trend, you'll realize that in the last 5 years, neither it has continuously increased, nor it has continuously declined. Right? There is a zigzag shape or there is a volatility here. Now, what is the importance of this particular article? First and foremost, please understand, Government of India in the last couple of years has been following the concept of import substitution policy or self-reliant India, Atmanirbhar Bharat. There are certain experts who are supporting this, but there are also counter arguments with respect to this particular policy of the government. For example, Pharmacy here basically states that if any country has to move from a developing country to a developed country, it cannot have a very high amount of customs tariffs. You'll have to throw open this particular market, reduce your customs, so that international market or international competitors will start competing with the domestic manufacturers. The idea here is, if you want to start a promotion of exports, and please understand, exports are very, very important for any economy to become a developed economy, because you can achieve higher GDP by producing and selling within the domestic market and selling outside India also. But the argument here is, what is the demand within India is comparatively lower compared to how much demand you can generate in the rest of the world. Is the argument okay here? In the rest of the world, if your exports are very competitive, you will get much higher demand in the rest of the world compared to what demand you can generate within the domestic market. So in order to achieve that, you have to ensure that your manufacturers are competitive. And not to ensure that your manufacturers are competitive, you have to ensure that these will start competing with the other manufacturers. And you can only ensure this particular competition if you allow the imports to come into India. Having said so, it doesn't mean that the government should not impose any tariff. As per the experts, they basically say that if government has somewhere in the range of 8 to 10% tariffs on industrial imports, that should promote the domestic manufacturing and become more and more competitive. That is the point to understand here. But beyond this, what are the other points here? Right? Please understand this. Government of India, in addition to approaching the concept of self-reliant India, the increase in the tariffs was also a result of the protectionist policies which were followed by other countries such as China, USA, etc. Right? In the last couple of years, we have seen that the tariff walls or the tariffs which are imposed by these particular trading partners also kept on increasing. So in order to protect our own interest, the Government of India increased these particular tariffs. Next point, when we increase the tariffs, the same trading partners such as USA accused India of being a tariff king. For example, the previous president, the former president of USA, Mr. Donald Trump, usually used to keep on hugging accusations against India's tariffs, and he kept on saying that India is a tariff king, right, forgetting that even his country's tariffs have been increased during his presidential reign as such. So understand this. Keeping in mind our own protectionist trends or to protect our interest, when these particular trading partners started increasing the tariffs, we also increased the tariffs. But in recent times, these particular tariffs have come down, which experts say is a very good sign. Having said so, understand this, even when these particular tariffs were higher at this particular level, Government of India protected or basically put forward certain arguments right, in order to basically defend itself. The two important arguments, you have to remember this, and if at all a question is there in UPSC, please mention these particular arguments. One, please understand, under the concept of a WTO, right, there is the idea of a bound rate. What do you mean the bound rate? Bound rate essentially means, right, under WTO, because you remember, what would be the maximum tariff rate or the customs that you are allowed to impose? Is okay? The bound rate essentially means what is the maximum rate of a tariff you can impose being a part of WTO. For the year 2019, the bound rate was 50.8%, not for 2019, just mention 2020. For 2020, the bound rate was 50.8%. So Government of India says, have a look at this. The bound rate that was applicable to us was 50.8%, but the tariffs that were imposed are much lower than that. Right? So you don't have to accuse us of having very high tariffs. Second argument, Government of India says that other developed economies, whenever they want to control the imports of non-essential items, they generally use non-tariff barriers. Is it okay? They generally use a lot of these non-tariff barriers. Right? Government says that Indian government says we are not doing this. Right? Very often we are not using these non-tariff barriers. We use it very rarely to control the import of non-essential items. So we are not violating any of the WTO norms with respect to having this tariff policy. So these are certain points that we need to understand with respect to this decline in India's tariffs for the year 2020. Now based on this, I give a question here. Average tariffs by Indian government on imports has been increasing steadily in the last 5 years, statement is wrong. Weighted average tariffs by Indian government on imports has been increasing steadily in the last 5 years. Again, the statement is wrong. Right? In some years it has increased, some years it has declined. Right? So steadily neither increased nor decreased. So both the statements are wrong. So right option is option D, neither one nor two. Let's go to the next article. FTP aims to increase exports to $1 trillion by financial 26. Now let's basically break up these particular terms. First, what is FTP? FTP stands for foreign trade policy. Once every 5 years, government will basically come out with a trade policy under which various targets are set up, various schemes are introduced, various policy measures are taken, all of them only to achieve promotion of exports. We had a policy from 2009 to 14. We have a policy from 2015 to 20. I'm using the term have for a simple reason. The policy should have ended in 2020, 31st March 2020, because of the pandemic. Government of India extended the application of this particular policy, and as per the latest information, the new FTP, right, foreign trade policy, will become effective from 1st October 2021. Again, it is just right, a piece of news. Whether it is going to be implemented midway in a financial year or government will decide let's go to the next financial year, you have to wait and see. But anyways, what is important here? Under this particular foreign trade policy, 2015 to 2020, which has been extended, government of India has set up a target of a promotion of $900 billion exports annually. Is okay? We have set up a target of $900 billion worth of exports annually. Have we achieved this? Right? Absolutely no. We have not been able to achieve or reach this particular target of $900 billion annually. The highest we have been able to achieve has been around $538 billion in the year 18 and 19. And for majority period of the times in the last 9 years, the value of the exports which have been done from India to rest of the world have been in the range of around $280 billion to $350 billion. Now the argument which has been put forward here is for this particular financial year, that is 2022, government of India set up a target of a promotion of $400 billion worth of exports. And already 1/3 of this has been achieved in the first 3 months itself. So government of India is very hopeful of achieving this particular target of $400 billion in financial 22 and basically expanding this to $1 trillion by 2026, which is supposed to be the period for the next foreign trade policy. Now various experts have pointed out that ambitious target. This is an ambitious target for a simple reason. If I move from right this level of, let's say, right, the 400 billion, right, around 400 billion to, let's say, $1 trillion in this time period, the compounded annual growth rate that the exports will have to achieve is around 15%. But if you see what has been the compounded annual growth rate, that is CAGR, for the 5-year duration, 2015 to 2020, it has not been more than 5%. So for last 5 years, forgetting the pandemic period, the growth rate, right, the compounded annual growth rate in case of exports has been around 5%. And now we want to achieve $1 trillion with a compounded annual growth rate of 15%. Right, there are certain questions or the concerns raised with respect to this particular target. Government of India says we are hopeful because of certain things that are happening in the economy. What are the things? One, the commodity prices in the international market are increasing. Is okay? Commodity prices. Just example, the steel prices. Now, what is the importance of the commodity prices? Please understand, commodities, for example, steel is a very important raw material. And whenever the demand for steel increases, it essentially means that there is a lot of industrial activity that is taking place. And when there is a lot of industrial activity, this is generally connected to higher production, higher growth rate, etc. So one, commodity prices are increasing. Right? We are hopeful that this will help us out. Second, the total global demand is also increasing, and we want to basically satisfy some of this demand by exporting more and more. And the third reason that has been provided by the government is the PLI scheme, production linked incentive scheme, is expected to provide benefits and improve the production that is basically manufactured in the domestic market. So because of these three reasons, right, we are hopeful of achieving this particular target of $1 trillion worth of exports by 2026. However, please understand there are certain structural issues also that government needs to address in order to achieve this particular target. What are the structural issues? One, government of India needs to enter into multiple trading agreements with other countries. Because please understand, until last year there was this particular discussion that we would be part of RCEP, which was supposed to have 16 members. Ultimately, we said we do not want to be part of RCEP, and that was a very important group or block as such for the sheer size of the potential market that would be getting access to. Now we have decided no, we won't be part of it. But that doesn't mean that, right, nothing else can be done by the government. We can enter into agreements with other countries, such as we are holding FTAs with that is a free trade agreement negotiations with the UK. We are holding that with the European Union. We are also conducting that with even bilateral agreement with the USA. So more and more agreements, trade agreements should be entered into by the government in order to basically provide more market for India's exports. Second, there are certain issues with respect to taxation. For example, whenever we are talking about exports, we talk about embedded taxes. Yes, government of India has implemented RODTEP, ROSCTL in order to provide the remission of embedded taxes, but the RODTEP scheme, the rates have not yet been notified. So these particular rates should be notified, which will give certain clarity to the exporters as to at what price they should sell this exports in the international market. So these are some of the structural issues. Now, one more point, the issue of logistics. You cannot basically finish the discussion on exports without talking about logistics in India. Please understand, logistics is a very important part and parcel which contributes to what is the final price of the product in the market. In case of India, one of the reasons Indian exports are not very competitive, underline the term, are not very competitive in the international market, is because of cost of logistics. Right? The cost of logistics in case of India is around 13% of GDP, whereas in case of other developed economies, if you see that, it is generally in a lower single digit number in the range of, let's say, 6% or 8% like this. That's the precise reason. Very recently, there has been a lot of discussion within the government, and there is an expectation that government will come out with a logistics draft under which they want to reduce this particular cost of logistics from 13% to 8%, so that the cost of logistics will come down, the cost which will get added to the market or selling price will come down, the domestic goods, right, comparatively will become cheaper, and even our exports, the cost will obviously become lower, and exports will become very, very competitive in the international market. So these are some of the points in regards to this particular article of the new foreign trade policy. One of the schemes, right, government of India is looking into extension of this particular scheme. The name of the scheme is Interest Equalization Scheme, IES. Now the important points here, this particular interest equalization scheme was announced by the government as a part of Foreign Trade Policy 2015-2020. Is okay? It was announced as a part of Foreign Trade Policy 2015-2020, which has been extended now. Second important point, this particular scheme should have ended right in the year 2020 itself. There is a financial year 2020. Government of India has kept on extending this. Very recently in the current year itself, this particular scheme has been extended 2 times, every time by 3 months like this. Now what is the problem with respect to this? The problem with respect to this kind of an extension is, under this particular scheme, the exporters, is okay, the exporters are generally provided with an interest subvention. Is okay, they're provided with interest subvention in the range of 3 to 5%, either based on a pre-export or post-export credit shipment. On this particular credit which is used for shipment purposes, the government generally provides interest subvention of either 3% or 5%. What's the meaning of this? Imagine, right, you are an exporter, you take a loan for shipment purposes, and the rate of interest applicable, let's say an arbitrary number, is 10%. Under this particular scheme, if you are covered, basically government says, although the rate of interest applicable is 10%, you don't have to pay 10%. Imagine you will get an interest subvention of 5% here, so effectively you will pay 5%, and the remaining 5% of the interest is actually paid by the government to the bank. Is okay? This is how this interest equalization scheme actually functions. Under this, the exports are done by MSME sector are covered, and apart from this, 416 identified products, even though they are exported by someone else, from MSME, those particular shipments will also be covered. Now, the problem with respect to this is, if you are an exporter, you do not know whether the government is going to extend the scheme, right, again in the month of October or not, right? Even if it is extended by 3 months, what will happen after December? There is uncertainty with respect to this, and whenever there is uncertainty, it will create certain problem with respect to how should you price your exports? Should you price it at this particular dollar? Should you price it at this particular dollar? Because based on the interest that you are getting in the form of subvention, right, you will decide what is your cost of shipment, and that will determine what will be your export pricing. Now, this kind of uncertainty will create certain problems with respect to pricing of the exports. So, this article says that government is looking into extending this scheme by 3 to 5 years, so that there is certainty created. It will also help the exporters to price their exports and enter into agreements with the international trade partners as such. So, this is the discussion with respect to this particular article here. Next question, the scale committee. Okay. Scale committee, scale basically stands for the steering committee for advancing local value added and exports. Please understand the points here. This particular committee was set up by Ministry of Commerce. First point. This particular committee was set up by Ministry of Commerce, or else in the newspaper they simply say it is a government backed committee. Okay, first point. Second, this was headed by B.K. Goenka. Okay, it was headed by B.K. Goenka. Now, what are the important points with respect to the recommendations here? That should be your focus. First, very important point. It has given a framework which will basically help the government of India in doubling the exports in the next 5 years. Is okay? Doubling of exports in the next 5 years. First, very important recommendation. Second, it is also given recommendations which will help the government of India in reducing the imports by 2/3. Is okay? It will help the government of India in reducing the imports by 2/3 of the current value. And why this is important? Please understand. Every year, government of India sets up a target of promotion of exports from the domestic market to international market, and they focus on merchandise exports here. And most of the times, what happens is the target which has been set up is very, very ambitious or very, very high, and we fail in meeting this particular target. For example, foreign trade policy of 2015 to 2020. Under this, we set up a target of $900 billion worth of exports, right, annually, and we have not been able to achieve that. And for the current financial year itself, government of India set up a target of a promotion of merchandise exports worth $400 billion from India to the rest of the world. And based on the recent data, we are on the way to meet this particular target. Whether we are going to achieve it or not, we'll have to wait and see. So, argument here is one: India is a net importer, and this will lead to higher dependence on imports, outflow of forex reserves, and in terms of exports, we are not been able to achieve these particular targets. So, this committee has identified 24 priority sectors. Is okay? It has identified 24 priority sectors, and each of these particular sectors, it has given a recommendation to government of India as to what government of India has to do with respect to these particular sectors in order to one, double the exports from India to rest of the world in next 5 years, reduce the value of imports by 2/3, and third, please understand the rate of growth of consumption, the domestic consumption, the growth rate of this particular consumption in the domestic market is somewhere around 7%, and the committee has given a recommendation to government of India so that it will increase to 9%. And what's important here, when there is a higher growth rate in terms of consumption, there is domestic consumption, which essentially means that there will be higher demand for goods and services in the domestic market, and this will help in these particular industries or sectors in producing more, creating more employment, and also contributing more to the GDP growth rate of India. Right? And the committee says that if we achieve all of these, all of these three, what are these three? One, doubling of exports, reducing the value of imports by 2/3, and basically increasing the domestic consumption growth rate from 7% to 9%. If we are able to do that, then this committee says that in the next couple of years, the domestic value addition will increase by $350 to $390 billion. Is okay? The overall domestic value addition or the GDP will increase by this particular amount. Right? So this has been the recommendation which has been given by this particular committee. In addition to this, the committee also observes that in case of India, have a look at this. In case of India, we are promoting merchandise goods, right, in terms of exports, and we are also promoting the services as such. But out of the total value of exports that we have done for the year 2019, out of the total value of exports, the service as well as the merchandise, that is the goods, the merchandise accounts for 43% of this. The merchandise exports accounts for 43% of this. If you look at the same type of a composition in other countries, right, the contribution to the merchandise exports is much higher. For example, as per the data provided here, in case of Vietnam, it is more than 70%. In case of Malaysia, right, in case of Malaysia, it is 56%, and so on and so forth. Again, you don't have to mug up this particular data. In essence, what they're saying is there's a huge scope of a promotion of these particular merchandise exports from India. Will have to increase this particular contribution, and which will essentially ensure that the overall exports from India will increase. Okay, so these are some of the important points with respect to this article. Next, two articles are related to the trade agreements or the trade negotiations that are happening between India and other countries. One trade negotiation or the agreement negotiation is happening between India and the UK. And the article discusses this, and the next article is between India and Australia, where also trade negotiations are taking place. Now, the important points provided in this article. First, the article basically says that both the countries are going to get the benefit if at all there is a free trade agreement which is signed by both the countries. And please understand, the UK as a trade partner is very, very important for India for a simple reason. The overall trade between both of these countries in the last couple of years has been booming. That is the one point. Next important point. The article says that though both the countries are going to get the benefit, it is the other party, that is UK, which will get more benefit compared to India. How so? Have a look at this. India will export the goods and services to UK, and the UK in return will export goods and services to India. So what is the average tariff rate that is imposed by UK on India's exports? It is just around 4.2%. It is just around 4.2%. And when UK exports these particular commodities to India on an average charges around 14.6%. First point. Second point. Majority of India's exports do not attract any tariff, right, by UK. Is it okay? I'll repeat it. Majority of India's exports which will land into UK do not attract any tariff. Around 66% of India's exports to UK do not get or do not attract any kind of a tariff. And on the other hand, only around 3% of the exports done by UK to India do not enjoy any tariff. Now, how do I say based on these particular facts that UK's exports will get a better bargain if an FTA is signed up? Whenever an FTA, that is free trade agreement, is signed, both the countries will come together and they will decide on what goods and services will reduce the tariff or eliminate the tariff. Now, have a look at this. UK's exports in case of India are attracting a very high amount of tariff. So obviously India will be forced to reduce this particular tariff by a larger margin compared to what UK will be forced to. And that's the precise reason when these particular tariffs are going to come down and more products will start enjoying a better tariff structure that is either exempted or very low tariffs that will basically promote more and more exports from UK's exporters to India. And that is what is mentioned in this particular article. So because of this particular agreement, it says that UK's exporters may get a better margin compared to India's exporters. So this is the gist of the article provided here. Beyond this, a lot of information, data has been provided. Please don't worry about that particular data. Next important article in terms of trade agreements and negotiations are between India and Australia. Right, couple of important points. India and Australia are negotiating a very comprehensive economic cooperation agreement, CECA, Comprehensive Economic Cooperation Agreement. And before this particular agreement is negotiated and signed, many of rounds of negotiations or talks have happened so far. We are expecting the early harvest trade pact by December. Okay, before the agreement is signed, we are expecting an early harvest trade pact by end of the December current year. And what is the idea of early harvest? That is what is the important point. Beyond this, don't read anything from this particular article. Early harvest essentially means before signing a broader agreement, before signing bigger agreements such as FTAs, CECAs, etc., both these particular countries will enter into a small type of an agreement or a pact, which is called as a early harvest trade pact. And the early harvest trade pact is a gateway to a bigger agreement. Is okay? Right? A bigger agreement later will be signed. But before signing a bigger agreement, both the countries are coming together and are coming to certain agreements or arrangements with respect to reductions in the tariffs. And that pact is called as an early harvest trade pact. And when you sign an early harvest trade pact, further negotiations will take place. Already you have negotiated, implemented certain tariff exemptions or tariff reductions, which your exporters will start enjoying or getting the benefit of. Later, a bigger agreement in the form of a CECA, FTAs, etc. are signed. That is the important point mentioned here. Beyond this, please do not bother anything from this particular article. Next article. One district, one product. ODOP. One district, one product. It was the concept of one district, one product. Have a look at this. Government of India, one, wants to promote exports from India to the rest of the world. Is okay? For example, for the current financial year, Government of India has set up a target of $400 billion worth of exports. Right? Whether we'll achieve it or not, we'll have to wait and see. But essentially, right, we want to promote exports. First point. Second, we want to promote entrepreneurship. Right? And for this, government has taken various measures. We want to promote industrialization. We want to address the regional imbalances which are present in India. We also want to ensure that all the districts in India will be promoted in terms of development. So, in achieving all of this, one scheme that will be utilized by Government of India will be one district to one product. Under the concept of one district to one product, all the 700 plus districts in India, right, will be looked into, or the focus will be all the 739 districts, and each of the districts, we are going to identify one product each. Is okay? In each of these districts, we are going to identify at least one product each, and the export potential of this particular product will be leveraged. What do you mean by this? The product which is going to be identified, we are going to promote the production of the product, and we are going to promote the export of this particular product. And if there is any issue with respect to the supply chain, is okay? Any issue with respect to supply chain of this particular product, it will be addressed under this particular one district, one product scheme. Now, what do you mean by issue with respect to supply chain? If you want to export any product, what are the characteristics or what are the features of a supply chain? One, you have to procure it, you have to produce it, you have to logistically, right, move it from one point to another point. You have to find an exporter in the international market. If there is any advice that is needed for production, that also can be provided. So whenever we talk about supply chain, all of these activities are involved. So under one district, one product, the Government of India says that we are going to promote right, the production of these particular goods or commodities in these particular districts. We are going to address the issue of regional imbalances. If there are any issues with respect to finding a buyer in the international market, if the producer wants any kind of an assistance or an advice, if there are any issues with respect to logistics of this particular product, all of these particular issues we will try and address under this particular one district, one product scheme. And if you can do all of these, if you can achieve all of this, please understand, it will be basically movement towards the concept of Atmanirbhar Bharat. It will help the Government of India in moving towards the achievement of Atmanirbhar Bharat. That is one more very important objective we want to achieve under the concept of ODOP. Now, this particular scheme is being implemented by Ministry of Commerce. First point, it is being implemented by Ministry of Commerce. Second, in each of these particular districts, that is 730 plus districts, we want to identify at least one product which has an export potential. Third, this particular scheme so far, understand this, under this particular scheme so far, 106 items have been identified from 103 districts. Okay, over 100 items out of right, over 100 districts have been identified for right, one district to one product scheme. So these are some of the very, very important points in the context of ODOP scheme. Rising shipping cost or rising freight cost. And in the last 2 weeks, there's been a lot of discussion with respect to rising freight cost. Let's find out what is the issue here. India has set up a target of exporting merchandise worth $400 billion for the current financial year. For financial year 22, you have set up a very ambitious target of having the merchandise exports worth $400 billion. And these merchandise will have to move from India to the rest of the world either through port or through airport. And most of the trade that India conducts, most of the trade, more than 90% by volume of the trade that India conducts is basically done through the port itself. And whenever you have a trade right, through the port, one, you have to have vessels, that is ships used for transportation. In addition to vessels, you also have to have containers. Now there is issue with both of them. First, let's start with the containers. 85% of the containers which are used in the global market are manufactured in China. And recently, because of issue with respect to lockdowns imposed because of COVID, right, because of lower production of containers, there is a shortage of containers in the global market. There is a shortage of containers in the global market. Now, because there is a shortage of containers on the one side, and on the other side, the demand recovery is taking place in the global market. So the lockdowns which are imposed by various governments, these lockdowns have been withdrawn. So there is a rising demand for goods and services in the global market. So on one side, demand for right, these containers is rising upwards, and on the other side, there is a lower production of this. There is a shortage of containers. As a result of this, cost of using these particular containers, cost of hiring these particular containers is gradually increasing. And the last 1 year itself, it has increased by more than 300% in many of these particular cases. Now that is one issue. And when the cost of containers starts increasing like this, there is the cost of using these particular containers starts rising upwards so steeply. Obviously, the cost of operations using the vessels will also start increasing. Now, this has raised alarm bells among the Indian exporters. Because very recently, the exports started reviving in case of Indian market, and the exporters looking at the global market demand recovery wanted to leverage, wanted to benefit out of this particular recovery. But as a blow, what has come to their surprise is this particular cost of a freight has started increasing very steeply. For example, the cost of sending a freight, that is the transportation from India to, let's say, Eastern America, it was somewhere around $6,000 to $7,000. Okay, the East Coast of America, from India to East Coast of America, it cost around $6,000 to $7,000 to transport right one container as such. Now, this has steeply increased to more than $11,000. Increased steeply to more than $11,000. And what is the impact? Impact is straightforward. One, I will get this very carefully. Cost of transportation is going to increase, and when cost of transportation increases, obviously it will translate to higher cost of other exports. And exporters are concerned that the cost of exports might inch up by 5% to 8%, which will further make them lower competitive or lesser competitive in the international market. That's the first issue. Second issue, because there's a shortage of containers. What is happening is earlier it took around 45 days to transport these particular containers from one point to another point, let's say from India to the rest of the world. Important trade assets. Now, as a result of shortage of containers, this particular time period has increased from 45 days to 75 days to 90 days in majority of the cases. So the time taken for transportation also has increased. Right? And as a result of this, understand this very carefully, as a result of this, exporters will export the commodities. Once it reaches the exporter, then the payment will be done. Now the payment is getting delayed by 2 to 3 months. Is okay? The payments are getting delayed by 2 to 3 months. And please remember this, exporters are always constrained with respect to credit. The amount of money that is available for the exporters is always short of what they actually require. So in a time period when the exporters are functioning in a shortage of the amount, shortage of the credit, the receivables are getting stuck up for 2 to 3 months, which will further put burden or pressure on the exporters as such. Now what's the way out? You have discussed the issue so far. What is the way out? The way out can be discussed under 2 heads: short term as well as long term. In case of short term, please be very careful. The exporters are asking Government of India to intervene and impose certain restrictions with respect to movement or export of empty containers. I repeat, the exporters are demanding that government should intervene and impose certain restrictions with respect to export of empty containers. Now, why are we exporting empty containers? Please understand this. When there is a shortage of containers in the global market, there are certain exporters from the foreign market who are pre-booking these particular containers. Have you understand this? Who are pre-booking these particular empty containers. And these empty containers, let's say they're sitting at Chennai port or Kolkata port, these empty containers are being transported from India to, let's say, any other country where the exporters are pre-booking these particular containers. And so if you transport these particular empty containers, obviously there will be further shortage of containers in India. As a result of this, Kolkata port very recently has imposed a restriction of not exporting more than 100 empty containers on a vessel. I will repeat the statement here. On a vessel which will move away from India, it will not be allowed to carry more than 100 empty containers, and the exporters are demanding that government of India should intervene and impose same kind of restrictions among other major ports also. That is one in the short term. Second, these particular exporters are suffering because of higher freight rate. Government of India can consider providing them fiscal support for next, let's say, next to 6 to 7 months, right? As long as the freight rates will start cooling down in the market. That is the second option available. Third option, government of India from 19, that is the financial year 1920, 1 year, and financial year 2021 have implemented a scheme called as a Transport and Marketing Assistance (TMA). I'll discuss more on this because it is in the PIP also. So earlier for 2 years, government of India has implemented a scheme called as Transport and Marketing Assistance, under which part of the freight rates which were paid by the exporters were given back by the government so as to incentivize these particular exports. This can also be extended, this can be reintroduced, which government of India has announced very, very recently. So government can take these particular measures in short term. What about long term? Understand this particular transport industry, that is shipping industry, accounts for value of around $60 billion annually in case of India. This export shipping industry accounts for around $60 billion annually in case of India. Out of this, only 5% is actually accounted by Shipping Corporation of India, SCI. And the government of India is of the viewpoint that because only 5% is accounted by this SCI, which is owned by us, will not be able to control the freight rates in the market. And more, please understand, SCI has already been put on the block by government of India for the purpose of the sales. Second, what government of India can do is promote more and more domestic companies to enter into shipping activity, right, so that the dependence on the foreign vessels will come down. And the third reform which government of India can take is promote manufacture of containers in the domestic market, because earlier I mentioned this, more than 85% are manufactured by China. So reduce the dependence, promote the manufacturing of containers in the domestic market itself. So these are some of the reforms that can be implemented by the government either in the short term or in the long term. Done? So this is a discussion with relation to the concept of shipping or freight rates, which has been discussed in the last couple of weeks. Concept of capital account convertibility. Now, certain very basic points here. Concept of capital account is associated with balance of payments. I'm pretty sure those who are preparing for the exam will know the idea of balance of payments. Traditionally, we say that balance of payments is divided into two parts or two accounts. One is called as a current account, and the second one is called as a capital account. But of recently, there is a third account also, which is referred as a financial account. Now, what is the important point here? In case of the current account, we have full convertibility. Post 1994, we have introduced the concept of full convertibility in case of current account, whereas in case of the capital account, even today, we have partial convertibility. Now, the simple meaning of the terms convertibility here refers to, in case of the current account, there are certain transactions. In case of capital account, there are certain transactions. The basic difference between both of them is, in case of the current account, there are transactions which are related to income of a particular country. For example, you'll be generating income by exporting. You'll be generating income by exporting goods or services. You'll be paying certain amount by importing certain goods or services. So generally, in the concept of the current account, you have the transactions which are related to income of a particular country. Whereas on the other hand, in case of the capital account, you have transactions which are related to assets. Is okay? The transactions which are related to income of a particular country. Whereas on the other hand, in case of the capital account, you have transactions which are related to assets. Is okay? Remember this. In case of capital account, I'm repeating it. It is important. You have transactions which are related to creation of assets in a particular country. So that is the basic difference. So the idea of convertibility is the government or is the central banker allowing you to convert, let's say, rupees into dollars as well as vice versa freely, or there are certain restrictions with respect to the conversion. The idea of convertibility means what? Right? Is there freedom for you to convert your rupees into dollars and vice versa without any restriction? In case of the current account, there are no restriction. In case of the capital account, there are certain restrictions. That is the precise reason the books will simply use a statement saying that in case of the current account, there is full convertibility. In capital account, there is partial convertibility. Now, over a period of time, there are two committees which are set up by the government, both headed by the same person, Tarapore Committee. Okay, very, very important to remember the name. Yes, Tarapore Committee. And this particular committee imposed certain conditions or gave certain prescriptions as to follow the concept of full capital account convertibility in case of India. Now, some of you will be thinking, sir, what is the advantage of having a full capital account convertibility? Because RBI governor in recent discussions has stated that the idea of capital account convertibility will be followed as a process, not as an event. Meaning what? Over a period of time, we will introduce certain measures or reforms as a result of which there is a full convertibility in case of capital account. So do not assume that capital account convertibility will be done in a single event or a single instance or single reform. It will be a continued process. So in simple terms, the argument is there is capital account convertibility, but there are certain restrictions. Hence we say that in case of capital account, there is no full convertibility in case of this. Now, what is the argument here? Why that is discussed? What is the need for a full capital account convertibility, or what are the issues or concerns generally discussed in the context of a full capital account convertibility? When we talk about capital account, we have already associated that with the concept of an asset. So the advantages of having a full capital account convertibility will be, one, it will integrate the Indian economy with the global market. Further integration will take place. That's the first very important advantage. Second, with full capital account convertibility, the Indian companies might get access to cheaper capital from the international market. Third important advantage will be, it will promote the concept of ease of doing business or ease of investment in the Indian economy. And the fourth very important advantage will be, a lot of investment is expected to flow into India if there is a full capital account convertibility. As of now, huge amount of FDI flows into India, huge amount of FPI, foreign institutional investment, flows into the stock market. And these are some of the advantages that are associated with the concept of full capital account convertibility. Having said so, historically there have been certain concerns which have been raised against the concept of full capital account convertibility. What are the concerns? One, if there is a full capital account convertibility, the foreign investments no doubt will flow into India. But what if there are certain issues with respect to macroeconomic norms of India? For example, fiscal deficit of government of India increases. Public debt of the government is at all-time high. Inflation rates are also increasing. In certain situations like this, you might see that foreign investors will take their investment and move out of India, and that will create certain instability in the market, not only in the stock market or let's say the debt market, but even in case of the forex market also. That is one concern. Second concern, imagine Indian economy is doing very well, but there is imagine a situation of Fed tapering taking place in case of USA, or there are better interest rates that are available in other economies. At that particular situation, what we can see is these foreign investors, because there are no restrictions with respect to the conversion, can simply take their investments, take all of the investments out of India, which will create instability in India. Third concern which has been raised by various previous RBI governors is that in case there is a full convertibility allowed in case of let's say capital account, there will be certain speculative investments. That is those investments which are done only to earn returns in case of India. This investment is not going to be productive in case of India. These investments will flow into India only to earn better returns. So Indian economy may not get any benefit out of these investments. And the fourth very important issue of concern here is with higher investments which are flowing into India like this with full capital account convertibility, there will be volatilities in case of exchange rates. It's okay, there will be huge volatility in case of exchange rates, and that will definitely have an impact on the trade competitiveness of India's exports in the international market. So these are some of the concerns which have been raised with respect to allowing full capital account convertibility in case of Indian economy. Now, in case of this particular article, basically that is what they have discussed. They have not discussed the critical evaluation part, but they have basically discussed that in the last couple of years, Government of India as well as RBI have taken certain reforms which will basically indicate that India is moving towards full capital account convertibility. For example, they mentioned the reforms such as a fully accessible route wherein non-resident investors are allowed to invest in certain government securities issued by the Government of India. In addition to this, FDI reforms have been introduced, as a result of which huge amount of investment is coming under the capital account into India. So there are certain reforms which have been taken by the government as well as RBI, which is basically taking India towards the concept of a capital account convertibility. Having said so, the article also mentions that despite discussing the concept of full capital account convertibility, even today we have not implemented some of the recommendations which were given by Tharapuri Committee. For example, Tharapuri Committee, first committee was set up in the 1997 and the second Tharapuri Committee was set up in the 2006. In case of 1997, certain important conditions that were prescribed by this committee in order to go for full capital account convertibility was: 1. Reducing the fiscal deficit to below 3.5% or to 3.5%, in controlling the inflation rate between 3 to 5%, implementing certain very important reforms in the financial market which will strengthen the financial market. For example, reducing the NPAs, right, amalgamating or closing down the weaker banks in the Indian economy. So if you see these particular preconditions, none of these particular preconditions are actually met or actually present in case of Indian economy. So without achieving these particular preconditions or without taking the economy to these particular preconditions, it would be very risky to go for full capital account convertibility in case of India. So this is the gist of the article provided here. Now, based on this particular discussion, I give a question here. Consider the following statements regarding capital account. First one, consists of transactions related to assets. True. India has full convertibility under the capital account. This is wrong. Naseeman Committee was set up, which in terms of promoting or regarding the path to full capital account convertibility. Even this particular statement is wrong. Naseeman Committee is more associated with the banking sector reforms and not the full convertibility. So only the first statement is true. The right option will be option A, only one. Now, post 1991, understand the story here. Government of India has opened up the Indian economy. As a result of which, we are seeing that we are entering with the FTAs or we are entering into the trade agreements with multiple countries. More and more multinational enterprises or MNCs are competing to come into India, and Indian government is negotiating or has entered into multiple free trade agreements. But over a period of time, there have been certain concerns which have been raised with respect to these particular FTAs, and these are the same reasons which were cited by Government of India not to join RCEP, Regional Comprehensive Economic Partnership. Apart from these reasons, there are multiple other reasons also. But what are the reasons here? Understand those particular reasons. That is more than sufficient with respect to this particular article here. As per the article, and generally it has been found that whenever Government of India has entered into a free trade agreement with other country, what is expected is both the countries are going to get the benefit. That is, exports from India will be promoted, exports from the other country will be promoted. So both of these particular countries, trade is going to increase, and both the countries will get the benefit out of this particular FTA. But umpteen times, in majority of these particular FTAs, it has been seen that India's exports initially have increased, especially for example, when you evaluate the FTA between India and Japan. Initially, for first couple of years, India's exports were promoted. Later, India's exports stagnated, and later these have been coming down. So overall, right, if I evaluate the FTAs that have been signed by India with, let's say, other countries, when I evaluate the overall impact of this, yes, the trade has increased, but the trade deficit that India has with other countries with which FTA has been entered, that also has increased. Which essentially means what? It simply means, I'm going to the second point here, when the FTAs have been entered into, we expect that both the countries are going to get the benefit of this. But in reality, the other trading partner has got the majority of the benefit, not India. Now you simply ask why India has not been able to leverage the FTAs. I'll come to that also. Let me go to the third point before I go to the reasons. The third very important point here, whenever you enter into FTAs, what do? The countries will either reduce the tariffs or eliminate the tariffs altogether, so that the trade between these particular countries are going to increase. Right? As a result of this, it has been found that when Government of India has reduced or eliminated tariffs on the imports have increased. These have become much more competitive when they land in the Indian market, and they have basically replaced the domestic manufacturers in the Indian market. In simple terms, by reducing or eliminating these particular tariffs, imports have become much cheaper compared to the domestic manufacturers, which has affected domestic manufacturing. These are the three very important and negative outcomes that are generally associated with India's FTAs with other countries. Now, in addition to this, I stated that the reasons for this are also very important. What are the reasons? Why we are unable to leverage these particular FTAs? Some of the reasons which have been cited here are: 1. The rules of origin. Right? That is basically whenever you export and you want to enjoy the benefit of, let's say, lower tariff or eliminated tariff, you will have to certify that certain amount of manufacturer value addition has taken place in your country. The rules of origin are very, very complicated, are very stringent. That is one reason. The information related to FTAs is not known to every exporter in India. The third very important reason why we are not able to leverage these FTAs is whenever we want to export, the rules are very, very complicated. Like multiple agencies are involved, cost of logistics are very, very high, etc. So these are some of the reasons why the FTAs have not been working in favor of India. And this becomes very, very important. Why? For a simple reason, India has started negotiating or started renegotiating FTAs with multiple countries, and right, these particular points have to be considered by Government of India before entering into new framework or let's say the FTAs with these particular countries again. So these are some of the very important points related to this particular article. Now, based on this, straightforward question, static based question, arrange the following increasing integration level. In the static portion, I'm pretty sure you come across the concept of economic integration. The beginning of economic integration out of these particular four will start with the free trade agreements, FTAs. After FTA, you will come across customs union, then you come across common market, and then the last phase of economic integration will be economic union. These are the four stages. If you go from left to right, this is increasing integration. Again, this is a question from the static part which already has been asked at UPSC, and the same kind of question has been asked at multiple state level PSC exams also. So first, second, third, and fourth, this is how the increasing integration or economic integration will take place. So right option will be option D here. The idea of export promotion bodies. Very recently, NITI Aayog has announced that it will be conducting a relevance study on the export promotion bodies. Now, they've used the term export promotion bodies. You can use it, or else the other term will be export promotion councils. Now, before understanding what is given in the article, let's look at certain very important basics here. Any country, for that matter, will be wanting to promote more and more exports, and India is not an exception to that. In fact, for the current financial year, Government of India has a very ambitious target of promoting more and more exports, especially under the merchandise exports, to the tune of more than $400 billion, and that's a target that the Government of India set up. In order to promote these particular goods as well as services, government generally sets up the concept of export promotion councils or export promotion bodies. You can divide these particular export promotion bodies into those which are present in different sectors or which are set up specifically for promotion of a particular product. And generally for exports, either you will have the EPCs, or to promote the exports, you will have EPCs, or you will also have community boards. There are community boards for promotion of coffee, spices, etc. And on the other hand, the examples of the export promotion councils, there is an export promotion council for promotion of export of gems and jewelry, promotion of apparels, promotion of agriculture products, which is famously referred as APEDA. So generally what you have is, under the Ministry of Commerce as well as the textiles, you have these particular EPCs, and there are more than 20 such EPCs which are functioning, which are set up by the government. In addition to this, there are also community boards like this. And what is the importance of the EPCs? The role that is played by the EPCs are, one, they'll basically try to find out which are the markets to which the goods can be exported from India. What are the different exporters? Get them registered and provide them with all of this particular information. For example, what kind of tariffs are imposed by the importing country? Which are the major markets where India's exports can be promoted into? Right? What kind of technology is being used in the external market? Right? What are the other schemes provided by the government to promote exports, etc. So all these kinds of functions, right, are provided, or basically the information is provided by the Export Promotion Council. Now that is the important role played by the EPC. Now in addition to this, another very important point that you need to remember here is, in order to provide or to facilitate the functioning of the EPCs, government keeps a certain amount, right, reserved or earmarked for their expenditure. For example, in the budget for 18 and 19, Government of India reserved over 250 crore rupees for this, and in 19 and 20, over 300 crore rupees was actually earmarked for their expenditure. And plus, in addition to this, government also has launched a scheme by the name Market Assistance Initiative, and there is also Marketing Development Assistance Scheme. Two types of schemes which have been launched by the government, which will basically promote the functioning of these types of export promotion councils. Now, what has been discussed in the article? In the last couple of years, there has been an issue with the functioning of the EPCs. That is, essentially, the exporters are of the viewpoint that the EPCs lack dynamism. That is, the EPCs do not or are not performing the functions very dynamically in finding out the different markets and promoting India's exports into these particular markets. And when the councils such as EPC do not perform this kind of a dynamic function, it is the exporters who will end up losing because their exports are not increasing at a very faster pace. And that is the precise reason in the last couple of years, NITI Aayog has announced that they will start evaluating the performance of these particular EPCs and they will be ranking these particular EPCs. Even the Prime Minister's office has looked into whether there are any issues with respect to, let's say, promotion of work done by these particular EPCs. And in addition to this, very recently NITI Aayog has announced that they will be looking into a mechanism wherein they are going to evaluate or they are going to find out what is the relevance of these particular export promotion bodies in order to promote more and more exports from India to the rest of the world. So this is the gist of the article which has been provided here. Now, one question that I've given is based on the scheme that has been announced by the government, Market Assistance Initiative, MEAI. Now, before looking at the points given here, let's look at some very important points related to the scheme. MEAI was launched by the government back in the year 2003. It was launched by the government back in the year 2003. First point. Second very important point. Generally, the MEAI scheme is used for promotion of the exports of goods as well as services. Export of goods as well as services. Third very important point. Right, under the concept of MEAI, right, we are promoting the goods and exports. And please understand this: the idea of an assistance. That is the third point here. The idea of assistance can be given to different central government bodies, export promotion councils, and different stakeholders in the system can get the assistance under this scheme of MEAI. So these are certain very important points. Let's have a look at the question here. This is being implemented to promote exports of goods and services. Yes, the statement is true. This was implemented for the first time as a part of Foreign Trade Policy 2015 and 2020. This statement is wrong because this was launched back in the year 2003 itself. And the reason I picked up the question on the MEAI is for a simple reason. Very recently, right, the 1520 FTP, right, got over and was extended, and the government of India has announced that the MEAI scheme will be extended for 5 more years. Is okay? The MEAI scheme has been extended for a period of 5 more years. Right, that is basically now the MEAI scheme has been extended from 2021 to 2026. And that is the precise reason I picked up a question on MEAI scheme here. So first statement is true, second one is wrong. The right option will be option A, only one is true. Brand India campaign. Very recently, the Minister of Commerce has announced that they will be launching an umbrella campaign. Is okay? They are going to launch an umbrella campaign to promote exports from India to the rest of the world. And the name of this umbrella campaign is a Brand India campaign. Now, as of this article, they have given very basic points here. That is the first one. This will be umbrella campaign. Umbrella campaign essentially means what? There are so many other campaigns which are conducted by various export promotion councils to promote exports from India to the rest of the world. But all of them now will be brought under the concept of Brand India campaign itself. That's the first point. Second important point. This particular umbrella campaign or let's say Brand India campaign will focus initially on some of the sectors such as gems and jewelry, textiles, plantation products, education, healthcare, pharma sector, etc. That's the second point. Third point. Right, the campaign approach would be like this. One, they will try to find out new consumers, new buyers in the international market, so that the exports can be diversified. That's basically you can export more and more to the newer buyers in the market. Second, right, they will also basically try to find out potential markets in the international market. Right, they will try to conduct promotional events through the digital technology, digital means like this. In addition to this, the fourth point, they have mentioned something called as IBEF, Indian Brand Equity Foundation. Remember this, IBEF is a trust which has been set up right by the Department of Commerce. Is okay? It is a trust which has been set up by Department of Commerce. And what's the function of IBEF? Basically, IBEF will be promoting and creating international awareness related to made in India products. Is okay? It will be creating certain awareness in the international market related to the goods which are manufactured in India. So these are some of the important points which are provided in the article related to Brand India campaign. FTA policy recalibration. In simple terms, in recent times, Government of India has started reworking on the free trade agreements that it has signed with various other countries. Now, what's the point of this particular discussion? In the last couple of months and in the last 1 week, I'm pretty sure you must have seen in the newspaper, there's a lot of discussion related to the trade agreements that Indian government has signed, not only in the recent past with other countries, but also in the last 1.5 decades with many other trading partners. Now, some of you might be scratching your head and thinking, sir, what do you mean by this particular FTA? We keep on reading this, we keep on hovering over this particular term very often in the newspaper without understanding what is this particular concept of free trade agreement. In the context of economics, you come across the idea called as economic integration. Okay, economic integration. That is the global market, which consists of various countries, will start integrating in terms of trading, in terms of investment, in terms of movement of labor, etc. Generally, the economic integration starts with preferential trade agreement (PTA). Then after this, there is a free trade agreement. Then after this, there is a common market. Then the customs union, and finally, economic union. Okay, the final integration will be economic union. After that, there is a political integration. Don't worry about this. Under the concept of economics. Now, basically, in case of free trade agreement, focus on the FTA because that is there in the newspapers very often. India signed multiple free trade agreements with many of the trading partners. For example, in this article itself, the authors quote that India signed agreements with countries such as Japan, South Korea, Malaysia, Thailand, Singapore, Sri Lanka, Nepal, Bhutan, Mauritius, and even the 10 grouping nations that is ASEAN. Now, should you remember this? My recommendation, please do. Because in the last couple of months, or let's say last couple of weeks itself, India signed a comprehensive economic partnership agreement (CEPA) with United
Arab Emirates, which I'll discuss in some time. In addition to this, there is also discussion with respect to United Kingdom regarding signing an FTA. We are also negotiating with Australia, and we want to sign a free trade agreement with them also. Now, some of you simply say, sir, hang on a minute. You told us about PTA, FTA, etc., but there is no mention about the comprehensive economic partnership anywhere in these particular terms. Essentially, the concept of PTA means what? Understand this. Let's understand the FTA first, then we'll look at the concept of CPA. Under the free trade agreement, two trading partners or two or more trading partners will come together, and they'll try to reduce the tariff as well as non-tariff barriers on most of the goods and services that have been traded amongst them. That is, imagine there are two countries A and B. Okay, imagine there are two countries A and B, and these particular two countries are trading, let's say, 100 goods and services between them. Now, if I cover, let's say, all the 100 goods and services, if I cover 90% of them, if I cover even 65% of them, it is essentially referring to a substantial amount of a trade which is conducted between both of these countries. And whenever we talk about free trade agreement, that is exactly what they're trying to do. Under the PTA, they generally focus on very small volume of trade, or very small part of the trade. Whereas under the context of free trade agreement, a substantial part, majority of the trade that is conducted between both of the countries, or let's say group of the countries, will be covered under free trade agreement. That is a very important difference between PTA and FTA. And before signing this particular FTA, generally the countries sign one more type of a scheme, or let's say agreement, which is called as early harvest scheme or early harvest agreement. Now, some of you simply say, sir, you're saying they will sign FTA, but before signing FTA, they will sign early harvest agreement. What do you mean by this? Let's take the same example. Both A and B want to sign an agreement which covers, let's say, 100 goods or 100 items. Now, it will take a long period of time for them to negotiate and come to a conclusion what kind of a tariff they're supposed to have regarding all of these particular 100 commodities. But out of 100 commodities, let's say, around 15 commodities, both of the countries can come to an agreement very, very soon, very quickly. And when both of these particular countries can come to an agreement regarding tariffs or, let's say, non-tariff barriers on these particular 15 commodities, they generally sign an agreement which is called as early harvest agreement. It is simply a precursor, I repeat it is simply a precursor to signing an FTA. Why? Negotiating and signing an FTA takes time, and there are certain low-hanging fruits, easier areas for which both of the countries generally agree, and these areas will be covered and will sign an agreement called as early harvest agreement or early harvest scheme. Now, what is the CPA? There are two terms here. Many of the books will refer to the agreements in the form of comprehensive economic partnership, right? Comprehensive economic partnership agreement, or else they also use one more name, comprehensive economic cooperation agreement. CPA, CCA. These are special types of free trade agreements. Understand this? These are one step further within the free trade agreements itself. Generally, the free trade agreements focus is on the trade of goods and services, whereas in the context of CPA or CCA, the agreements, rather than focusing only on the goods and services, they'll start focusing on investments, they'll start focusing on intellectual property rights, human labor, etc. Again, it depends on one agreement to another agreement. But in simple terms, I can say that the coverage under CPA as well as CCA, or the scope of both of them, is much broader, much wider compared to a simple free trade agreement. Now, in the recent times, India signed a CPA with United Arab Emirates. Now, what is the point of discussion in this particular article? In the last 1.5 decades, India signed agreements with many of these particular countries. And whenever such agreements are signed, a simple object of the agreement is that the trade between both of the countries should increase, and both of the countries should benefit out of this particular trade. But what has actually happened in the context of India? If you can see this particular graph, they have shown what has happened to trade deficit of India with the majority of these particular free trading agreements, or these are trading partners, between financial year 11 to financial year 21. And in simple terms, you can see that the value of imports that we have done from these particular countries is much higher compared to the value of exports that we have done. In essence, or in a nutshell, what I'm saying here is India's trade deficit with these particular countries was, right, this number, whatever number you don't have to remember, right, it was this much in the financial year 11, and by financial year 21, this has actually ballooned. It has actually increased to a very large margin. Now, I'm saying don't mug up these particular numbers. By the time you write the exam, the numbers will have already changed. That is the reason you don't have to mug up these numbers. All you can simply say is, before signing these particular agreements, yes, there's a trade deficit. India signed these agreements. We expected the trade between these countries to increase. Has it increased? Yes. But what has happened is, with the rise in the bilateral trade or overall trade between India and these particular trading partners, India's trade deficit also has increased during the same period of time, which essentially means India's exports are not increasing at expected level to these particular countries. Now, some of you might be thinking, sir, why is this happening in the context of India? Why our exports are not increasing so that the trade deficit will come down? Reasons are very simple. In the context of India, the cost of production is higher. Why is the cost of production higher? For example, I'm a manufacturer. It is very difficult for me to find, let's say, loans at a cheaper rate of interest in India, especially for the MSME sector. Even if I find a loan or credit in the market, I'm forced to pay a higher rate of interest on these particular loans, which will have a direct impact on what is the cost of product. So cost of production are higher, cost of electricity that is used for production is higher, cost of logistics is higher, and as a result of these plus many other factors, our exports are not very competitive in the international market, and that is the precise reason why we are unable to leverage these particular trade agreements. Now, there's a way forward here. Government of India simply stated that we want to review these particular trade agreements where our trade deficit is actually increased over a period of time, and that is what is discussed in this particular article here. Done? So based on the discussion, I'll give a question here. Consider the following statements. PTA and FTA both cover substantial trade. Statement is wrong. PTA covers a very small part of the trade, whereas a free trade agreement covers a substantial amount of the trade. Under FTA, the trading partners reduce both the tariff as well as non-tariff barriers. Now, some of you here will simply say, sir, in my book, it simply says the FTA is focused on the tariff barrier reduction. Yes, it is true. But if you see the government documents which are published, and there is an FAQs on the trade agreements which have been published by the government, and in these particular documents, clearly the government states that the object of FTA is that the trading partners will try to reduce both the tariff as well as the non-tariff barrier. So I'll go to the government document here and say second statement is true. Right option is option B, only 2. India, UAE, comprehensive economic partnership agreement. Now, what are the important points here? We'll focus on the most important points. Just now we've discussed that CPA is a step further or step above the concept of a simple FTA. And when you talk about CPA, you're focused on goods, you're focused on services, you're focused on other areas such as investment, intellectual property rights, digital trades, right, etc. And that is why this particular agreement is very, very important for you. First and foremost, what has been proposed under the agreement, what has been provided in the article here, right? It has been provided that United Arab Emirates, UAE, will be reducing the tariff or eliminating the tariff on around 90% of the goods that are exported from India. And in return, India would be reducing the tariff on 65% of, right, the goods that are imported from UAE. So there's a reciprocity here. There's a reciprocal reduction in the tariff or elimination in the tariff by both of the countries. Now, what is the advantage of this? The advantage of this is, initially, to begin with, in the next 5 years, we will try to increase the bilateral trade that is conducted between both of these countries. And the investment target, or to be more precise here, the bilateral trade target has been set at $100 billion in the next 5 years. $100 billion. And understand this. In addition to this, as per the data given in the article, because of this particular agreement, 10 million jobs would be created. Right? Rather than 10 million, just here, 10 million jobs would be created only in India because of this particular agreement. That's the second point. And over a period of time, UAE has stated that we will reduce or will eliminate the tariffs on most of the imports that we do from India. And in the next 10 years, India would be reducing and eliminating the tariffs on around 90% of the goods that are imported from United Arab Emirates. This is the third point. Fourth point, have a look at this. We will be importing 200 tons of gold from UAE. It's okay, we'll be importing 200 tons of gold, that is a precious metal, from UAE. And please understand this.
whatever imports we are going to do from UAE under this, up to 200 tons, we are going to reduce the tariff on this by 1%. Is it okay? We are going to reduce the tariff by 1%. That is, whatever the tariff we are importing on, let's say, the gold imports, whatever it is, on this particular import from UAE, we will apply 1% less on that. But this particular limit is only applicable up to 200 tons of import of gold. So what will happen if I import more than 200 tons? In that particular case, we'll simply increase the tariff and apply whatever is the normal tariff applicable on the import of gold. Done? Right? That is one very important point. Now, why this agreement makes a lot of sense for India? Have a look at this. This is the first comprehensive trade agreement that the current government of India has signed in the last 6 to 7 years. First, very, very important comprehensive agreement. I understand this. That's the first point. Second point, strict rules of origin will be applicable in this particular agreement. Now, you simply raise a question, so what do you mean by strict rules of origin? Let me give a very simple example. Imagine trade is being conducted between A, B, and A and C. So from C, certain exports are entering into A. From B, same exports are entering into A. Imagine this particular market. C is exporting this market to A, and B is also exporting the same or similar market to A. Now, let's say A and B enter into an agreement, and as a result of this, we will reduce the tariff on the market to, let's say, 0%. Now, earlier imagine it was 15%, now it has been reduced to 0%. So if this particular market is exported from B to A, what will the tariff applicable? 0%. And a similar market exported from C to A, the tariff will be 15%. So there's always a danger that a manufacturer from C will export these particular markets to country B, and from country B, he will simply route it. He will simply send this particular exports from country B to country A to enjoy this particular benefit of the exemption of tariffs or 0% tariffs. Now, the whole objective of agreement between A and B was that both of the countries should benefit. But in this particular case, a manufacturer from some other country, the third country, is getting the benefit of this agreement between A and B. Now, to overcome this particular issue, government has introduced the concept of rules of origin. And this is not a new thing. Please remember this. Here's your homework. In 2020, government of India introduced something called as Carotara Rules 2020. Please find out what is the long form of this. Carotara Rules of 2020. And I'll give a hint. This particular rule is basically connected to concept of rules of origin. And very often this is cited in the newspaper. Now, please understand the concept of rules of origin is not anything new. It was there in the context of RCEP. It has been there in the context of many of the trade agreements that India has been signing or has been implementing this concept. The argument here is, whenever this particular market, imagine this particular market will move from country B to country A now, the government of India, before allowing the market to land, will ask for proof of documentation. Is okay? They will ask for a proof or a document which will simply say that certain value addition has happened in the country B and it has not been merely imported from country C to B and then exported to country A. You understand this? This particular market, imagine if it is manufactured in country C, it doesn't have to go or it doesn't have to undergo any kind of manufacturing in country B as such. It will be simply imported, then routed to country A like this. But what if there is certain value addition, certain manufacturing which has happened in country B? Will that product be allowed to enjoy this particular 0% tariff rate? Definitely yes. But for that, the government simply says, in this particular agreement, country B will have to prove that 40% of value addition has actually happened in country B. And how does the exporter from country B will prove that? The government of country B will provide a certificate to him. Is okay? A document will be provided. This particular document will be submitted by this exporter to the government of A, and only then the tariff, which is the 0% in this case, will be applied on this. Otherwise, government of A would simply apply 15% tariff, even though it is coming from country B. So strict rules of origin, 40% value addition. Remember that. Third one, chapters on digital trade, government procurement, and intellectual property rights have been included for the first time ever in the agreement. Very, very important. Remember this. Having said so, next point is also very important. Imagine the government of India introduces a certain government procurement policy, and UAE says that it is against this particular chapter in this particular agreement. Can United Arab Emirates file a complaint against India under WTO? As per the agreement, no. I can understand, as per the agreement, no. It has been introduced just for negotiation purposes, just to show the willingness that India is ready to discuss these kinds of concepts in the agreement. But right now, as per the agreement, the other trading party is not allowed to file a complaint against India under WTO if they violate or if their policies are against any of these particular provisions as such. And finally, India has imposed a tariff of 10% to protect the sensitive sectors. What's the importance here? There are certain sensitive sectors in India. Now you start asking me, sir, what are these particular sensitive items or sensitive sectors? The list is provided here. Vegetables, fruits, dairy, cereals, automobiles, auto parts, etc. And government of India feels that I cannot allow the imports from UAE to come at zero rate too, right? Or I cannot allow the imports to come into India at 0% tariff as such, because these are very, very important areas for us. A lot of livelihoods depend from production activity happening in these particular areas, so I will not allow duty-free imports to come into India under these particular sectors. So government of India has continued to keep these particular sensitive sectors in mind, has imposed 10% tariffs on these particular items. So these are some of the very, very important provisions or the points related to India-UAE CPA. India reaching the exports worth $400 billion. This is the first time ever in a year where merchandise exports have reached the target or have crossed the target of $400 billion. Now the important points you need to understand with respect to this. First and foremost, Government of India set up a target of achieving $400 billion target of exports, that is the merchandise exports, for the current financial year. Now even before the end of the financial year, that is 10 days before the end of the current financial year, government has announced that we will be able to reach the target of $400 billion worth of merchandise exports, and in the coming days we will even cross more than $410 billion. And this is an achievement for a very simple reason. For the first time ever, we have reached and crossed this particular target of $400 billion. Now what are the reasons? Why were we able to cross this particular $400 billion target? First and foremost, there is a recovery that is happening in the global market. For example, USA. This particular country is very important for you for a reason that India is the top trading country, or USA is the top trading country of India, and second largest trading partner is China. Now out of the total exports that India does, around 18% of the exports generally go to USA. And for this particular year, this is very important. Why? The total amount of exports that have gone from India to USA have crossed more than $73 billion. More than $73 billion out of more than $400 billion. And it is not just sufficient to remember this. Also remember the next point. Compared to last year, the amount of exports have increased by more than 47%. And when you compare this particular $400 billion worth of exports compared to, let's say, the pre-pandemic era, in the year 2018 and 2019, the highest amount of merchandise exports that India did was $331 billion. And this year, we have been able to cross more than $400 billion. Second reason, it is not just that there is a recovery in USA, there is a recovery in other countries also. And when you see there is a recovery, the growth is happening, there is a very close linkage between the growth, the production, as well as the exports. With the recovery that is happening across the global market, these particular companies are stocking inventories. They are purchasing more and more inventories or goods and they are stocking them. And as a result of this, exports from India have increased. Second reason. Third reason, rupee is depreciating. Are reading newspapers, and very often you come across this article. Rupee is depreciating. And when the rupee depreciates, the value of exports or the exports will become more and more competitive. And as a result of this, the exports from India have increased. In addition to this, there is one more reason. What are the reasons? List it out. One, there is a recovery that is happening in USA. Second one is there is a rupee depreciation that is happening, which is adding to India's exports. Third one is with the recovery, more and more companies are stocking these inventories or goods. And the fourth very important reason is the price of the commodities in the international market is increasing, is rising up. Now, the rise in the price of the commodities will add to India's exports. Imagine you're manufacturing a product and you're exporting this to the international market. And one of the raw material is a steel or an aluminium. When the price of this commodity rises up, raw material cost for you will increase, cost of production increases, and as a result of this, the value of the exports at which you are going to export, that will also increase. This is also contributing to more and more exports from India to the rest of the world. So these are some of the reasons why India's exports or merchandise exports have actually boomed in the last couple of months, or let's say in the last 1 year.
And one more noteworthy point here is, in last 12 months, that is let's say from the last year April till the March year, in every month, the value of merchandise exports that have been done from India on an average are more than $30 billion. Remember this also. Consequently, in the last 12 months, the merchandise exports that have been done have crossed more than $30 billion. Now, having said so, will this continue? Will this boom continue? Are there any concerns related to this? Yes, there are certain very, very important concerns. First one, with Russian invasion on Ukraine continuing, there is volatility, there is uncertainty that has been created in the international market. And that very uncertainty might basically lead to effect on the global trade, which can have an impact on India's exports. First point. Second very important point. With this uncertainty, there is also another trend that is actually rising. That is the central bankers in many countries are concerned about inflation and the reducing the money supply. And the concern here is, with reduction of money supply, the access to credit, let's say for the countries, will come down. Interest rates will rise up, so the demand in these particular countries might come down. And if India is an exporting country to that particular countries, the demand might have an impact on India's exports. Right, so these are some of the very, very important concerns which might derail India's exports in the coming years. Right, so these are some of the very important points which have been provided here. Please go through this. Now, based on this particular graph, suddenly UPSC can ask you a trend-based question here. Just have a look at this particular graph. UPSC can ask you a trend-based question. And in this particular graph itself, there is a concern also. What is the concern? It is the fact that there is no stability in terms of exports which have been done. There is merchandise exports which have been done from India. For example, if UPSC will give you a statement, merchandise exports from India in the last 5 years have continuously increased. Have a look at the graph, you will realize statement is wrong. And there is a second point, which is a concern for India. What's the concern? With rising exports, understand this very carefully. With rising exports, the trade deficit in case of India also has increased. Right? In case of India, the exports have crossed more than 400 billion, no doubt. But with that, the imports also have increased. Imports into India also have increased. And as a result of this, the trade deficit that India has also has ballooned. But what can you understand from this particular graph related to trade deficit? Is the UPSC will give you a statement like this. In the last 5 years, the trade deficit or the merchandise trade deficit that India has continuously increased or consistently increased, wrong. Has consistently fallen, wrong. There is a volatility. There is no pattern. There is no trend that you can observe. Right? In some of the years, the trade deficit is low. In some of the years, the trade deficit has increased, etc. Right? So have a look at this particular graph also. Now, based on this discussion, I've got an MCQ here. Consider the following statement. A country having a higher merchandise exports will always have a current account surplus. Underline the term always here. Do you think a country which has a higher exports in merchandise will always have a current account surplus? Not necessary. I'll repeat it. Not necessary. Because please understand, he's asking a question about current account. Within current account, there are visibles as well as invisibles. But you're coming to a conclusion based on only the merchandise exports, that is visibles, that there will be a current account surplus always. Not necessary. Best example is India itself. India's merchandise exports have increased, crossed more than 400 billion. But even then, there's a current account deficit. So it doesn't necessarily mean that higher merchandise exports means current account surplus. It could happen, but there's no guarantee. Because what if the remittances, like the out remittances are very, very high? What about debt payment? Right? What if it is also very, very high? In that particular case, or even in this particular statement also, it doesn't say what about imports or services. So there are so many other parameters which can have an impact and make a country's GOP as a current account deficit. So first statement, wrong. Second, rising commodity prices have helped exports from India. Statement is true. This is straightforward. A statement picked up from various newspaper articles. So right option for this particular question will be option B, only 2. One more parliamentary panel has given some very important recommendations with respect to free trade agreement. Now, the important recommendations here, first and foremost, this panel says that the government of India is delaying, or there is a delay in signing of free trade agreements. So government of India should speed up signing of these particular agreements. Why? Sooner you sign the agreement, like the sooner you will be able to get the benefits from this agreement. So sign or form of these agreements as soon as possible. Second, whenever you sign the agreement or these FTAs, try to include a provision for reviewing the agreement. I will repeat the statement here. Try to include a provision for reviewing this particular free trade agreement. Why? Between 2006 to 2011, right? How this? Between 2006 to 2011, government of India has implemented or has brought into force around 6 FTAs. But out of these 6 FTAs, in 5 FTAs, the trade deficit of India has actually increased. So there is a concern amongst the government officials, or let's say the government itself, that if they sign the agreements, the trade deficit of India is increasing, which means the other country or other party is getting the benefit. We are unable to leverage these agreements. So what we can do is include a provision to have a midterm review of these particular free trade agreements. So that once you implement or bring it into force, after a couple of years you realize, okay, this agreement is not working in my favor, you can simply rework this particular agreement. That is a second very important recommendation. Third one, have the foreign trade policy as soon as possible. Because the last foreign trade policy was implemented from 2015 to 2020, and during 2020, where we were supposed to implement a new foreign trade policy, there was a pandemic. Government said, we will extend the same FTP. It was again extended till the end of financial year 2022. Now government says that it will be extended till the end of September 2022. That is half of the next financial year. But this panel says, right, how many years will you keep using the same FTA, right, FTP? Have a new foreign trade policy because it will create certainty. It will provide certain cushion to the market as to what is exactly your new FTP. That's a third very important recommendation. Fourth very important recommendation. Enter into those particular agreements wherein the other countries want to invest in India. Understand the statement here? Enter into those particular free trade agreements wherein the investors from other countries want to invest in India. Why? Like there is a strategy which is being followed by some of these particular countries, and the name of the strategy is China plus one. Okay, China plus one. Wherein rather than investing and developing a manufacturing facility only in China, they want to spread this particular manufacturing activity in other countries also. Right, so focus on those particular agreements wherein those particular countries or other countries, there are investors who want to invest in other countries. So leverage those particular agreements. And that is the fourth very important recommendation. Fifth very important recommendation related to special economic zones, related to less ECs. Very recently, government of India has already announced that they want to restructure the policy of special economic zones. That's the first point. Second, very importantly, those particular units which will start manufacturing by the end of June 2020. Remember this. Only those manufacturing units which will start manufacturing or production before the end of June 2020 would be given the income tax exemption. Because under the SEC policy, remember this, 15 years worth of IT exemption would be provided. Again, it is not uniformly 100%. First 5 years, 100% IT exemption. Next 5 years, 50%. And next 5 years, based on your float back, like the investments out of the profits, certain exemption in IT is given. But that particular clause has been ended. Right? That is government of India simply said, we will have a sunset clause, and that sunset clause has been utilized or implemented by the government from June 2020. So if you have a production unit, let's say manufacturing unit, you set up manufacturing unit within SEC, but the production starts after 30th June. You will not be given access to this particular IT exemption. You will have to pay income taxes as usual. So sunset clause has been implemented by the government now, or has been utilized by the government, and the MAT is also applicable. Minimum market tax is also applicable on the units set up in SEC. And this committee says, if you withdraw these kind of exemptions or the benefits in the units present in SEC, SECs will start losing competitiveness, and there will be no interest among the investors to invest within SEC. So do not do that. Continue with these particular benefits. Extend these particular benefits. And the sixth very important recommendation given by this particular panel is, the scheme of RoDTEP has been launched by the government. Okay, remission of duties, taxes on export products. Scheme has been launched. But there are certain sectors, for example, organic, inorganic chemicals, right, etc. There are certain sectors which are not covered under RoDTEP. And this panel says, don't do that. Cover of them also, include them also. Then ask me, sir, why is government of India not including some of these particular sectors? The reason is government says that these sectors are accounting for a lot of exports. It's okay, these particular sectors are accounting for a lot of exports, and these are already developed sectors, so I do not want to give the subsidies to these particular sectors. Right? But this committee says of this and says don't do that. Continue. And cover them also, give them exemptions. Okay? So these are some of the very, very important recommendations that have been provided by a parliamentary panel regarding free trade agreements.
Export Preparedness Index. I'm pretty sure all of you heard of NITI Aayog, National Institution for Transforming India. NITI Aayog has been set up by the government, and this NITI Aayog prepares multiple types of indices. For example, there is a Composite Water Management Index, there is a Sustainable Development Goal Index, right, etc. But apart from these indices, there is one very important index which is prepared by the NITI Aayog by the name of Export Preparedness Index. I'll use a short form henceforth, EPI. Now, what is the utility of an Export Preparedness Index? You must have heard of the term competitive federalism. Now, what do you mean by competitive federalism? In a nutshell, competitive federalism means there is a promoted competition amongst the parts of India. Parts of India here basically refers to the states of India. Whenever any policy is taken, wherein there is a competition, enhanced competition, higher competition which is promoted amongst the states, essentially that is referred as competitive federalism. And one way to promote competitive federalism now is to promote the export preparedness amongst these particular states. Now, what do you mean by export preparedness here? NITI Aayog will basically consider 4 parameters or 4 pillars and will give weightage to all of these particular 4 pillars. So, what are the 4 pillars? Please mark up these particular pillars: export policy, export business, ecosystem, right, export, right, performance, etc. And has given weightage to all of these particular 4 parameters or 4 pillars. And you can see the weightages in this particular slide itself. And it will evaluate the performance of each of the states as well as union territories. Remember this. I'm focusing on this for a very simple reason. If you have read the newspaper articles, which I'm pretty sure all of you have read, they are only telling about the state governments. Right? They'll say that Gujarat, for the second consecutive time, has topped this particular index. And Gujarat is followed by many states such as Tamil Nadu, Maharashtra, Karnataka, etc., etc., etc. But most of the newspaper articles are not focused on the fact that this index will not only rank the states, but will also evaluate the performance of union territories and will rank even the union territories. So this particular index, which is prepared by NITI Aayog, has been prepared for the second time now. Earlier it was prepared for 2020, now this has been prepared for 2021. As already mentioned, there are 4 pillars, and within this particular 4 pillars, there are 11 sub-pillars. I'll repeat it. There are 4 pillars, and under this particular 4 pillars, totally, there are 11 sub-pillars. So should I stop at this particular point? No. There is one more point here. And within this particular 11 sub-pillars, there are 60 indicators. Is okay? Within this particular 11 sub-pillars, there are 60 indicators. So this is the second time NITI Aayog has published it. It has not changed the pillars. It has not changed the 11 sub-pillars. But have a look at this. It has actually made certain changes in the indicators. Certain number of indicators have been removed. 3 indicators have been removed, and around 8 indicators have been added. Why this has been done by NITI Aayog? The report mentions that NITI Aayog, before evaluating or conducting this particular exercise, conducted the consultations with the stakeholders. And based on the recommendations given by the stakeholders, or the inputs given by the stakeholders, NITI Aayog has basically changed the composition of indicators. Some of the indicators have been taken out, and some indicators have been added new. Now, what are the important points related to this particular index or index for 2021? Remember the state name? Gujarat has topped the list again. Right? It is the second time the report has been published, and it is the second time that Gujarat has topped the list. That's the first statement. Second, Gujarat is followed by the next important states: Maharashtra, Karnataka, Tamil Nadu, etc. Now, suddenly the UPSC might ask you, let's say in interview. Again, I don't expect this kind of a question to be asked in, let's say prelims or mains, but in an interview, what if the interviewer asks you, why are these particular states generally topping? Why not, let's say, a state such as Uttar Pradesh, which is the most popular state in India? Why does it not top the export preparedness index? Why not another state, let's say, like Madhya Pradesh? Why does it not top the index as such? Simple reason for this is these states are coastal states. Is okay? These states are coastal states, and by virtue of being coastal states, the export preparedness in these states is much, much higher compared to other states. That is the reason generally why you will see that Gujarat, Karnataka, Maharashtra, etc. are at the top of this list. Now, what about union territories? Which union territory is topping the list for this year? It is Delhi. Remember this? Delhi is the union territory which is topping the export preparedness index. Now, what is the importance of the index? Right? What is the importance? Why should we focus on the index? Whenever the measurement is done, or let's say the performance is evaluated by the Aayog, it will give you a very good indicator of how the states, as well as the central government, how they are implementing policies to produce as well as export goods. Is okay? Does the state government have a policy to promote export? Does the state government has a policy district-wise to promote export? So why should the state have a district-wise policy to promote export? Simple reason for this particular statement is government of India in many of the schemes says that I want to develop districts as export hub. Is okay? The central government has the objective of developing districts as export hubs. So when you say you want to develop districts as export hubs, I don't think you should have a policy for each of the districts. Definitely yes. Now, do all the states in India have a policy district-wise to promote exports? No. That is the observation in this particular index. Remember this. That is the observation. All the states do not have a policy district-wise to promote exports. There are some states. And this is one very, very important point regarding the index. So one reason why we need to focus on the index is we want to evaluate the performance of the states as well as the central government in order to implement a policy and export the goods from India. Second, do states have sufficient export infrastructure? If yes, which are the states which are performing very well? And if the state has sufficient or good export infrastructure, is it present throughout the state or is it present in certain specific regions? So what is the importance of this evaluation? If in a particular state, the export infrastructure is present in only one part of the state, it simply means region-wise. Is okay? Region-wise, there's a difference in promotion of exports. In some of the regions, exports are promoted because sufficient infrastructure is there, and in other regions, export promotion is not very, very high. So don't you think that will also give you a very good indicator of what should be the focus of your policy? And this has been the observation of this particular index. It says that in case of India, the export infrastructure is not uniform. It is not present in all the regions. In certain regions, there is a concentration of export infrastructure, and it is very less in other regions. So there is a region-wise difference in the promotion of export infrastructure. And the second issue that has been flagged by this particular index is that in case of India, we do not have research and development infrastructure to promote exports of, like, let's say, complex export products. And so these are some of the very, very important points related to export preparedness index. Now, based on this, I've given a question here. Consider the following statements regarding export preparedness index (EPI). First statement: it evaluates the states as well as union territories. Statement is true. Within the UTs, Delhi is the best performer. Correct. Within the states, Gujarat is the best performer.
Correct. All the three statements are correct. The right option will be option D here. Sunflower oil imports. Now, why this is there in the newspaper discussion? As such, understand this, in the last couple of years, edible oil imports have always been there in the news. Okay, as such, they have been there in the news. Why? Around 60% of the requirement in India we actually import. Right? Whatever is the demand for edible oil in the domestic market, we import it into India. And within the edible oils, majority of the import is in the form of palm oil. Remember this. Majority of the import is in the form of palm oil. And following palm oil, you also import soybean oil. Following soybean, you import sunflower oil. Is okay? So these are the three topmost edible oil imports into India. And out of 60% of edible oil imports that we do into India, that is, right, 60% is required to import into India. 14% of the imports are in the form of sunflower oil. So what is the connection of all of this with the article here? Let me get to the article. In the recent times, soybean oil production in Northern America has been affected. So supply to the international market will get affected. So the prices are rising up. Second, there is one country, right, that is Myanmar, which exports a lot of these products, like palm oil to the international market. And very recently there is a certain issue with respect to palm oil production. So the palm oil export also will be affected. Now what is left out here? Sunflower oil. In case of India, we import huge amount of sunflower oil. And much more importantly, whatever is the import of sunflower oil into India, 90% of this, okay, 90% of this sunflower oil, we actually import it from two countries, Russia and Ukraine. Is okay? 90% of the sunflower oil that we import are from two countries, Russia and Ukraine. And if you can see this with the data, right, have a look at this. In the year 2021, out of the total import, right, of sunflower oil of $2.4 billion, more than $2.1 billion are imported from Russia as well as Ukraine itself. And between two countries, remember, Ukraine is the topmost exporter of sunflower oil to India. This could be asking UPSC claims. Ukraine is the topmost exporter of sunflower oil to India. Now, there is a war that has been happening here. Ukraine is unable to export the sunflower oil. So there are very two important events that have taken place very recently regarding sunflower oil imports in the context of India. First one, India wants to enter into a long-term deal with Mercosur countries so that we will be able to import sunflower oil from these particular countries. Mercosur is a trade grouping which consists of countries such as Argentina, Brazil, Paraguay, and Uruguay. So we want to import sunflower oil from these particular countries, but they are saying you will have to enter into long-term trades. But in addition to this, there is one more problem. Right now, the imports that we have from these particular Mercosur countries, we are imposing tariffs on them. You will have to reduce the tariff, that is the import duty, so that we will be able to import, sell it in the domestic market. That's the first very important current affairs event. Second very important event is, very recently, India has signed an agreement with Russia. Is okay? They have signed an agreement, or let's say basically a contract with Russia, wherein they are going to purchase huge amount of sunflower oil from Russia itself. So these are the two very important events in the context of sunflower oil in the current affairs. Please be very careful. And in addition to this, there is one more very important point here. India has signed the PTA with the Mercosur countries or Mercosur grouping back in the year 2004. Remember this also. India signed a PTA, preferential trade agreement, with Mercosur countries back in the year 2004. All these points are very relevant for UPSC prelims. Done. Now based on this, I'll give a question here. Consider the following statements. Sunflower oil accounts for majority of the edible oil imports into India. Statement is wrong. Which would be the right statement here? Palm oil. Is okay. Remember this. Palm oil accounts for majority of edible oil imports into India. Second statement. India imported around 90% of sunflower oil. I'm writing sunflower oil here, but specifically this is a crude sunflower oil. Okay. 90% of crude sunflower oil from Russia and Ukraine in 2021. I've taken the statement from the article itself. Statement is true. Right. So the right option for this question will be option B. India UAE deal. Now before you tell me, sir, you have already discussed India UAE deal, I will not discuss what I already discussed. Now there is one specific, right, the provision that has been discussed in recent times regarding India UAE deal. What is the specific provision I'm talking of? They're talking about government procurement. Follow this very carefully. They're talking about government procurement. So what do you mean by government procurement? Government of India will purchase goods and services from the market. All of you agree? Right, if you ask me, sir, why does government procure goods and services? Answer is, government wants to construct, let's say, office. Government wants to, right, employ people, so they will require desk, they will require chair, ACs, water coolers, etc. Right, so there are various reasons why government will purchase goods and services from the market. Now so far, understand this very carefully. So far, under the concept of government procurement, there are certain regulations which have been implemented by the government of India. And what are these regulations I'm referring to? Government of India generally favors the micro, small, medium enterprises in terms of government procurement. That is, there are restrictions which have been imposed by the government. For example, sir, what are you talking of? Government of India says, if the government procurement, that is for a particular project, they are procuring, let's say, 200 crore worth of goods, the tender value is, let's say, 200 crores. Then foreign companies are not allowed to participate in this project tender. Is it foreign companies are not allowed to participate? So why this kind of a differentiation? Government says, I want to promote MSME sector. And is it allowed? Yes, under WTO, this is actually allowed. Is okay? Under WTO, this is actually allowed. That is, respective government has to implement certain guidelines or policies, and based on the policy or regulation, they can have such kind of a policy where certain domestic companies will be given a preference over foreign companies. So understand this, whenever we talk about government procurement, you're simply saying that, right, are the foreign companies allowed to participate? Are the private sector companies allowed to participate? Or are there restrictions which have been imposed by the government? And just like any other country, government of India has a restriction like this. Having said so, have a look at the next point here. There's one agreement, right? Remember the name of the agreement? Agreement on government procurement. Agreement on government procurement. Generally, this is not discussed in the textbooks or any other books. Focus on this. Agreement on government procurement. In short, they will refer to this as GPA. Under WTO, there are certain number of countries which have come together and they have signed this particular agreement. Right? I'll repeat it again. Under WTO, there are certain number of countries which have come together and they have signed this particular agreement. Is India a participant, or let's say, is India a member of this agreement? No. Right? Now, what is this referred to as? There is a term called as plurilateral agreement. Remember the term. There's something called as plurilateral agreement. It is exactly opposite, or let's say it is different compared to the concept of multilateral agreement. So what is the difference? Let me start with the example you'll understand. I'm pretty sure you've heard of GATT, you've heard of TRIPS, you've heard of agreement on agriculture. All these are examples of multilateral agreements where WTO members will sign and implement these particular agreements. Whereas whenever you talk about plurilateral agreements, and by the way, this is in the discussion now, I'll give you the example also. There's a plurilateral discussion that is happening amongst various WTO members in regards to services. India is opposed to that. In regards to digital services, India is opposed to that. And that is under current affairs topic. But when you plurilateral, all the member countries of WTO are not going to sign this agreement. They are not members to this particular agreement. Right? In case of GPA, there are 48 WTO member countries. Is okay? In case of GPA, how many member countries are there under WTO? Under this agreement, 48 member countries of WTO are following, right, or implementing the agreement on government procurement. And the basic idea of government procurement, right, is that, or the agreement on government procurement is that, imagine there are two countries, USA and UK. The companies of USA should be allowed to participate whenever the government of UK is procuring goods. Is okay? The companies from USA should be allowed to participate. And in return, when USA government is procuring goods, the UK companies should be allowed to participate. That is the whole objective of agreement on government procurement. India has not signed this. India is an observer. Remember this. India has not signed this. India is an observer, and it has been an observer since 2010. And many of the times, a country such as USA has asked government of India to sign this particular agreement. But so far, Indian government has opposed this. They have resisted signing this particular agreement. Now, what will happen if you sign the agreement? Once you sign the agreement, foreign companies which are present in India, let's say, want to participate in the government procurement. When the government of India will procure the goods from the market. Now, what is the problem here? The problem is whenever the government procurement will be opened up like this, domestic companies may or may not be in a position to compete with the foreign companies. I'll repeat the statement. Whenever the government procurement will be opened up for foreign companies participation like this, the domestic companies may or may not be in a position to compete with the foreign companies. And currently, that is what is being discussed. Because the CEPA, Comprehensive Economic Partnership Agreement, which has been signed between India and UAE, has a provision wherein the UAE companies can participate whenever the government of India will procure the goods from the market. But there is again a condition. What is the condition? Only 34 government ministries will be covered under this. That is, whenever a tender is announced by any of the 34 government ministries, only those will be covered. So what about central public sector enterprises? What about other agencies of the government of India? Will they be covered under this? Absolutely no. Right? So that is what is being discussed. What is the concern related to this? For the first time ever, government of India has opened up the government procurement for a foreign company. The concern is, one, Indian economy is yet to recover, which essentially means the domestic companies, especially MSME sector, is yet to recover from the hit that they have taken from the pandemic. Now you have opened up government procurement, UAE companies will participate. What if they start winning the bids? They will start providing the goods to government of India. And by the way, remember this, the government procurement size is not very small in India. Generally around 20 to 22% of GDP. That is the value of government procurement in India, which translates roughly around $500 billion. So that is the worth of the goods that the government actually procures. So the market size is very, very large here. So UAE companies might participate, they might win the bid, domestic companies may not be in a position to compete. Second concern is, if government of India is giving this facility to UAE companies, then all the other trading partners will start demanding the same. Now you have to throw open the whole government procurement for all the other countries. That is, those countries which have a trade agreement with you or will negotiate a trade agreement in the future. And as such, already there's a CEPA that India has with Japan. Is there a CEPA that India has with Japan? And there's one provision, one condition there. If government of India signs a CEPA with another country and gives more access to the second country compared to Japan, I'll repeat it. And the CEPA which Indian government has signed with Japan, if government of India enters into CEPA with another country, for example, UAE, then the same access should be provided to even Japan. So there is all expectation that Japan will demand the same kind of access to government procurement. Having said so, what is the objective here? What did government of India do? One, it will basically give you an idea that government of India's strategy is completely changing now. The strategy of government of India is completely changing. So far we have not given this access. Now we are giving. And there is one very important point here. Remember this. India and the European Union were earlier negotiating a free trade agreement. And one of the problems was government procurement itself. Is it okay? The negotiations that have been conducted between India and European Union, one of the sticking points, one of the problem area was government procurement. They wanted access to government procurement. Government of India was saying no. Now there is a change, a shift in the strategy. So it might help government of India to enter into more and more free trade agreement. Second, if the competition improves, right, obviously the government of India will be on the winning side. So how? Imagine, right now only domestic companies will participate. The lowest bid, that is the tender value, is let's say 100 crore rupees. Now if a foreign company participates, it provides the lowest tender value of let's say 90 crore rupees. Government of India's money spent will be much lower. So competition will promote, right? It will promote competition. So these are some of the very, very important points related to the India-UAE deal which is being discussed in the newspaper. Done. Now based on this agreement, consider the following statements regarding agreement on government procurement. This is a multilateral trade agreement. No, it is a plurilateral trade agreement. India is a member, signatory of this agreement. No, it is just having an observer status. It is not a member of this particular agreement. Right option will be option D. For the first time ever, India has crossed the total trade, that is goods trade, of $1 trillion. Now before you say, sir, you already discussed in the last week. What I've discussed in the last week is the merchandise exports crossing 400 billion for the first time. What I'm mentioning here is total merchandise trade. Right? What do you mean by total merchandise trade? Imports plus exports. Is it okay when I say total merchandise trade? I'm talking about imports plus exports. So what is given in the article? Very important points. One, for the first time ever, the total merchandise trade, that is between India and the rest of the world, has crossed $1 trillion. What is the importance of this? India wants to become an export destination. India wants to become a global factory, and it also indicates that there is a rising demand for goods in other countries, which is a very good news. It is also one good news for India because we have imported, right? And understand this very carefully before you jump to conclusion. Whenever the imports into India will rise, one indication of that is there is a demand in the domestic market. I'll repeat the statement. Right, whenever the imports into India will increase, one outcome of that or one influence of that is India's demand for goods and services is also rising up. It is also increasing. Don't you think that is actually good news for Indian economy because it indicates recovery in the market? Higher demand means recovery because people are spending more money. That is good. Right, so apart from this, what else has been provided in the article? Right, just remember this. India's exports to the global exports or India's proportion in the global export market accounts for 1.7%. Is okay? Indian exports in the global export market is accounting for around 1.7%. And China's exports, right, are accounting for 2.6% of the total global exports. So these are some of the very important points which have been mentioned in this article. Beyond this, such remember everything which is given in the article, please don't do. The agreement between India and Australia, the trade agreement. Now the name of the trade agreement right now, remember this, is ECTA, Economic Cooperation and Trade Agreement. It is not CPA right now, it is not an FTA also, it is a higher concept of an FTA. The name that they have given is Economic Cooperation and Trade Agreement. And various articles have given this, and even the statement that was published by the government, they have clarified it. Initially they wanted to have an early harvest trade agreement, but later they decided no, let's not go for an early harvest, let's enter into a trade agreement. And eventually, in the next couple of months, negotiations will continue and they will have comprehensive economic cooperation agreement. Is okay? Comprehensive economic cooperation or partnership agreement in the next couple of months. Now you have to wait and see what will be the nature of the comprehensive economic agreement that will be decided later. But right now, what are the important points here? Follow this particular discussion. Certain very important points can be picked up by UPSC from this article itself. First one, in terms of the merchandise trade between India and Australia, what has happened? India says you export the goods to India around 70%. I will cover them. I'll reduce the tariff so that you can export more and more to India. Second, India will also export more than 12,000 merchandises or goods to Australia. To begin with, around 95% of this, the tariff will be lowered, and over a period of time, that is in the next 5 years, 100% of these particular goods will be covered and tariff will be eliminated. So we will be able to export more and more to Australia. And as such, remember this, right now, the bilateral trade, that is the total value of the trade between India and Australia, is somewhere around $27 billion. For 2021, it was $27 billion. Under this particular trade agreement, we want to increase and achieve $50 billion in the next 5 years. We want to achieve a total trade worth $50 billion in the next 5 years. Now, this is in terms of merchandise, or let's say the exports of goods. Now, second, in terms of services, what a very, very important point here. In terms of services, India will be getting a preferential access, right? That is liberalized, the norms will be applicable with respect to service exports that India does to Australia. This is very, very important. India will export services to Australia. Australian government will apply liberalized norms, very loose norms for these particular service exports that we are doing. In fact, under this particular agreement, 100 sub-sectors under the service sector will be covered, and these liberalized norms would be applicable for these 100 sub-sectors. Now, what is the importance here? First and foremost, India is exporting a lot of services to international market, and if you see generally in the context of GDP, more than 50 to 55% of the contribution to GDP comes from the services sector. And second, our exports
exports in the form of services are also very, very high. Now we'll be able to export more and more services to Australia because of this. But more importantly, remember this point also. There is one agreement under WTO, General Agreement on Trade in Services, GATS. Very important. General Agreement on Trade in Services, GATS agreement. Under GATS agreement, we generally divide the services into 4 types. I'll connect it to the current affairs here. Under GATS, we divide the services into 4 types. Rather than saying 4 types, they will write this as mode 1, mode 2, mode 3, and mode 4. Is okay? Mode 1, 2, 3, and 4. And please go through all of these 4 words. For example, in the current affairs, that is the trade deal between India and Australia, they are going to cover mode 4. I'll repeat it. In the context of India-Australia trade agreement, they are going to cover mode 4 under the GATS that recognizes the service of trade like this. Mode 4 basically deals with movement of natural persons. Is okay? Movement of natural persons. So what do you mean by that? Under this agreement, now for example, from India, chefs can easily go to Australia because they are covered under this mode 4. That is covered under the services, which is covered under the trading. Right? Yoga teachers can simply go there. Right? Services person, anybody who is going to provide the services, and that is going to be covered under this agreement, they can easily travel to Australia, provide the services in Australia. That is the importance of this particular agreement in the context of services. Second very important point. Third very important point. There are certain sensitive areas or sensitive sectors. Those have not been covered under this particular agreement. Best example, agriculture sector. Okay, there are certain sensitive sectors. Generally, Indian government is very touchy with respect to agriculture because if I cover agriculture sector and I will allow Australia to export more and more goods, and Australia, trust me, can export more of these agriculture commodities to India, farmers in India will be unhappy with that. And generally, government will try to protect these particular sectors. So sensitive sectors has been kept out of this particular agreement. Fourth very important point. Safeguard mechanism has been put in place. Remember this. Safeguard mechanism has been put in place. That is, if the imports from Australia suddenly surge, they increase into India, it will affect the domestic manufacturing. And obviously, domestic manufacturers or companies will be unhappy with the government. So there is a safeguard mechanism which will be implemented by the government, and the safeguard mechanism has been inserted within the trade agreement. Fifth very important point. There is a compulsory review mechanism after 15 years of implementation of this agreement. Compulsory, there will be a review of this particular agreement. Why this makes a lot of sense for India? Earlier, government of India signed many trade agreements with many countries. But over a period of time, we have realized that the other partners are getting more benefit out of this trade agreement. Our trade deficit is actually increasing with these particular countries. So after 15 years, there is a compulsory review mechanism under this agreement. Remember this, very important. And the sixth very important point, I'll write it at the top here. It will try to address the issue of double taxation that the service sector companies used to face, which provided the services from India to USA. Now, what am I talking here? Software companies, whenever they take a deal or whenever they enter into an agreement to provide certain services to, let's say, the clients, they will generally divide the work into 2 parts. That is, most of the work, let's say part of the work, they will do it in India, and remaining work, they will do it in Australia. That is the place where the client is actually present. That is in simple terms, on-site services will also be provided. Now, because of various judgments in Australian courts, even those part of the services which were provided from India, that is, imagine part of the software is built in India, code is written in India. So obviously that income is generated in India. Australian courts basically stated that even that particular income which the Indian software company is generating, doing the coding in India, will be considered for taxation in Australia. As a result of this, Indian software companies paid a huge amount of taxes both in the countries, that is India as well as Australia. That led to double taxation on these particular software companies. Now under this particular agreement, this issue will be resolved. Is okay, this particular double taxation will be resolved. So these are some of the very, very important points regarding the trade deal between India and Australia. Now MCQ on this, consider the following statements regarding India, Australia, ECTA. It has an inbuilt safeguard mechanism in case of surge in imports. Statement is true. Compulsory review mechanism after 5 years. Statement is wrong. It is after 15 years. Remember this. Right. So based on this analysis, option A is the correct one.